investment groups, watching from Canada, from ASEAN, it's probably a bit later in the day because it's super early, but obviously from Australia as well. And I said, that really goes to speak to everything about what Emergence is. Emergence is about putting a spotlight on the entire ecosystem, whether it be the founders, the investors, or the companies that play a role in help make this ecosystem work. And I remember from the very first time we did it, that seemed to be, we set that as a standard and as an outcome as far as what we wanted. And you will see today, whether it be the keynotes that we're hosting, whether it be the panel sessions that we're hosting, whether it be the companies that are presenting and being featured at the event, everything we do is absolutely aligned with that. And from a company's perspective, to give you some history of Wholesale Investor, we actually started as a magazine. And the whole idea for us was, let's curate a bunch of companies, and then also let's bring together a high net worth to actually showcase those opportunities via the magazine. Then in 2000, and that was in 2008, just after just as basically in October 8 was actually the starting point. 2012, we shift to basically an online to offline model. And then 2019, we took our next step. And this is really what's important for us about this conference. That next step was building our own software, Crisp, where we could actually, the idea was how do we seamlessly integrate the online and the offline experience as well? And then also, how do we actually empower that connection between you guys as both investors, founders, and also industry? One of the key parts for that, and I'll go through a bit of the software in a second. The other thing I mentioned is about the history of Emergence. We did our first Emergence in 2018. And I remember it was around about 2019 when, for some reason, there always seems to be that period of like January to March where there just seems to be mayhem from a market's perspective. The time that we experienced it the most was, I think about the journey that we went into the 2020 Emergence, was firstly in November. In the November, December, there was bushfires in Australia where we were getting international companies asking us if it was actually safe to come to Australia. So you remember, you look across the CBD and the skies were just black. And then, of course, there was COVID. 2021, I think we almost killed our team trying to host a 24-hour Emergence. And then, of course, last year was one of the most wildest rides I've ever experienced, trying to navigate COVID. Also then ended up basically having one in a century floods take place literally whilst we're hosting the event, not having team members be able to get here, etc. And then this year, if you think about it, having banks fail just before you kick off an innovation showcase is not ideal. But what's exciting about this space is it doesn't matter what's happening on the negative side. The reality is what sits in this room is optimism, right? And effectively, what is the nicest thing about being in this space is the people that actually are involved in it and the attitude in which they bring to this ecosystem as well. So over the next 2 days, one of the nicest things that you'll experience, it's like a bubble of optimism and a bubble of potential. And the best part about it, that is demonstrated not just through the keynotes, but really through the companies. And one of the slides I did in a presentation earlier this year, I talked about all the different negative things, and I mentioned about what is absolutely always undefeated in this space is founder optimism, right? And that is really what sort of drives this. And also what's important about that is the founder optimism and then your optimism on the investor side. So as I said, these next 2 days, you're going to hear from some incredible founders and you're going to hear about their businesses. They're going to be presenting their opportunities. My encouragement to you is this, both in person and online. Every single one of you has in your networks anywhere between 10 to 15 people that are relevant for this space. So when you're having conversations, I recommend to also think about who it could actually be relevant for as well. Yeah, I'm going to get my right. There we go. Now, from the actual presentation part, what we know about challenging periods like what we're experiencing now, because we experienced this in the GFC, many of us anyway, in that it actually accelerated transformation, right? 2008, we saw that a lot of the companies we know as household names got their start in that 2008 to 2010 period. Then what we also know is when it comes to actually COVID, it was a similar thing as well. Oh, hang on. It's always a trick with clickers, figuring out the exact direction to send it. Okay, now we're back to the start. But COVID was the exact same thing. Instead, it provided that transformation. Can we go to there we go. And we saw that across many different spaces. Many different companies absolutely blew up. And there's a lot of different factors that actually align for that. Not only was everyone at home that needed to actually then be connected online, but there were other factors at play as well. And 2020, sorry, it's just the clicker's not working properly. So in 2022, for investors, for many, like the biggest thematics that we found from everyone was, it was really the year of climate tech and the year of yield. And that's what we saw coming from investors and what they were interested in. And as we're sort of moving into 2023, not only is that still a focus for many investors, as what's happening around the planet, but also got the other aspect of the great transformation. And this is the thematic which really sets the foundation for this entire conference. And it comes from the work of two different people. And if you haven't watched them, I think I think everyone in this space should be. The work of Tony Seba, and then also the work of Kathy Wood from ARK Invest. This transformation where you're seeing these platform technologies being developed around, say, whether it be food, the future of food, whether it be AI. I'm sure every single one of us has benefited from things like ChatGPT recently. And you understand that all of a sudden with tools, with the technology that's coming down the pipeline, the capacity for human potential is increased massively. Energy storage. Blockchain's been a big one for us since 2017, 2018. And then in the life science, the personalized healthcare space. We're fortunate enough to work with some incredible life science companies. You'll see the likes of James from Recce today, Biosignals Diagnostics. We've got EBR Systems Inc. who are developing a new type of, can't believe it's gone from my head, pacemaker that's tiny and got no wires whatsoever. It is absolutely crazy the innovation that comes from Australia in the life science space. So for me, these factors were going to play out across all the different presentations and all the different keynotes throughout the actual day. Okay. I don't even know where this is. Okay, so from adoption, one of the things we want to highlight, not only is the fact that I mentioned about these platform technologies making a difference, but also the fact that the adoption curves that's taking place. A lot of these technologies are now moving to their early adopter phase, which for obviously investors represents a significant financial investment opportunity. And because as that adoption takes place, that is typically where you see the highest growth in the companies and in the valuations of the companies that are actually participating. Can someone actually help and just maybe move it for me? So what we're actually seeing, next slide. So effectively, these are some of the headlines that a lot of us would have been seeing lately. Obviously, the job redundancies, people being laid off, that's been a common theme across all the big tech companies. And I remember I said to someone, as soon as we start seeing telcos and banks laying off people, that's when you know it's really on. And it was interesting that, it was probably about a month after that, that's when we started seeing banks collapse. Now, that's something that none of us expected, starting with the one most titled for our entire space being Silicon Valley Bank. And then you sit there and think, okay, well, how does this actually play out across the ecosystem? Next slide. And the reality is, whilst that negative news is taking place, there's also some incredible optimism that actually sits underneath all of that. And the great saying of software ate the world. But I love the addition to that now. It's now that AI is eating software. And if you think about many of the companies that are actually presenting today are all would be utilizing AI in some way, shape or form. The digital transformation, how it actually creates additional productivity amongst ourselves in our own personal capacity, but also across our teams as well. And then also that capacity for job automation. The part that I find really interesting is, as a B2B business, you always thought about the B2C businesses, how easy they had it because they had things like Facebook, Instagram, TikTok, and their platforms. What's beautiful now, if you think about from a scaling point of view, B2B companies have access to data. Everyone has their data accessible in some way, and there's software to actually scale that outreach to that. So that means the upside potential for B2C and B2B businesses takes on a whole new level of opportunity. Next slide. So obviously I'd like to say a big thank you to our keynote speakers. Michael's obviously going to be coming up first. Mian B from Medical Angels, from Daniel from Backbone Partners, then Hugh from Galileo, Todd from NAB Ventures, and then obviously Lisa from DigitalX who will be in the next room, and I'll explain the room structure in a second. You know, very excited to have these keynote speakers, each in their respective areas, so to have a look at what they're looking at, what they're seeing in the markets, and also what are the investment opportunities that you've got the opportunity to take advantage of. Next slide. And the different panels we're going to be hosting, obviously the venture investment trends. By the way, all this is actually in your app, in the conference software, which I'll get to in a second. The climate tech solutions for a sustainable world, so the climate tech panel, the rise of syndicated opportunities. For me, I believe this is the future of the space. You know, there'll be a lot more syndicated opportunities coming out. And then obviously the last one, and then the last one being the career opportunities in venture capital. Next slide. On the presentation room 2, so basically the way it works is this is presentation room 1, and then around the corner we have presentation room 2. We have digital investment trends for 2023, and we've obviously got some incredible digital asset managers that are highly, highly regarded in this ecosystem. And then the one that sort of, I suppose, sets the foundation for all of this, which is the great transformation, the AI, sustainability, and deep tech. As I said, the platform technology is being built around those key areas. Next slide. Okay, and then also at 11 a.m. we've got a separate room right down the end where we're going to be having a masterclass session. This is more for the founders in the room. At 11 a.m. we've got After Work Ventures. They're presenting how they're approaching VCs differently. And then also we'll be doing a session, Wholesale Investor will be about raising capital in 2023. That will be at 11:30 a.m. Next slide. Okay, now obviously these events don't happen without sponsors and without partners, so I'd like to say a big thank you firstly to Auticon. You know, I can't wait to have Bodo come up. Auticon is actually backed by Richard Branson and the Porsche family office. They're an incredible company that basically taken people with autism and then put them to work in a consulting area in their actual specific skill set. They're a global company doing incredible things, and I really encourage, you know, their outcome in being involved today. I said, I want to give them as much visibility as possible. My hope is that whether it be you as investors introduce them to your companies, or the companies that we're featuring look to have conversations with them about what they're doing and how they can help. Stake, obviously one of Australia's largest online trading platforms. They're actually streaming our ASX stream tomorrow to our event. So to Sergio, Matthew and the team, thank you very much. We're very happy to be involved. And do you know what, that whole thing, when I suggested the idea about creating visibility to some of the smaller micro caps, they were right on board. And that is everything that we're about. Everything we're about is creating opportunities for tomorrow and making sure that there's visibility in the ecosystem. Matthew from weConnect, one of my favorite people that I've actually met as far as the energy he brings to the table and the enthusiasm for this. He's actually flown in from Japan for this event to speak here. You know, the work that weConnect does, obviously you have portfolio companies that are scaling, right? Or you may be scaling your business. Their whole job is to take the administrative nightmare out of that process and simplify it for companies that are looking to scale globally. So, said great stuff they're doing. Flav, you know, Stuart has been a good friend of mine for a very, very long time. He runs his own family office. He's an investor himself. But this is his brand that he launched, Flav. They're actually catering lunch, and they're also, like with everything for a Wholesale Investor event, everything is available to be invested into and to have discussions with strategically, right? Including the food sponsors. So Flav are also in capital raising as well. So try their food. They're taking, they're part of that sort of future of food that I mentioned. Pacific Channel, they're a New Zealand deep tech firm. I first met Brent 10 years ago when he started introducing New Zealand companies to us. He was one of the pioneers in actually bringing over NZ companies to Australia. Some of the results, basically what they did, they had so many different success stories that they ended up building a fund around that business. Brent is an incredible guy. His team are fantastic to work with. Some of the opportunities they have access to coming out of New Zealand that actually have scalable global potential are very impressive. So make sure you speak to the Pacific Channel guys. Sales Director Central. I said for companies, one of the funniest parts is people very rarely talk about sales in this space, but this is exactly what their focus is, help bringing sales, leadership and scaling to companies. And then Chefin. So for those that are invited to the VIP room, one of our favorite companies that we've worked with over a period is Chefin. They're actually catering in the VIP room. Their food is absolutely delicious. Petco's an amazing guy. Have a chat with them. They're also raising capital as well. I said everything's available from an investment perspective. Next slide, please. So I was going to talk a little bit about the software we're using for today. So obviously, everything we've thought about Crisp, all of you have probably been on it by now. You've probably seen that inside the actual networking zone, there's probably nearly 1,500 people in there with what everyone's doing and what they're looking at. Crisp is our basic mission in basically building a world-class solution to a global problem. Next slide. So first step is go to app.crisp.io. If you aren't in there already, just go to, and when I say that this app is designed to absolutely empower your experience in the conference, you can find anyone that's relevant to you, whether it be investor, company that you're looking to invest into, is sitting inside that app and very easy to find. Right, next slide, thanks. So the way we've thought about it is firstly, intelligent deal rooms. Firstly, it's got two-way AI ML matchmaking. So you as an investor, actually I'll go through that in a second. Basically, we've done our best to streamline and simplify the process. We've got frequently asked questions for investors. So we've encouraged the companies to set up their most frequently asked questions when you're discovering the opportunity. Obviously, some of their latest news, and obviously got the capacity to message as well and network. Next slide. So with the AI ML-driven matchmaking, I think from what I've seen, we're one of the first companies globally to implement a two-way version of this where investors can see the most relevant companies for them and companies can see the most relevant investors for them as well. This was a massive milestone we achieved in the last month. Next slide. And the three fundamental principles that we've built the software off is really simple. We want to build software that lets the ecosystem do what it naturally does. So whilst we're using it for our event today, it is also where we'll be engaging with you, with our clients going forward in the future as well. Also building a globally scalable solution. You'll see that we're going to be launching a global version of our offering shortly. At the moment, we're across Australia, Singapore, and the UK. And then the last fundamental principle is how do we remove friction from the capital raising process, but also creating a global opportunity at the same time. All those has been the key parts. Next slide. And the integrated conference software part, as I said, we've done our best to make sure that this experience is absolutely streamlined. The agenda is up to date. There's instant messaging and networking, which I know some of you have already been going back and forth with people. We've already seen thousands of messages going through the system already. And then obviously it's got a live agenda in the virtual booth inside the platform as well. Next slide. So I'm going to finish on this one slide. The power of one conversation, the power of connection. Every single year, year after year, Emergence teaches me that it only takes one introduction to change the entire trajectory of a business. The only challenge is we don't know which conversation that is. And that is part of this ecosystem. This ecosystem is amazing in the way in which people actually support each other. And I've seen it where one conversation has led to a 20 million investment. I've seen it where one conversation has led to a company strategically going global with their actual business. I've seen it where one conversation has actually opened up an entire nation for a company. Because this business is the power of people and it's the power of networks. And that is absolutely what I love about Emergence and bringing people together. And the 6-month journey that we go through, that's a wild emotional ride to bring this to you, this next 2 days makes that worthwhile for us. Because if you think about all the connections that get made and then the connections that pass on from that, I said, that is what becomes special about an Emergence experience. So never forget that power of the one conversation, and also never forget that when you're having conversations with the companies in their exhibitor booth. So just to explain the layout, the exhibition area is just as you walked into the right where all the companies are being featured. The VIP room is just off to the left here in between, and then Stream Room 2 is just on that side as well. Now, obviously, all the different agendas for the 2 different streams are covered in the actual software, right? And also online, so you can see it at any time whatsoever. Next slide, thanks. Okay, so next slide. So basically, as a next step, I'd like to say, welcome to Emergence. Thank you for joining us. I hope you enjoy the next 2 days. We've done everything to make sure that the experience, is something memorable for everyone, so that not only do you come back next year, but you bring other people along with you. Now, on that note, I'm going to introduce Michael from Google to talk about generative AI and what comes next. Thank you.
Perfect. Good morning, everyone. I'm Rhythm. I'm going to be your MC for the next 2 days. We have an incredible lineup of exciting and informative sessions planned for you, featuring some of the most inspiring thought leaders in the industry. For our first keynote speaker of the day, she is an accomplished leader in technology industry with extensive experience in digital transformation and innovation. Please join me in welcoming to the stage Lisa Wade, CEO of DigitalX.
Hey everyone, room 2, hey? This is where it's all happening today. We might just start on my first slide if that's okay, or do I do that? It'll happen, it'll happen. I think I know it off by heart anyway. Could I just get a show of hands, because obviously I can shape shift the content to the audience. How many people here understand the term Web3? Okay, sorry, you're going to be bored. No, I'll gloss over it. How do I get my... There we go. Yeah, usual disclaimer, this is not financial advice, and today, because the theme is investments, I'll do something I don't always do, which is talk about our fund. I usually talk about DigitalX Limited, and yeah, this is not working, team. But that's a very big disclaimer there. So DigitalX is an interesting listed company on the ASX. We're the only company listed in Australia that has Bitcoin on their balance sheet. And that gives us sort of a fair and uniquely different point of view to most listed companies and where we operate in the financial ecosystem. To make the Bitcoin on our balance sheet efficient, we actually run 2 crypto funds. So one is a Bitcoin fund and one is a top 20 crypto fund, where we use what we call an original process called a universal scoring matrix and filter down from, there's about 19,000 tokens in the world, believe it or not, and we filter down from 19,000 down to the top 20 using our own unique process. And we also use this same process now on a new product that we're launching, which is a real-world asset tokenization fund. And I noticed there's a real-world asset tokenization stall out there, and I have publicly said that I believe that 2023 will be the year of the real-world asset token. What I didn't realise is that there will be the beginnings of a new global financial crisis, which we're currently walking into. And now I will also be on record. Somebody sent me a text message the other morning and they said, welcome to the period of Bitcoin adoption. And I nicknamed that International Bitcoin Adoption Day, and that was Monday. And I genuinely and passionately believe that what is happening in global financial markets is why Bitcoin was invented, and I'd be very happy to answer questions and talk about that today. But what we're seeing in the market, which is, after a terrible year last year, we can't deny that, Bitcoin is starting to find its feet, and I believe it will find its way onto corporate balance sheets and find its way as a mainstream type currency as we move into this period of uncertainty. So DigitalX, we manage investments in digital assets, and our mission is to build one of the world's most transparent digital investment management companies, and that takes all forms and guises. So I just thought I'd give you a quick overview of our company structure, but I'm not going to talk about the listed company today. The code is DCCAU. If you want to take a look, go and do that. So what I wanted to talk today about is what is Web3 finance. So sorry, the slide's a little bit messed up there. And from my point of view, Web3 finance is a new and emerging set of financial rails or financial infrastructure. And I passionately believe that that's the greatest economic opportunity of our generation. So when we look at what we invest in the crypto fund, we're not just punting crypto and mining and doing all the usual things. We do stake Ethereum off the balance sheet. What we're actually doing is looking for opportunities in what we call the new financial rails and selecting assets in our portfolio that we believe will be the financial infrastructure of the future. Now, I notice my friends at Leonie Hill here. They also build asset tokens, and I encourage you to go and talk to Adam after this. I won't be around all day, but we work very closely with Leonie Hill in building some of these financial infrastructure and rails. We own a stable coin called XAUD. We own part of a tokenization platform called xBullion, and we also are building other real-world asset solutions. So when we talk about these financial rails, for me, one of the biggest opportunities is the change that we can make to KYC and AML. So if you talk to any financial institution in the world, and off the record I can say when I was at National Australia Bank, when I started building the blockchain projects inside the bank, they very quickly did what banks do, and they put me on a paper to work out the digital strategy for CNIB across the whole of the division of the bank. And not only was it quite boring, but when we did a reconciliation of everything that was happening across the bank, in CNIB alone, there were 16 KYC and AML digital projects, 16, 1-6, and I'm not exaggerating or lying, because every single division of the bank was unable to use anybody else's KYC and AML. So every time we deal with a client, it's like we've never dealt with them before. You cannot take for granted that they're the same management. You have to do all of the checks again. Now, one of the biggest opportunities I see for Web3 is these verifiable credentials. And what I'll talk about throughout this talk is a concept called Web 5. So Web 5 is Web 2 plus Web 3, and it sits across this ION platform that is built across Bitcoin. And the difference between what people call Web 3 and Web 5, I think, is amazing. And it's this ability for consumers to take their own credentials and take their own data and take the ownership of that data into their own world. Now, many people think that that's the same as Web 3, but actually the main difference is in Web 3, I'm still giving over my wallet address to every person's ecosystem that I join into. In Web 5, I'm actually owning my own credentials, and I'm inviting people into my walled garden. So instead of signing up to an app, the app signs up to me and I allow it into my world. So where does that start? That has to start with credentials, and I'm obsessed right now with a thing called soul-bound tokens. Now, a soul-bound token is a non-transferable, non-fungible token. Now, there is a mouthful if you've ever heard of one. And the way these work is you basically have your credentials inside of a wallet, and that wallet can then bring other apps in and be verified. So why is that a game changer for KYC and AML? What it means is that as a financial services provider, if somebody has a soul-bound token set up in their wallet, I still have to check their credentials every time. However, I don't need to communicate with them or speak to them. I can actually use that non-transferable, non-fungible token as a verification to prove that that person exists and that KYC and AML has been done. And that can happen 1 million times faster. And so it doesn't matter how many times you have to check somebody's credentials and do the KYC and the AML, you're basically able to check them much faster. And from my point of view, that's a game changer. So we'll talk about that in a whole context in a minute. What I wanted to show here is that Bitcoin is very well known for its sort of characteristics as money. It's less known for how you can actually build on the network. And Ethereum is, ultrasound money. That is the network that we all build on, and that's the network that we bring smart contracts onto. But the inventor of Web 5, which is Jack Dorsey, who also invented Twitter, and I'm sure everybody's heard of him, they're building this Web 5 on top of ION, which is built on Bitcoin. So from my point of view, that just cements Bitcoin's place in history as what I believe will be the blockchain that stands the test of time. I also believe Ethereum will as well. That's why we stake it. So in terms of this identity what I'm talking about with the onboarding of apps into your world and why that's a game changer is because I believe that people are just going to be sick. I mean, who here is sick of handing your data over? Who here is sick of, being worried about hacks and people stealing your password and having your whole life blown up? I mean, we've seen some really big data breaches this year. And in the Web 5 world, these data breaches will not be able to happen because you will be in control of your own walled garden and you will be the one bringing the apps in. Now, will criminals try and build Trojan horses? I'm sure. However, as we know, in the world of word of mouth, there's another tongue twister, I should not put those in my talks. In that world, word of mouth and credible apps will be able to be onboarded into your ecosystem, and it'll be up to you on who you bring into your world. So this is just a neat little example of previously, yesterday actually we were relocating a staff member. They messed up his accommodation. He's the young kid in the team. He was in Perth. He didn't have anywhere to stay. So I'm sitting there on Airbnb with my Digital X credentials, having to log in really quickly and get this poor guy some accommodation. So Airbnb now have all of my credentials. Do I want Airbnb to have my credentials in the future? No, absolutely not. I would have much preferred to have onboarded them into the Digital X data ecosystem and then onboard them as a trusted partner. Do we have that option now? No. Now, it's all well and good for to think about this in the context of a slide. How does this work in practicality? So basically, it will still hook into your MetaMask wallet as per normal. Who here has a MetaMask wallet? All right, everybody else should go and get one. This is the future. So you can actually download while I'm talking, I won't get offended. But basically you'll be able to do this inside of your wallet and onboard the apps into the equivalent of your wallet, and you will be in charge of your future. Now, what are we doing at Digital X? So I might just skip that slide. So just for the people who don't know what Web 3 is, my definition of Web 3 is Web 1 was when we just did instant chatting and emails to each other online. Web 2 is when I started shopping from my couch with my credit card. And Web 3 is basically going shopping with your friends in the metaverse, paying with your MetaMask wallet that I showed you before, using any type of crypto. Web 5 is the two of them together, which, as I said, is this portability of your data and control of your data and having that discernment. So what are we doing at Digital X and creating around this? So we are launching a real-world asset tokenization fund. So as I said earlier, inside of our portfolio, we select crypto and tokens that we believe are going to build these new financial rails, with the vision of the future being that I believe the 100% of assets will be tokenized by 2030. Now that might sound really ambitious, but I actually believe it to be true, and I think it's going to happen faster than we think. As I said, I believe 2023 is the year of real-world asset tokenization, and to put our money where our mouth is, we have set up this fund. So basically what has been announced to market is a deal that we've done with a company called Bricklet. Now, Bricklet are using blockchain technology to validate and verify the ownership credentials of a house. So why is this a game changer, and why are real-world assets game changers? When I was at Bendigo Bank, we spent many years trying to build what we called a no-deposit home loan. We had all of these customers who had self-managed super, who had children who couldn't buy houses. Their money's locked in their super. It's illegal to give their children any money out of their super. Technically, they want their children to inherit that superannuation. And there was this standoff between kids not being able to afford houses, and literally we have interviews of parents crying because they're so upset that their children can't get into the property market. And I'm sure there's people who feel that way right now. I know I've got members of my team who feel like they're never going to be able to buy a house. So Bricklet have managed to get what we call a co-ownership deed registered on the blockchain, which means as an investor, I can now prove that I own 20% of a house. Therefore, I can support people into the property market and close that gap, because investors can now see that asset. Previously, if you had a mortgage, you face off against the bank, and you own the deposit and the bank, and then you owe the rest of the money to the bank. as an investor, I can't lend because it's illegal for somebody to have a 100% mortgage, but I can't give somebody that 20% because I'll never be able to prove that I own 20% of the asset if something goes wrong. So what Bricklet have done is created a co-ownership deed, and that sits on the blockchain, which means I can invest in that deed and close the gap for that householder, and they can go to the bank and buy their house. So there's a few cool innovations in and of itself in what Bricklet have done, and then what we've done with our universal investment score, which is a matrix. We actually, once the AMP, which is the current bank that works with Bricklet, once they approve the homeowner to borrow 100%, we can start doing work on the asset. If the asset meets all of our criteria, we can then invest in 20% of the house. Now, at the moment, the game changer in that is yesterday when I would invest, I would use paper and I would do the due diligence. Today, when I'm investing, I'm using the data that comes from that house that Bricklet supplies to us and from the AMP bank to verify that that home exists, that the home borrower has been approved, and all of the inspection documents from the house are digitally recorded so we can automate our investment process. So we've done 4 trades off our balance sheet, which were approved by the board, and now we're rolling that into a fund. What we've also done is we own a business called Sell My Shares. We've started to do same-day settlement for people who want to sell shares. Now, I'm funding that off our balance sheet, and what we're also doing is building a liability token off our balance sheet, which could be any liability. At the moment, it's the 2-day funding for T0, which means my investment fund can constantly fill that gap via tokenization every time I need more money for the T0, because the moment we set up to pay that customer, if we use our XAUD, the money talks to the liability off the balance sheet talks to the money in the fund, and we're able to continuously fund that liability, which I believe is the future of corporate borrowing. So inside that fund, I believe that there will be an infinite number of investment opportunities. We're very happy to invest in any real-world asset tokens as long as they meet the universal score. And the naysayers of real-world assets, and I don't disagree with them, will say that people will start tokenizing photos of assets. And I believe that in the future, as an investment manager, my only job, even if I worked at National Australia Bank, I will have the same job. My only job is the verification of the data that the asset actually exists, and that you believe that my process actually invests in, yesterday I used the example of a pen, today I'll do a clicker, that I am proving this clicker is here, not a photo of a clicker, not a photo of a clicker, and that will be the role that investment managers play in the future. So I think I'm at time, but I wanted to leave a minute for questions because I know that there was a lot there. Probably spent a little bit too much time on identity, but does anybody have any questions? Yes?
Sorry, one question here. Just wanted to check any legal issues for this ASAP organization.
Yeah, look, so what we have done in the first instance is we have created what we call digital twins. And that was a ruling. I believe so KWM created that legal precedent when I was at National Australia Bank. And what you do is you take the paper credentials. So in the instance of Bricklet, there is actually a legal document that is that co-ownership deed that I have physically signed with I didn't sign it with my pen, I did on DocuSign, but you know what I mean. So it's still a little bit old-fashioned in that way. So the co-investment deed exists as a real legal document, and then we tokenize the digital version of that, but there is still a record of truth which exists in the world. And then the work is this reconciliation. So Project Carbon was another, which is now Carbon Place, was another project of mine. And what we did in that is what we're doing with real-world assets now, is proving the reconciliation of the legal status of the data to be equivalent to the paper version, and that there will need to be, work done on that, and that takes time, right? So in 5 years' time, I'll be able to say that data I received from AMP and that all of those digital signals I received from the house are equivalent to this piece of paper that I tokenized on the blockchain, but we're not there yet, and there'll be work that needs to be done around that.
Cool. Thank you.
Yeah, and the other ruling is called abondment, and I forget the name of the legal company that did that, but there's bondment and digital twins.
Thank you.
Yeah. Yes?
It's the beginner's question. Beginner's question. The real-world assets certainly include work in digital forms, like movie or film or artwork. Does it?
Yeah, so and that would depend on your investment criteria. So yes, there are non-fungible tokens and digital assets that are artwork and those things. And the Citigroup wrote a report in 2018, I think, and they call this a financial revolution for that very reason, because yesterday as a portfolio manager, very hard for me to invest in art or movies or things like that. It's very specialised, but you'll be able to fractionalise those assets and more likely the cash flow streams off them and be able to add them to your portfolio. So it's actually revolutionary in portfolio construction geek, which I didn't really go into today. But that's what our universal scoring matrix does. We construct a portfolio and then look for the matching data credentials that match that portfolio construction.
Okay.
Yeah.
Thank you. Oh, sorry. Where can we find universal matrix for that?
Oh, we haven't published that. That's a little bit of IP that we're building, but I'm happy to, if you email me, I'm happy to. I've just finished the first one-pager on it from an artist, so I'm be very proud to share that today. And it's not investment advice, and it's not an investment document. It's a piece of art.
Thank you.
With a lot of blood, sweat and tears, let me tell you. Yeah.
Thank you.
Okay, thank you, Lisa, for such an amazing session today.
Thank you, everybody.
Thank you. Amazing. Hi, everyone. So our upcoming segment features presentations from 5 innovative companies. Each presentation will give you a glimpse into the innovative technologies and solutions that are shaping our world today. So sit back, relax, and get ready to be inspired by the amazing presentations that are coming your way. First up, we have the founder and CEO and CTO of Leonie Hill, Adam Switzer.
Hi everyone. I was actually going to say thanks to Lisa for the mention before and talking about some of the topics that we're going to talk about today as well. So she's absolutely right. We've got a partnership with them through another company to do the XAUD Australian dollar token and also gold and silver through XBullion. And also really ramping up into real world tokenization. So particularly focusing on bonds, so loans and private debt. I'm not really one for compliance or being excited about compliance and KYC. I'm a very traditional finance background, and these processes are really important. But that the kind of processes, so it's actually quite exciting to hear about the KYC automation and the credentials, non-fungible, non-transferable credentials, because this is a really important part of the journey and the way we structure our business, but it's a real pain point for us, and a really great innovation in the Web3 space that could solve a lot of challenges that's complementary to some of the challenges we're trying to solve as well. So a bit about us, a bit about me and the team, what we're doing and where we're going. So, does work? Is that working? 1 second. So a bit about me then. I know me. So Adam, I have a 20-year background working on some of the biggest trading floors all around the world, here in New York, London and Singapore. I used to run HSBC's treasury risk systems, so sort of $3 trillion worth of instruments through the systems that I ran. And most recently at DBS, which has been the best bank in the world for the last 4 years. I ran their bank-wide data and AI technology department. And really technologists at heart with a financial services and trading background, and grouped together with some of our other co-founders who have very, very similar backgrounds, slightly different skill sets, but really passionate about bringing technology to solve real-world problems. And I think Lisa talked to it again about real-world problems, real-world assets. This is the way of the future. Some of the early wave of the novelties is panning out, but it's really about the application of this to solve real problems and bring value to the sector. So that's what we're doing, bringing blockchain technology to solve kind of two angles of the problem. One is access to digital assets for anyone, but particularly around sophisticated, high net worth, but not institutional clients of really large institutional organizations get access to digital assets. So if you think about the retail space, pretty easy for anyone to go get an account, and maybe for an insto with one of the big guys, they've got to do their own thing. But everyone else, it can be pretty hard. And we're in a high tax region, superannuation, corporate structures, all this sort of stuff. It's really, really hard for those entities to get access to the market in a way that is trusted. We've seen lots of banks fall over. Recently, exchanges and so on hitting really classic problems that have been solved or lessons were learned 15 years ago through the GFC, but people have very short-term memories. So the way we structure our business is applying a prudential model to digital assets and operate it like a well-structured, bankrupt, remote trading business that can bring on clients and give them access in a way that they're familiar with. The second angle is the real-world asset stuff. So it's access to digital assets, and then also bringing onto blockchain and the digital asset space real-world assets. Things like, as you mentioned, art, wine, movies, all these things can be tokenized, essentially, just applying technology to make it easier for people to access these investments and asset classes. And we have a large book of private debt, a couple of $1 billion in the pipeline to bring on the blockchain. So Lisa's vision of, she mentioned before, about everything's going to be tokenized. We're huge believers of that as well. That's what we're doing, and we already have a pipeline of private debt deals. There are other people doing private equity. That's their niche. We've partnered with private debt guys as sort of our first place to start. I know I haven't looked at any slides. I think it's working now. To sum that up, bringing Web3 to the masses, so actually doing this Web5 thing that Lisa's talking about, sort of new term to me, but Web2 plus Web3 make Web5 make sense. We kind of call it 2.5, but same thing. So bringing the two prongs, bringing wealth and traditional investment processes to allow people to add digital assets to their portfolio, and secondly bringing traditional assets into the digital space. I'm probably a little bit behind because I think we're sort of running over from before, but the why Web3, I think Lisa probably covered a fair bit of that, but ownership of your data, simplification of processes, fractionalizing things that are currently impenetrable markets. And the markets are huge and only growing. And I think the key difference is it's going to flourish where there's a real use case, a real value to it. Some digital assets will have real value because they're part of an ecosystem, and you can use that to play on the ecosystem, like Ether, to run on the network. And same with us, we're applying technology to massively simplify and streamline the processes around asset life cycles. So things like loan registry on paper. Lisa was talking about it as well, around the process to have a paper document and doing a digital representation of that, making sure they're real world and legally binding, and the key of having a provable legally binding contract to the real world asset is a key thing we're solving for. And that's where we bring value. So that in the real world at the moment may cost mid-size fund managers or deal originators millions of dollars a year to have that registry in custody. doing all that on blockchain and having a marketplace for that exponentially reduces those costs and gives us an opportunity, and that's where we're building our business. So kind of covered it, the two main prongs of digital asset access and bringing real-world assets onto the blockchain. We've also talked a little bit about some of the processes you need to have around that to do that. We think about that in 5 pillars for us. Targeting institutional space, all the tools and processes around having an institutional grade platform that people are used to for sophisticated corporate trust investors. Advisor tools, so essentially looking at the advisor network, because most people in the high net worth sophisticated space will go through an intermediary or platform to invest. Some will be more hands-on and do it directly, but obviously a lot of, I think about half the market or a couple of trillion in Australia is under advice or administration. So having sort of tools for the B2B2C model, where we provide the platform to other companies that don't have the technology or expertise to then be able to offer digital assets to their customers. Trading, obviously, to give market access involves trading. So we have a core platform and it's largely aggregated brokerage. So we're not taking on, we've intentionally structured to avoid the collapse scenarios that you've seen recently with a lot of exchanges, where we are brokering, everything's one-to-one backed with assets. We have bankruptcy, remote custody. We don't trade the assets on behalf, on our balance sheet as if they're ours. They're fully client assets, bankruptcy remote, and collateralized, and things like on-ramp, off-ramp. And having on-ramp, off-ramp gives us things like FX and payments, obviously, and we're actually seeing a lot of secondary deal flow through facilitating FX for a lot of clients. As I mentioned before, tokenization has always been our North Star, and really where we're looking to ramp up and use the investment that we're raising for now to grow out that platform. As I mentioned, we've already got quite a significant pipeline of deals to put on the blockchain, and an exponentially cheaper model to offer a lot of the incumbent fund managers and originators. Target market, I think hopefully it's relatively obvious. There's a middle market, so it's not necessarily the big institutions we're trying to replace or offer services for. They'll do their own thing in their own time. The NABs or the Goldman Sachs or the JP Morgans, these guys have got their own roadmaps, and actually they're doing the same thing, and that's good for the ecosystem. The retail side is not really where we're going after either. It's quite saturated, and not really sort of interested in these sort of products. But everyone else has a huge belt, and it's pretty much more than half the market in Australia alone. A couple of trillion in this space for wealth, many times that in terms of the assets that are going into the space. So people that need institutional grade but don't have the tech or the processes to offer that to their clients, we can white label that, provide access, or do the tokenization as a service, or direct to companies that need corporate trading and so on. Kind of covered that. And in the interest of time, I'll probably skip this a little bit, but essentially the nub of it is we are a B2B2C largely, where we're providing infrastructure and all the processes to other businesses that have their own clients. So we're not going direct to retail. And a lot of the businesses that have clients, be it through an advisor group or sophisticated investors as a private equity fund or VC or whatever, will not have the technology or the time or money to build all these rails. So if you think you're a mid-tier VC or advisor, how can you offer crypto to your clients? Well, you go and tell them to go away and go to an exchange or something and do it themselves. Or you can build it, or we will essentially be able to provide that as a service to you, which is something that we do for Wholesale Investor. That's how we got involved with this event, and Steve, essentially providing our platform to Wholesale Investor clients, because obviously it's not their core business to build a platform themselves. So we provide the rails, and it's a very, very easy way to keep sticky clients within that B2B to C framework. Again, a key thing I mentioned before is we have built our business ground up to do it right, which has been proved right with a lot of the collapses and so on we've seen recently. Everything's bankrupt remote. We don't rehypothecate, we don't leverage. Everyone's KYC'd. We clear off exchanges, settle off exchanges into a custodian, so we have no counterparty risk either. And the key of our fundraise this round is tokenization. And I think we all believe this is a huge part of the future. And in some ways, it's just application of technology to solve a problem. And being a technologist, that's actually quite exciting. What that means for the customer, though, is that it makes it easier, more secure, provable. All the kind of promises of blockchain and Web3 is what we're trying to enable. So decouple that from crypto. And what we're really doing here is applying technology to bring real-world assets into a much lower friction environment to be able to issue, trade, transfer, prove, and so on for real-world assets. And we're starting with debt, and what that means is we partner with essentially one of our seed investors, Aura Group, who has a multi-billion-dollar debt portfolio. And bringing all that onto the blockchain in provable, secure, and immutable processes that will allow them to massively cut costs for all of their registry and custody, and also open this up to trading and innovation around market making and so on. So some really exciting opportunities for us. What we're trying to do, we've already got a reasonably good traction client base with in the realms of sort of access to $15 billion of investable assets with the likes of IPS, Aura Group, Wholesale Investor, and partnership with DigitalX and Lisa talking before. The team mentioned we're a pretty traditional background, so we've structured this whole business to do things right in a prudential way. And I'm being kind of given the warning sign, but we're here. Come and have a chat to us if this is of interest to you. We're obviously doing a fundraise, which is why we're here to present. Thank you.
Amazing. Thank you so much for your amazing presentation, Adam. It was great to hear from you. Next up, we have another great speaker, Brett Andersby, co-founder and CEO at DComm.
So clicker to the right to move the slides? Yes. All right, excellent. Thanks very much. I'm Brett Andersby. I'm from DComm. I couldn't have had two better lead-in speakers before mine than Lisa and Adam. For me, it's very interesting to see people from very, if you like, traditional backgrounds or traditional business backgrounds talking about and entering into the blockchain. So, okay, what is DComm? DComm stands for Decentralised Communities. So what are we? We're a layer one blockchain. So we've built our own blockchain. And our mission is to become the premier open source blockchain protocol for tokenisation of assets. I'll get into that in a minute. And our strategy is, and we've all been involved in businesses before or blockchain projects before where there was a lot of talk and then people invested, and then not a lot happened after that. We wanted to go about that the other way, and so we started from doing things first, and then we've been talking about them. And I'll get into that in a little bit. All right, so why asset tokenisation? Again, I couldn't have asked for a better lead-in than Lisa and Adam. I think why asset tokenisation, why we felt that that was the sector that we wish to be in. I think they've covered it. I think in the future, I'm going to put Adam and Lisa's name on here about why we should be doing it. But there's some traditional businesses now that are talking about asset tokenisation as being the next big thing. So the next thing where blockchain and traditional business intersect for all the reasons that Lisa and Adam explained of the efficiency of it. So why did we build a layer 1 blockchain? Because that's the question we get asked. Does the world need another layer 1 blockchain? What we decided was, or what we found was, that there wasn't a blockchain specifically designed for asset tokenisation. Nobody started out with that to be their focus at the very start. And then I'm just going to get on to the technology itself. The reason we decided that we did need to do that was over time, and as again Adam and Lisa said, it's a very complex transaction, tokenisation on a blockchain versus a very simple thing like an NFT, just transferring between wallets. And for that, eventually there'll be a congestion, there'll be a lot of transactions happening on the network. And if it's not set up correctly, we thought that over time what would happen is we couldn't predict what those transaction costs were going to be. So we designed a blockchain so that in the future we could have certainty as to those transaction costs, because there'd be no point in having a tokenisation where you were paying out an 8 or 10% yield on an asset and finding that 3 or 4% of that was taken up in actual transaction costs. So that's why we decided to build our own blockchain. The other part that we've already done as well is, Lisa alluded to the decentralised IDs. All of those tokenisation events are going to require a lot of extra components to make them work. And we've already started to build some of those out. These are in beta phase, most of these. And what that means is, an analogy I suppose is 20 years ago when you wanted to build a software solution, you had to go and build your own database, you had to build your own payment gateway. And then what happened is you had software as a service, and so Stripe came and built a payment gateway, AWS have database services, and so developers were able to pull those off the shelf and go build the applications quicker and cheaper. And that's kind of the component layer that we're building out so that people can basically tokenise their things more quickly, or people can build platforms for tokenisation. Okay, something we're doing that's really different, and I'm only going to spend a very short bit of time on this part, is we've also got an infrastructure part of our business. So we're in our overall strategy to do some things first and then talk about them. We actually have invested into some assets themselves. So we've got a solar farm that we've just purchased some land for in Collie, south of Perth. And we've just bought some the assets, some modular data centre assets off an ASX listed company. And then the reason for doing that was we wanted to proof of concept, so we wanted to go and tokenise some assets. Now, there's a lot of work to do to get to the point where those things are tokenised, but we wanted to show how it can be done by tokenising assets that we had developed ourselves. Obviously, there's the adoption of the blockchain, the utility, the transactions that go onto the blockchain itself. Those revenues that come off those projects will also help support the blockchain itself with actual revenues. And again, we just wanted to do this stuff first and then talk about it. All right. Who's behind DComm? I'm not going to run through the whole team, just a couple of notable people in there, and I don't put myself in that category. Two people who are very important, one in building out the community that we will require to be successful, and the other one is the technology. So one of those is David Haslop. David Haslop's the owner and founder of the Australian Crypto Convention, which was held in September. They had about 3,000 people. And the next crypto convention will be in November. That'll be in Melbourne, and it'll have 15,000 people. OKX have signed up as a premier sponsor. So David's one of our founders, and one of the key tech founders is Dr. Ravi Chimera. So Dr. Ravi has a DevOps platform called Zeev, and Dr. Ravi and Zeev are founders of DComm. So when we were building out the technology, we had about a team of 25 developers building that out. We have the ability that when we're building out specific tokenisation projects or things within the blockchain, 2 minutes left. got a sign up there. With all that digital, you wrote it on a piece of paper. Cool. So we've had the ability. So I'm going to run through what we've achieved today, because I said at the start, we like to talk about what we've done, and then I will talk about what we want to do. So we've built a layer 1 blockchain. We deployed a testnet, a public testnet in September. Now, we did all of that and funded it ourselves. That public testnet had a decentralised 70 independent validators. We've also deployed a second testnet which will be used for future education and development so that we can educate the next generation of web developers. We launched a mainnet, again decentralised, with independent validators in February. That component layer is being built out. It's in beta phase. We've purchased a couple of solar farm and a modular data centre, and we already have a number of partnerships in place, including Zeev, CryptoDen, and some of those listed there. Okay, what comes next? I won't go into these, but obviously to get to the next stage of where we needed to be, we do require the capital to get out there. It's not much point in having a great piece of technology without anybody being able to know about it. So building the community, getting out into the global marketplace and building partnerships with other people who wish to build platforms is our focus. And really, we think that the tokenisation and putting on chain the ownership and the peer-to-peer transfer, and particularly the digital IDs, will be the next big efficiency in global markets, and we think blockchain is well positioned, and that's what we're trying to do. We're basically trying to be an enablement platform for asset tokenisation. Thanks very much.
Thank you for your presentation, Brad. That was great. Next up, we have Phil Williams, founder at Make Good Give Back, coming up on the stage.
Thanks, Rhythm. Hello, thank you for your time today. Welcome. I've heard a lot about technology. We're a Web 5 company, very early stage. But there's got to be a reason for all this tech. We love the tech. There's got to be a reason, so I want to share that with you today and what it means for each of us and some important people going forward. So thank you for your time. Make Good Give Back is our intent. Our reason for doing all this is our purpose, which is your data for good. You've heard a lot about data. So what I want to do is share with you what's important about that from our point of view. Let's see if I can get the slides working. So I want to share with you today in 4 easy steps how you can get hold of your data, maybe become a little smarter with it, certainly get paid for it, and then also maybe a little bit more sexy with it and give back to charity if that means something to you. But really what I want to do is talk about something that's perhaps a little bit more useful for you as an investor, is that in those same 4 simple steps, you could help a company along, but also you could help Janie improve her financial well-being, her health, wealth and happiness, and get paid for doing that. So who's Janie, I hear you asking? Well, she's our MVP. No, she's not your next AI chatbot. She's a real person. She's our most valuable person. And you probably know her very well. She's probably been your mum, or she might be your sister, she might be your daughter, she might be your wife or your partner. And every day of her life, today and tomorrow and the rest of her life, she's going to be doing these things. And for her, financial well-being, her sense of that is to be secure, it's to be resilient, is to be getting on with life and to be in control. So we want to talk to you about why Janie is so important to you and to me and to everybody else. Well, she's 1 in a million. She's the financially squeezed mum. What you probably don't know about her, though, is that she's real smart. She's 25 to 34, married, kids, mortgage, job. She's an early adopter. She manages the family finances, and that's how she takes care of the financial well-being of her family. But what you probably don't know is that in being squeezed, she's not in crisis. She'll tell you that she feels stalled by money. And you might be wondering why she's 1 in a million. Well, in the UK, she is one of 920,000 such mums. And in Australia, we estimate she's one of 300,000. There's a lot of Janies around. She's an unsung hero. She's actually key to unlocking financial well-being for everybody. But she's the least understood person in the national financial well-being strategies that every Northern Hemisphere country has. Australia has one too. We want to get it started. It's dormant. We want you to help us do that. We want to get the UK National Financial Wellbeing Strategy up and running. It's the leading national program at the moment, but it cannot execute at scale. Ask me about how we can help that. But if you're wondering why she's the key to unlocking financial wellbeing for everyone else, then just look at some of the numbers. She's one of 3 million young couples and small households that are squeezed. There are 23 million people in the UK, probably about 8 million here, in the same boat. And if you think that's probably a hard stretch, 9 million people in the UK and about 3 million here are actually struggling to pay food bills every week and use credit cards and hit this vicious cycle. It is our main use case. This is what we want to start with. So, what's the problem here? What are we trying to solve? We want to implement these national strategies, but let's break it down into two simpler problems. First of all, Janie's doing these things every day, flying blind. It's her digital life. And that data's going to waste. But somebody else knows about what she's doing, where she's based, her demographics, and what she's buying. But none of that is coming back to Janie. So in fact, it's all going to third-party data sources, cookies, you name it, and that's a big business. Because the second problem is that data's got to go somewhere, and we all know where it goes. It goes to help large companies sell us products and do stuff. And they spend about $20 billion in the US alone each year on third-party data. That's a lot of money. And then if you add core first-party data, which is, I'm a customer, I'm an employee, all those data that goes into the systems, that's $100 billion. But they're spending $900 million, in other words, over $1 trillion a year on this data, but they still don't know who she is. So we want to help with that. One of the ways to help with that is to help companies generate a business case. So what we're saying is that if you know Janie, you know your employees, you know your customers. What's missing from this slide, unfortunately, is that this is a great opportunity to invest right now. You probably missed the train on where financial well-being kicked off, which is employee well-being. Fully support that. But it's about selling financial services to Janie. We're not about financial services. We're about her data, helping her improve her financial well-being. We're the next train off the platform, and we'd like you to get to know us a little bit better. This is how we're tackling it. 3 core stakeholders, big companies, Janie, and 500 million others, and impact groups that are key to making sure that any system-wide change is embedded and then it's beneficial for everybody involved. So we'll help Janie get hold of her data, help her get paid, help her improve her financial well-being, make it work for her. But we'll help companies with that business case take that data and reward Janie for what it's really worth. Which is what? Well, lowball figures. $100 from each company every year to Janie. 100 companies, $10,000 a year. Not chicken feed, not cents, 10K. What do we make? 11.5 million maybe out of that. Instead of Janie? No, we don't make that from Janie. Companies pay to access the system. We're looking to get 20 million Janies, and we're looking to get as many companies as you can think. Has the team got the capability to do it? Well, we need your help, but we've got 4 people who are pretty experienced. We get the technology, we get the companies, and we're pretty driven. So what we want you to do is just buy a ticket. $100 each, 10,000 units, backed by a safe, rolling close, let's get started. The money will help Janie, and this is how we'll spend it. Thank you very much.
Thank you for your presentation. Next up, we have Theodore Stone, Director at YupHome.
Firstly, thank you for the previous speakers. It appears I've got very big shoes to fill. All great presentations. Hi, everybody. My name is Theo. I'm an engineer by trade, property developer by profession, and I'm currently the Director of Business Development and part of the executive team at YupHome. Don't mind these AI-generated images. It hasn't quite perfected getting my face right just yet. As an engineer, I love numbers. So let's start with some interesting ones. Every year there are on average 500,000 property residential transactions. Further to that, there is over 200,000 brand new property sales per year, rounding up a 150 billion a year industry in annual market capitalisation. Our supply must meet this demand in order to alleviate affordability, which currently we definitely are not, but most importantly, to house the people that live in this great country of ours. As Aussies, we are absolutely nuts about property, and over 75% of Aussies are homeowners. To service this demand, we currently have well over 5,000 active property developers in this country and over 50,000 real estate agencies. So who is YupHome? YupHome is a PropTech company focused on revolutionising the property industry, starting with the off-the-plan or brand new home segment. YupHome has a double-engine system that powers its platform. On one hand, we have a SaaS platform to service our B-side clients. These are property developers and real estate agencies. On the other hand, we also have a Web3 component to service the end customers purchasing the property, our C-side clients. For our B-side clients, we facilitate the environment and create the digital infrastructure for property developers, real estate agents, and end customers to interact seamlessly with one another, and we form the connection between these three parties. For our C-side clients, we are building a community around real estate and projects. Through building a community and adding a social component to projects, along with the incorporation of blockchain and other Web3 technology, we will create transparency, which will ultimately create trust. These two engines work together to create our innovative B2B2C approach. The problems for each of our clients are quite unique, yet quite simple. The developer has a sales problem, but they also do not understand their customers' needs. The developer's mantra is if you build it, they will come. The agents require resources, both properties to sell and customers to sell to, and need to provide their client with a better service in this new digital age. End customers ultimately want convenience, value, transparency, and most importantly, trust. Property is likely the largest investment most people will undertake in their lives, so trust is an important part of the transaction cycle. However, I can tell you that most people here don't trust developers or real estate agents. So why haven't these problems been solved yet? There's two main reasons, really. One, the digital infrastructure needs to be there first to be able to solve this problem. 5G, unique tech solutions, and an amalgamation of various technology need to work symbiotically together. Second is timing and adoption. A post-COVID world has accelerated digital adoption, which in turn has made more traditionally based industries and businesses more receptive to using the power of tech, and it has changed the way people view and purchase things, and property is no exception. So what's our solution? Our amalgamation of Web 2 and Web 3 technologies and services will solve these problems for our clients, whilst at the same time exposing them to a new ecosystem built on Web 2 and Web 3 tech. Our digital infrastructure, or software as a service that we've created, helps developers sell more stock at volume by connecting them to a large volume of the right agencies, or connecting them directly to the customers with the power of AI. We also provide digital marketing solutions such as augmented and virtual reality to both developers and agencies to empower them to sell their stock to their clients more efficiently and in a new digital environment. Imagine having a platform that can market your project in a completely digital format, create a digital and immersive replica of your product, then connect you to the right agencies to help sell your stock at speed and at volume, and have the infrastructure ready for your clients to view, sign, and pay everything all in one place. This is the power of our platform. We also utilize the power of blockchain to provide more transparency and in turn more trust between all parties, and to reconceptualize the idea of communities around property and projects. Imagine being able to interact with developers and agents directly in one platform and finding the answers to all of your questions from the horse's mouth, whilst also joining a community of others also invested or interested in the same project as you to share comments, thoughts, and ideas. This is the power of YepHome. Here is a small snippet of what the community component looks like on our platform. So 2023 has been a big year for us. We've launched our MVP and are starting our marketing to our business and end customers. Traction is building, and in the last 12 months, we've added over 200 developers' projects onto our platform, have launched a new results-focused service last month, which has been received very well by developers, and have signed up a number of developers for our VR and AR packages to help market their projects in a new way. On the customer side, we've had over 214,000 visits to our platform since February this year, with the addition of 84,500 users and almost 7,500 posts from people who have joined communities we created for the buildings that they live in. So we are seeking to raise $5 million in capital to fund our vision of revolutionising the real estate sector. We will start with the brand new home segment, to which our competitors are sparse and our platform already advanced. The opportunity for investors is to be involved in a company that will reshape how real estate is transacted, not only in Australia, but around the world. We have scalability built into our business model, as the processes required for selling property through a B2B2C ecosystem are ubiquitous worldwide in most developed countries. So the digital revolution is now upon us, and only now are we starting to see the positive implications this will have on our industry. We are at the forefront of the wave and pioneering the inclusion of advanced Web 2 and Web 3 technology to bring about a digital disruption in our otherwise still traditional real estate industry. We want you to be part of the change. We want you to be part of the movement. Thank you.
Thank you, Theodore, for that great presentation. Next up, we have Peter Smythe, who's the founder and managing director at Hound Group. He'll be coming to the stage shortly for his presentation.
Morning, everyone. I'm just watching the clock. I've got 2 watches on so that I can manage the time carefully. My subject is Hound and my time begins now. So let me tell you, there's nothing else around like Hound. What is Hound? Hound is a game changer. It's a game changer for the mortgage broking industry and for Australia's army of hard-pressed home loan borrowers. Why is it a game changer? Well, because it transforms the way that brokers work with their customers, and importantly, it puts borrowers back in control of their home loans. This goes a little bit to what you were just saying about YepHome. So let me talk a bit more about that. Why is this important? It's important because home mortgage lending is second only to super as our biggest personal financial services market. Brokers settle 2/3 of all new mortgages these days, and they manage almost half of the existing ones. But they aren't equipped to provide effective after-sales service. So customers don't know if their mortgages are still in their best interests or if they're paying too much. So what this means is the industry doesn't really work very well for existing borrowers. But it also doesn't work very well for brokers either, because all that unmet servicing need means that the runoff amongst their existing customers is very high, usually in excess of 20% per annum. Who does the industry work well for then, you might well ask? Well, of course, it works well for big lenders. Of course it does. Their largest source of profit, as you would know, is lending on home mortgages. That's why they're sometimes referred to as building societies on steroids. Their business model is to attract new borrowers with loss leader offers, and then they rely on inertia and a lack of transparency to gradually crank the rates up, so that what happens is existing borrowers end up paying more for the same loan that a new borrower just recently attracted pays for that same loan. That is crazy. That makes no sense. And Hound changes all this. So how are we doing that? Why do I say it's a game changer? Well, in a nutshell, we are solving the industry's data problems. Today's industry is fragmented, it's out of date, it's incomplete, it's basically incorrect. And more importantly, it's structured around transactions, it's not structured around individuals. What we want is data structured around borrowers as people, and that's not how it's set up at the moment. So no one has the full picture, not the lenders, they know about transactions, not the aggregators, they're the middleware, and not the brokers themselves because they don't have the data. So without this, everyone just concentrates on finding new loans and settling those, and the cycle continues. But Hound changes all this. So how do we do this? Well, Hound equips borrowers for the first time to be trusted advisors to their customers. And we do this by creating and maintaining an up-to-date database of those customers. We do it by identifying the customers with unmet servicing needs and surfacing them to the broker's attention. We actually do some of that servicing work ourselves on the broker's behalf, and we build a track record to support what the broker has done so that when the broker comes to sell their business in the future, they've got an auditable, credible track record of what they've done with their customer base. Now, that might sound amazing, but of course, why is it not possible today? It should be, but it's not. What makes it possible is the way we're solving the industry's data problems. So the way to think about Hound is it's not just essential tools for brokers, which are important enough on its own for their business, but it's actually a data business, and it sits at the centre of the industry, and it's going to, as you would know, data is sometimes described as the new oil. So if you've got data, you've got the oil, and that's the role that Hound plays in the industry. What's the result? Well, quite simply, brokers using Hound are able to retain customers they'd otherwise lose to competitors, as simple as that. So their business grows, it's more profitable, it's more valuable, particularly when they want to sell out and exit the industry. So Hound pays for itself many times over. What's the alternative? Well, without Hound, a broker's business typically falls into the no-growth trap, sometimes called the hamster wheel. Existing customers are leaking out the back door while you're busy trying to bring new customers in the front door. And that's no way to build a business, I'm sure you'd agree, and it's certainly no way to create value that you can sell. So Hound changes all that. Where does Hound have the greatest traction? Well, we're focused on the most productive, professional, tech-oriented segment of the full-time broker population, estimated at about 12,000. Typically, these are brokers who are building a professional practice. They're working in it now. They're not sole operators. They're acquiring portfolios for growth, and they've got admin staff, and they've got a long runway in the business. So they're a professional component of the business. Our first phase objective, described here, is based on our standard platform pricing, which is just $1 per loan per month. So that's like a utility cost, if you like. And that's why we sometimes talk about Hound as the new utility for the industry. Our first phase objective will generate around 12 million annual revenue, plus we intend to build out a selection of special use cases with large operations such as orphan books, mortgage managers, and indeed lenders themselves. So where's the evidence that this works? Well, we proved the concept with a book of over 2,000 Yellow Brick Road orphan customers over the course of last year. These had been largely unserviced for many, many years, and the data was in poor shape. But we took that data, we curated it, we updated it, and we've then interrogated that data on a regular basis to identify the action required customers. And these are the ones that have been contacted. And remarkably, for people who hadn't been contacted for years, a third of them said, yes, yes, please, I'd like a review. I'd like to speak to someone about my mortgage. So that proved it works. Now we've moved on to the active broker networks that Yellow Brick Road controls, where the customer data is a lot fresher, where there are brokers and admins who can then follow up actively. And what's more, we're also lining up a whole bunch of other aggregators to bring Hound to their brokers, and we're developing some of those large special use cases I referred to earlier. So, where do we go from here? Well, this is something of a map which shows you our key strategic priorities over the next 2 years, but essentially they are to deliver on 3 fronts. One is technology and data, where we've got to develop and deliver at pace. The second one is commercial. We've got to get Hound into the hands of the industry. It's as simple as that. And the third one is financial. We've got to raise money to do that, and then we've got to pay back returns to investors for their confidence in us. We intend, as you can see towards the end of the map there, to put ourselves in play as the industry rationalises and consolidates. And of course, our key position in that is that data is the new oil. Who's going to do all this? The mortgage broking industry has always been a traditional relationship-based industry. So it's all about both what you know and who you know. So it's essential to be an insider if you're going to try and get into this industry, and that's why Hound's team is made up of a bunch of industry luminaries and technology and data experts who've lived their lives in the mortgage broking industry, and they seriously speak fluent broker. So that's how we approach the market. What are we looking for today? Our current Series B round has already raised 1.35 million. There's room for about another 400,000 before we'll close that. And that'll take the issued capital a bit over 4 million. And then we'll be planning one final round for growth capital later this year. So this is pretty much your last chance to get into Hound before we're off to the races. And that, ladies and gentlemen, is Hound in 8 minutes or less.
Thank you so much, Peter, for that amazing presentation about Hound, and we really appreciate the work you and your team are doing. So everyone, we are just going to have a quick 10-minute break, so feel free to get some coffee and just refresh yourself with some water. But come right back around 10:50 because we have a great speaker, Daniel Whitbits, founding partner of Backbone Partners, and he's going to be speaking about his experience working across 20 sectors in 9 countries, and he'll be sharing some valuable insights. So be right back in 10 minutes, and I'll see you guys shortly. Thank you. Thank you everyone for being here. The presentations will begin shortly. Just give us another 3 to 4 minutes. Thank you. Amazing. Thank you so much everyone for coming back. I hope you were able to refresh yourself with some coffee and some water. It's time for our next keynote session and I'm excited to introduce our speaker, Daniel Bibbitts, founding partner of Backbone Partners. With experience investing in over 50 early stage ventures across 20 sectors and 9 countries, Daniel will be sharing some valuable insights on successes, surprises, and errors in investing. So without further delay, let's welcome our keynote speaker to the stage. Over to you, Daniel.
Thank you very much. Good morning, everyone. Firstly, a huge shout out to Wholesale Investor for putting on this amazing event. There's a lot of high caliber speakers over the next 2 days, and I encourage you all to participate as much as possible. If you know, the fun fact is that in Australia, VC investment per capita is about 20% of that in the US and about 10% of that in Singapore, which is world leading. We can and we should be doing more in the VC and early stage investment space. As mentioned, my name's Daniel Vatesplit. I'm the founding partner of Backbone Partners. And Backbone Partners has been set up to invest in, empower and actively support immigrant founders. Why? Because we believe immigrants have the hustle, resilience and persistence to solve globally meaningful problems and scale ventures globally. Did you know that 55% of unicorns in the US are started by a first-generation immigrant founder? In the UK, that stat is 65%. A little bit about me. As mentioned, I've been investing in the early stage space now for the last 7 years. Prior to that, with a background in investment banking, funds management, and as a co-founder of a fintech. I've reviewed over 7,000 opportunities in that time and invested in over 50 companies across 20 sectors and 9 countries. Which brings me to the topic of today, effectively lessons learned over those 50 investments. Now, when you start in the startup and early stage world, it can be a pretty dark space. And you go in and you ask for advice, and the advice you'll often get is invest in founders. Invest in an A-grade founding team and maybe a B-grade business versus a B-grade founding team versus with an A-grade business. Why? Because founders are critical. But that doesn't really give you enough, right? Everyone thinks they're an A-grade founder. And so we think, and I think the most important quality in founders is resilience. And I suggest looking at this. So what is resilience? Resilience is the ability to adapt and overcome adversity. Why? Because the startup journey is seldom linear. There are always challenges and obstacles to overcome, and I'd rather be backing a founder who's not learning about resilience while overcoming these obstacles. I'll give you a couple of examples. Justin Liang from InSpace. Justin left corporate Australia because, as he puts it, he was sick of being under the bamboo ceiling and he wanted to build a house of his own. So he started InSpace with a bit of a chip on his shoulder. He started the business as a VR product for architects. Early on in the journey, Justin's co-founder left to pursue his dream job at a gaming developer. And as COVID was hitting in 2020, or just before in 2019, InSpace was struggling to find product market fit. Most founders would have and could have given up. Justin saw an opportunity to pivot using the technology already built to build a digital twin as a service company. Since 2020, Justin has raised 4 rounds of equity financing from well-known VCs in Australia and has customers in Australia, Asia, and the US, where Justin now resides. Another great example, Phil Turner. Phil came to Australia from regional Austria, and his first job, he wanted to work in a large building to prove to his parents that he could make it in the big city, having moved. He worked at a law firm in the Citigroup building here in Sydney. He started at the bottom and he was an IT help desk assistant. He automated a bunch of tasks for that legal firm and years later founded Nexel to be a legal tech company, effectively LinkedIn for lawyers. Similar story to InSpace. Nexel didn't find product market fit and were very, very short on cash runway. just before COVID. So what did Phil do? He didn't give up, he pivoted. And he used the technology that Nexel had built in-house as a CRM to reach out to legal firms, which were his customer, and offered this technology to the legal firms themselves to build relationships. And if you're a keen reader in the financial press, you would have noted that Phil and Nexel raised a pretty substantial round about 2 weeks ago. That resilience helped Phil survive and thrive, and he didn't give up, and now he's in a position to take on that next chapter of growth. So when you're looking at founders, invest in resilience. What's the next thing that matters? Well, the picture might give it away. I don't think it's financial models, not at the very, very early stage. Financial models are full of unvalidated, unverified assumptions. And you can't be trusted, and they're wildly optimistic. You want founders who are optimistic, but I wouldn't pay too much attention to those models. So what matters? Moats. What is a moat? It's something within your business that helps you defend against the competition to give you a significant advantage. Now, moats can come in all different shapes and sizes. I don't believe marketing is no longer is a moat anymore. You can now buy marketing expertise. Equally, technology is not a moat in many cases. You can now buy technology, whether that's underlying platforms or whether that's the people to build all sorts of technology. So you need to look elsewhere for moats. One particular advantage I've seen multiple times is a founder knowing the customer base so well that they can get an early advantage. Great example, Monetis Seafood Market. Peter Monetis and the Monetis family have been in the seafood space for multiple generations. Their name is well known in that market. It's a niche, but it's a massive niche globally. And Peter built SureTrade, a platform that connects the fisherman to the wholesaler digitally versus an auction clearinghouse that happens physically in the morning. The moat that Peter had was he was able to get over 100 suppliers and over 1,000 buyers on the platform day one. There's not many people in this room and online who could go to a fishing wharf and get a fisherman to sign up to a tech platform. That was Peter's moat, and Peter and the business have since gone on to raise multiple rounds of funding and are now trading globally. Another moat I've seen, which is rare, but is invention. So when you're actually inventing something completely new. Great case in point, Quantum Brilliance, based in Canberra. 2 PhDs as founders, had complementary PhDs that worked on the properties of diamonds to build room temperature quantum computing in the size of a lunchbox. You're not going to see invention very often, but if you do see it, there's a formula there for outsized returns if it goes right. Another moat, industry experience. Applied EV down in Melbourne creates autonomous electric vehicles. The founder had 19 years experience at GM and knew the automobile industry back to front. But he actually also had the foresight to know that the next wave of autonomous electric vehicles wouldn't be built by just building a car better. So the first 30 people he hired were all tech, hardware, software developers, and he and one other person had automobile experience. He redesigned the paradigm for creating an autonomous electric vehicle by creating effectively a skateboard base that was powered on software and built with hardware, and that you could click in, effectively like an iPhone app, any sort of top onto it. But he's redefined autonomous electric vehicles because of his extensive experience in the industry. And then the last moat that I've seen is a hidden piece of technology that powers amazing customer experience and user experience. Really well-known example, Google. It was their search algorithm that created an amazing search experience for the end user. We had search before, Alta Vista, Yahoo, Ask Jeeves, But why did Google succeed? Because their search algorithm was so much better that it created this unique customer experience. A local example, Gigspace, which creates 3D files and converts regular CAD files into what's called a .gig format, their own format, and creates a seamless way to both create and view 3D presentations, effectively 3D PowerPoint. Now, the uniqueness, the user experience has even been recognised by Apple, and Tim Cook presented Gigspace 2 years ago at an Apple launch event. So after Founders, the one thing I'd urge you all to look at is for the moat. And when we talk about surprises, the one thing I've found over the last 7 years is beware of tailwinds. It's not a case of a rising tide will lift all boats. The common topic today, and the thing you'll probably hear a lot of over the next 2 days and maybe over the next few months, large language models, ChatGPT. But who owns the underlying technology? OpenAI, Microsoft, Google, other large companies. When you see an early stage company pitching a derivative of a large language model, ask yourself, what is their actual moat if they don't own the underlying tech? Equally, there are huge tailwinds behind sustainability, climate change, and mental health. And there are hugely important problems to be solving in these spaces. The issue is there's a lot of attention on these spaces and there's a lot of founders building in these spaces. So again, it's really important to ask yourselves, do these founders have resilience and what is their moat? How are they going to compete in a sector where there's a lot of attention and mainly common problems to be solved? How are they going to sway customers? As a great example, how many people in the room remember crypto? A few people are smiling. There were hundreds of businesses pitched over the last 2 or 3 years, and now that volume has been dialed down. But the best businesses in crypto have survived and thrived. But it wasn't a case of a rising tide lifting all boats in that space. So beware of spaces that are sexy, that have tailwinds, and remember to look at the founding team and the moats that they have in particular in those spaces. And to errors, and every investor's made a few. The first that I'd suggest you having a very good look at is investing in a management team rather than a founding team. Founders are aligned to investors because the majority of their compensation should, over the long term, be via equity, not their base salary. Management teams usually are driven by base salaries and maybe a little bit of ESOP. Really question whether the founding teams or the team that you're investing in is aligned to your objectives, which generally is increasing equity value. Secondly, understand the end buyer of the technology. Not all end buyers are tech savvy. They're not all early adopters of technology. A great case in point, and this is a generalization, are doctors. Doctors are generally very wary of adopting new technology. Their number one priority, assisting patients and getting great clinical outcomes for their patients, not adopting the latest piece of tech. There are some small businesses as well that really like to adopt technology. In Australia, the great example is Xero and MYOB, getting tech out to accountants. But there are other fields of small businesses that really shy away from technology. So really understand that end buyer and whether they're going to be receptive to buying a new technology. Lastly, the direct-to-consumer business model requires a lot of capital. Anecdotally speaking, it takes $15 to $20 million to build a brand and to build customer awareness. Now, some of the biggest tech companies globally are direct-to-consumer companies. So I'm not saying don't invest in D2C. I'm saying make sure these companies are adequately capitalized to ensure that they can gain market share and gain profitability. Lastly, they say in every presentation you need to leave your audience wanting more. This is a pretty obvious statement. Australia is different as a market. We have not much less of a landmass than the US. Our population is about 1/10. Our VC investment is about 1/5. GDP is about 1/20. And the number of unicorns in Australia, 15 versus 1,200 in the US. My last piece of advice is tailor your investment strategy appropriately to the Australian market. If you'd like to know my views on this, please feel free to reach out. Thank you for your time.
Amazing. Well, thank you so much, Daniel, for that informative presentation. We really appreciate your time and efforts coming here for Emergence 2023 here today. Our next session is brought to you by one of our sponsors, Sales Director Central, and we're delighted to have JD here with us today. JD brings a wealth of knowledge and experience in the field of sales, and we are excited to hear from him. Please join me in welcoming JD to the stage for his session. Thank you.
Thank you for that. This is really good. Like, really is going to be good. I wouldn't leave. Anyway, g'day. My name is JD from Sales Director Central. Fantastic. I'm going to talk to you today fundamentally about fractional sales leadership. What is fractional sales leadership? Well, imagine, if you can for a moment, that you've got a 20-year sales veteran in your business today implementing a sales framework, creating a peak performing team, whether you're a founder-led business or you've got a sales team. That's what fractional sales leadership is. We come into your business in a very scalable, very affordable fashion, and we provide super experienced sales leaders to come in and put a framework in place. I'm going to share 3 things with you. I'm going to talk about research phase versus scale-up phase. We've identified a series of attributes based on talking to lots of different businesses. I'm going to look at some survey results from a Wholesale Investor presentation that we did, and I'm also going to share a little bit about our framework at the end. So at Sales Director Central, we love sales. We live, eat and breathe selling. Our mission is to use the power of sales to unleash the superpowers of those crazy enough, are there any crazies in here, to believe they can change the world. So that's both investors and founders and investors in founders. We do that with our no-fail promise of value, which is that we provide predictable, sustainable results. We got that from doing workshops with a series of clients, and unmistakably that was the message they gave us back. We provide predictable, scalable results. We've been able to help some of our clients double, triple and quadruple their revenue in 12 months. We've got 4 clients to exit, and we've got lots and lots of social proof that what we do works with companies looking to scale and grow. What we fundamentally do is give you what I'm going to call today the cheapest form of capital, which is customers, because most people don't have to give it back, and or the best way of allowing your capital value, your company valuation to improve as well, again by adding more customers. So what do we see in the marketplace? Lots of companies go through a phase of research. I'm going to talk about the attributes and the components of research phase. In research phase, as a founder, you've gone and seen a gap in the market, which is fantastic. You've identified the gap, researched the market and realised there's no one actually doing the thing that you're going to do. So you go about MVP, creating a product, and then you launch the product. What we see with a lot of founders is they get stuck in what we call research phase of their business. So some of the attributes of that, you become very product-centric, and I get it. You want the product to be as best as it possibly can, and you want it to be as functionally rich as you possibly can. So you want to put as much effort as you possibly can into making sure that product is as appetizable to the marketplace as it possibly can be. When you're in the product-centric mode, there's a mindset or an approach that you typically take, which is, I want to prove it. Let me show you it works. And so you're actively trying to show as many people as possible, because after all, if you show lots of people, you'll sell it, right? Hands up. If you show lots of people, you'll sell it, right? It happens a lot. In research phase, companies tend to focus on what and how much. So if you think about the pipeline in your business, if you're a founder, most of the time you know very little information about the customer. You know what you're selling and how much you're selling them. And that's what you start tracking in CRM. We then talk about race to the proposal. If I can't show it to them, they're not going to buy it. If I don't give them a proposal, they're also not going to buy it. So we actively go through giving them a proposal as quickly as we can. And I'm going to show you some research in a moment which suggests that templates are killing your business. Right? Proposal templates are killing your business. They become more and more ubiquitous as time goes on, and the information in the document becomes less and less about the customer and more about you. The challenge is when an infrequent buyer gets that document, they can't go to the business and get approval for that. Right? So how do we start to reshape that as we go through? So race to proposal is a big thing. And the big one is deals progress by gut instinct. Deals progress because Mary said I'm in good shape. I've only got one more signature. Frank said he's got the budget. And we can't have deals progressing by gut instinct. It doesn't work. We then come and work in this organisation. So lots of organisations that we work with are in that research phase and they're looking to scale and grow. The first thing we do when we get to scale up phase is we want to understand the problem they're solving. So as a founder, stop looking for a $50,000 solution, start looking for $1 million problem. Because if you can go and find $1 million problem and you can elaborate it and you can understand the importance of the organisation to sign off on that, then you're more likely to get better traction at all sorts of levels. We also go deeper in understanding the customer. Rather than let me show you the product sells itself, we get into only showing what the product needs to solve that problem. And that's all we want to show. So we're going more into a buying and helping mindset than a selling mindset. Here's the big one for me. Most clients in research phase know what and how much. If you think about your pipeline, what and how much. What they don't do is understand, we put processes in place to let you understand who's going to buy, who are all the people that are going to buy your system in a corporate environment. Most corporates, there's somewhere between 12 and 14 decision makers, people who can say no, involved in the evaluation cycle. Unfortunately, most founders and sales teams only really track 2 or 3 at best. So we want to know all those people. Once we understand all those people, we want to understand the time frame, the when, what is the evaluation cycle they're going to go through, and here's the big one. In a series of methodologies, I'm going to talk to methodologies in a moment. In 2 specific methodologies, they talk about what is the burning platform or what is the critical event. Art Jacobs wrote a methodology called target account selling, which is one of my personal favourites. And he says if there's no critical event, there's no deal. The challenge is a lot of founders have lots of deals in their pipeline where there's no critical event. They're not going to buy. They like your product, they like your price, but unless we understand the who, when and why, what the critical event is, then we're actually not in control of whether the deal's going to happen or not. So rather than race to the proposal, we start helping the buyer with, are you doing this to get a budget or do you have a budget? If you're doing it to get a budget, what does that look like internally for your organisation? How many people you need to talk to? Have you done it before? Who owns the budget for this? Or who are the budget holders for this example? So we're very much starting to help them write the business case. And the big one I mentioned already, deals move by gut instinct in research phase. In scale-up phase, we start analysing deals more structurally, and we provide rigour to whether someone's going to buy or not, or whether we're going to engage or not. So we analyse deals a lot more effectively, and we qualify out of a lot of deals. So when we typically work with a founder, at least 30% of the pipeline when we start working with them is garbage, because they like our product and they like our price. Right? In reality, and there's a couple of nodders, there's a couple of people in the room that we've done the work with, in reality, you only want to be talking to people who can make a buying decision. It's not on a slide. What's the only thing we measure in sales? Revenue. Everyone says revenue. The only thing we measure in sales is time. If you can spend more time in front of people that have to buy your product, you'll make your sales target. If you spend more time in front of people who like your product and like your price, you probably won't make your sales target. Does that make sense? We're trying to look for what are the organisations that have to make buying decisions. So we help people. If you look at the left-hand side of that slide, that's all about us, our product, our capability, our price, our proposal, and the proposal is all about us. If you look at the right-hand side, what do you notice? It's all about the customer. It's all about all the elements that a customer needs in order to get a buying decision. So it's a significant driver. We did a survey in a Wholesale Investor client base, and we saw a series of results that came back and really support the things we see in the marketplace. 35% have a specific sales plan in their business. Organisations that have that, thanks to ChatGPT, I might add, have an 80% greater correlation to sales growth. So if you have a sales plan, just by having a sales plan, you've got a better chance by 80% that you're actually going to make your sales target. And those that don't have 50% more stagnant chance, 50% have a methodology, 50% that have a methodology have a 70% chance of outperforming against their competitors. There's a survey I saw the other day that said when MedPick was implemented in a business, the conversion rate went up 311%. Right? So sales methodologies are vitally important. If you don't have one in your business, get one. If you get no other message. 50% do not do a demonstration, do not show their product in the first meeting. The correlation is ridiculously high. If you're showing your software to people in first meetings, if you're showing your stuff, you're wasting too much time. You're spending all your time understanding the customer, who, when and why that you're going to facilitate. And the last one is proposals are killing your business. 40% that don't have proposals have a greater than 55% chance of having success. When you don't have a proposal template, you start to write information that the customer needs in order to get a buying decision. And ultimately, that's all we're trying to do is find buyers. So what do? I talked about our framework. The M in the middle of PAMIS is methodology. It's a really important component. What we realised some years ago in working with well over 90 businesses is that there is 6 pillars of peak performing teams. We've been able to capture it. Planning is account plans, territory plans. It's accountability, methodology, getting the right indicators. If you either are lacking in one of these components or you don't have it, by merely improving it, you will sell more. We guarantee it. We've done it too many times. So there's 2 bits down the bottom, which I'm going to touch on in a moment. If you're a founder, as part of our engagement, we give you these graphs that are telling you this is a snapshot today of where your sales team is at, whether it's a founder-led only or the sales team function. If you're an investor, we can get engaged to help you either with your portfolio businesses or make a decision on whether you invest in a company or not based on looking at 46 elements of the sales function and rating it out of 10. So we go far deeper than any DD that I've spoken to any investor about, and provide hopefully a better opportunity for you to make an investment or not, and give you a series of recommendations on what to do. If that has resonated with you, there's QR codes. Does anyone know how a QR code works? Does everyone know how a QR code works? 15 minutes with myself or my business partner. We have a stand in the sponsor area. Tomorrow we're running a masterclass on how to scale your business at, I think, 9 o'clock or something like that with my co-founder. Love to have a chat to you. If you want to get a sales methodology, come and talk to me. If you want to increase your revenue, come and talk to me. If you want to figure out how to get your portfolio businesses pumping, come and talk to us. Thanks.
Brilliant. Thank you so much, JD, for your presentation. We really appreciate your insights and the expertise on sales. I'm sure that we will definitely be taking something back at Wholesale Investor. Now, I'm pleased to announce that our next session is also by one of our sponsors, Chefin. They are sponsoring the VIP room. And we are honored to have their CEO, Petko with us today. So Petko has a wealth of experience in the culinary industry, and we're excited to hear from him. So please join me in giving a warm welcome to Petko as he takes the stage for his session. Thank you.
Hey guys, let's see if this is going to work. Yes. So I'm Petko. I founded Chefin in 2015 with my co-founders. It's the largest private dining experience booking platform in Australia in particular, but we don't really have too many competitors in the world that are still alive at the moment. And I want to talk to you guys about the access economy, which is very, very interesting, in particular for hospitality. For over 120 years, the hospitality industry has not been disrupted. And this sort of food tech stuff are coming up and becoming really, really interesting at the moment. People have access, they have access to the same ingredients that the chefs have in the top fine dining restaurants. They have access to different dining methods. They can dine at home, they can dine out, they can do catering, they can cook themselves with the most expensive Wagyu, caviar, and other ingredients as well. So what is really that is making it very interesting is that access. We believe that this new era of access is where we can fill the gap in the marketplace and disrupt the hospitality industry. Private dining is growing year on year, and it's sort of splitting up from the general restaurant space that is declining with businesses, traditional businesses closing down. They're not able to make their margins. They're not able to survive. They're really, really struggling with labor shortages and chefs. The same chefs that actually want to come and work for us, they want to be part of the marketplace. They want to go and cook for people into their homes, use expensive ingredients and deliver amazing experiences. They don't want to work anymore for the traditional businesses, for the brick and mortar restaurants. So you can see pretty much the same thing actually happening today, which is very interesting. I find it amazing and a very good example of where the future is going. You've got general catering of vegan food, alternative proteins available for the mass market, and then you've got the private dining in the VIP room where you're going to have two chefs chopping up a whole Hiramasa kingfish that was picked up from the fish market this morning, serving New Zealand king salmon, free-range organic hams, artisan cheeses, and some really amazing produce from the farmers, basically. So that's sort of the difference between the world and how the world is splitting from an access perspective, at least in my view. And that's where a lot of investors are also putting their money. They're putting their money into the alternative proteins, into the cell-grown stuff, into the fake milks, and all the other things, which is amazing. It's really good for the general market, but we are here to stay, and we're growing year on year, and we are serving the top of the market with amazing dining experiences. We provide custom menus. We provide unforgettable and memorable experiences in people's homes. That is something that everyone wants to have, from blindfolded dinners to romantic dinners, anniversary celebrations, exclusive degustations as well. Like we've designed, like some of our investors like get chefs and they say, hey, I want to have an exclusive dining experience for the 12 countries I've lived in. One dish from every country that brings memories back for the time I've spent there. And our chefs go and do that. They design all of these amazing experiences. What we're doing in the future is we are actually moving into white labeling our booking platform and providing this software for exclusive dining into, say, restaurant groups, hospitality brands, say, Open Table and 7 Rooms. If a restaurant, a fine dining restaurant is booked out, people can actually order the same dining experience to have it into their home. And then Chefin would fulfill that, send a private chef, shop local ingredients, go and cook for them into their home. Something else we see coming up into the market is the robotics and AI. We've seen a lot of really cool machines out there, but they're pretty much useless without our chefs. Without chefs being able to actually create the recipes, fulfill the data for the artificial intelligence to be able to create the food, for the robots to be able to put the dishes together, then the machines can't really do much. So we see that coming in the future. We see the restaurants and the businesses struggling for work hand to actually fulfill that with a much cheaper alternative, with an automated alternative of machines, either vending style machines, washing machine style machines that can actually cook dishes and spit out food that is ready to eat for the general consumer. This is happening at the moment in a mass scale in China, Asian countries. It's starting to automate in the US as well. Like there's this machine called Chippy in some of the restaurants. There's like Flippy that does like flipping up of burgers, which is something that people do here for like $50 an hour, which doesn't make any sense. You can get a machine to do it for $5,000 a month, and it's pretty much fully automated with a chef providing the insights and the data for the AI and the machine learning to actually fuel up the machine to know when to flip, when not to flip, when the food is cooked, when it's ready to take out and serve, etc. In China, it's like amazing. You can go to some of these restaurants where you can see 1,000 of these machines, which is like on the right, there, top and sort of bottom right corner, and they're producing like mass market dishes, like anything you can think of, stir-fried food, tofus, vegan dishes, vegetarian stir-fries, noodles, stir-fried rice. It's all coming out in 90 seconds, fully finished dish in front of you. They can keep like up to 2,000 recipes in these machines. A bit of traction for Chefin. We've been out for like 7 years, I think, although it says 5 there, but since 2015. We've served more than 80,000 people so far. We have more than 400 executive chefs across Australia and the US, and we have 40% yearly return customers. We're very small churn, pretty good growth, and quite stable, except obviously COVID, which is a nightmare for everyone. And we've got pretty good traction. We've just reached out over $4 million of sales. We're profitable. We're not raising at the moment, but we love to keep in touch with people. Thank you guys again. I would like to be short so I can allow the rest of the people to catch up with their presentations.
Brilliant. Well, thank you so much, Petko. As someone who really likes to cook and experiment with different flavors, I was really impressed by the way that Chefin is revolutionizing the way that we approach home-cooked meals. Now, it is my pleasure to introduce our next keynote speaker, Hugh Stephen, General Partner of Galileo Ventures. In his keynote session, Hugh will be discussing the topic of first time, first round, how to build conviction to be young entrepreneurs, first VC. Over to you, Hugh.
Howdy, everyone. Look at that. Does it work? It works. So I got asked to speak about this topic, and it's an interesting area, something that comes up pretty frequently. James, my co-general partner at Galileo, James and I think, are the youngest GPs. I'm looking at Rain, who probably is somewhere closer to some of the younger of the GPs in the country. That we see. Galileo is, we've actually just been investing. We launched in December 2020. We're just over a $10 million ESVCLP, so that's the corporate structure that you see in most VC funds in Australia. Gives you some tax benefits if you're a private investor. We've got 18 portfolio companies at the moment. We've invested in 18 portfolio companies. The thesis for us is kind of what we call the emerging founder thesis. So the idea essentially is being very, very early, ideally first check-in, particularly with founders who it's their first sort of high-growth, high-scale startup. So we commonly see founders where they might have done, they might have had a, sort of entrepreneurial types. They were doing sort of weird import-export businesses on eBay when they were younger or something like that. And then, we sort of generally speaking invest at the point at which they're going for their large sort of high-growth, high-scale first, I guess, true startup in that sense of scale. We don't have an industry focus. We've done software, we've done hardware, got some deep tech stuff, and so it's been a very interesting piece. And kind of the way that we support our portfolio is with a very high touch. So the core team essentially is the two of us as general partners, plus we have a head of community, and we have a separate back office team, but everyone has a back office at some point. And then we use a whole lot of our sort of mentors and coaches. So we have a whole mentor and coaching community to be able to support the teams, whether that is about enterprise sales or it's about deep tech hardware strategy, all that kind of stuff. So that's kind of where we are. And I guess the reason I wanted the first thing I wanted to really bring up here is like one of the interesting challenges that we had when we were first going out to go and raise a venture fund. So James and I We thought we were very, very smart people, and we thought, great, it's time to do a venture fund. I came from an operating company, so I was an ex-startup person. James used to run Incubate, the University of Sydney's early stage accelerator program. And we thought, oh, great, okay, this was 23, 20, so this was 2018 or so. We thought, wow, startups, everyone wants startups and investors love startups. So it'd be really easy. And we went and spoke to Rick Baker, who runs Blackbird. And Rick said, oh, it's not going to be that easy to raise, a fund. Took us 3 years at Blackbird, and that was back in 2007. It'll take forever. And we said, no, Rick, that was back before, before this whole recent, vintage of VC funds, and everyone would love that. And, now startups, people recognize that startups are great, aren't they? No, it took us literally 3 years. And one of the reasons that actually was the case was because when we first went out to the market, we thought it's going to be really interesting. We're going to unlock this group of investors, and we're going to have a policy of no rogues. Now, a rogue to us is a rich old white guy. And we thought it would be really interesting to try and build a VC fund where, perhaps barring one or two of the key anchor checks, we're going to try and avoid talking to the same people who end up investing in many of the same VC funds, or many of the Australian VC funds. We're going to unlock a new market. And it turned out that that was a totally, totally wrong hypothesis. And the reality ended up being that in our first fund, barring, I think, 2 or 3 of our LPs, they were all people who were, generally speaking, rich old white guys, but rich old white people. And generally speaking, all had invested in a VC fund before. And it was an interesting lesson, and we tell it to our startups in terms of the sales cycle, just purely in terms of having to actually try and educate someone who was, yes, perhaps, a high net worth individual, having to educate them on the business structure and model of venture capital as an asset class took such a long time that you just couldn't actually close any of those deals in a reasonable time frame without a degree of traction and a degree of track record, which, I can understand. But as a result, what I think one of the things that we see as a result of that is ultimately in small funds like ours, realistically, you have no budget to be able to pay most of your, actual staff of the fund, right? So we obviously have to cover compliance and licensing and back office and things like that, legals. But one of the reasons that I think that we see a lot of lack of diversity in Australian fund managers, and I'm going to come to the point of why this is important in a second, is because the reality is for most fund managers in Australia, the first sort of 3 to 6 years of your time as a fund manager, you get paid effectively nothing. Not even really minimum wage. There just really isn't anything left in your management fee to be able to actually really pay you an income. And that obviously is the reason why you see typically fund managers are people who've come from previous exits and they've come from family money or whatever it is they have the capacity to be able to do that. And that's great for them. And I think that's the reason why when you ask a lot of founders about what they actually think the venture capital market looks like in Australia, this somewhat is their kind of recognition. This was actually made by one of the AI generative art things. It's quite fun. Trying to make it make a sea of white men. But a lot of founders recognise that as what they see in the market. And one of the most interesting things that we've seen coming into running a fund in Australia has actually been the way in which founders have responded and going, it's so interesting talking to partners who aren't rich old white guys. And for them, it's actually, we never really thought it would be a differentiator in terms of the founder side of the funnel. We never really, we thought it'd be a little bit of that in terms of it's easier to build rapport when you're sort of obviously a bit closer in perhaps age and stage in life and things like that. But we never thought it would be quite as extreme for a lot of them in that they went, yeah, it's just bizarre sitting in these meetings. Normally, I'd only ever see an associate who is, under 50, and that's about it. And so really, I guess, the follow-up to that is that one of the challenges that founders have is that then they look at the people who are actually helping them and they go, okay, well, obviously in VC, yes, you're a bucket of money, and that's an important piece. You've got to give them the bucket of money. But you're also there to try and be a value-adding person, right? Everyone loves to think they give great advice, and VCs don't always give great advice, myself included, but whatever. And the story I always tell is actually a good friend of mine who I won't tell too much detail, it's easy to recognise him, but a good friend of mine who built a fantastic software company and exited it in, well, it would have been probably, I think, 2008, 2009. Great exit, good outcome, everything else. And you talk to him about go-to-market strategy, and he's amazing. He's amazing at talking about, team management, people, how you deal with scaling culture, is fantastic, all those sort of pieces. But you ask him about go-to-market, and he gives you this very, very strange advice, and you sort of go, what's going on here? And one day I was sitting down with him having a drink, and I was like, tell me about how your company sort of did go-to-market. I'm just trying to sort of piece together the advice you give me. And he was like, oh yeah, so our top channel was those CDs that you stuck to the front of the PC magazine. And so his whole life was getting the trial version of his software burned onto the CD and then stuck to the magazine in the newsagent. And that was his whole go-to-market strategy that built this huge business, great exit, everything else. And it's interesting because you look at that advice 10 years later and you go, it's just entirely irrelevant. There's a piece here of you've got to find your key channel, you've got to be able to execute on it and all sorts of stuff. But when you actually try and get down to some of the specifics, you can start actually seeing where some of his advice, you sort of go like, oh, the world's really moved on from there. And the world's really substantially changed compared to when it is. And so what we have to keep telling our founders is you need to be able to make sure that, well, first of all, you've got to hope that the other person can give you some disclaimers on where their advice comes from. But you also need to make sure that you're actually getting advice from someone that actually has that timely experience. When you're looking for something very specific. Again, principles-based stuff, generally speaking, doesn't change. But that very, very specific stuff can change very, very quickly, particularly in, obviously, the world of software and the internet. So we asked our founders, what are you actually looking for in an investor when you were first looking for a check? And it kind of came down to, firstly, do they believe in them? Do they actually feel that the investor actually believes in what they're doing? And you'd be surprised how often founders feel like that is not the case, even if perhaps you do. Secondly, do you understand them? I've certainly been in many conversations, again, coming back to the piece of raising a venture fund, when you're sitting there talking to someone who is a high net worth or even a very large family office, and you're talking about venture and they say, oh, well, so when do I start seeing returns? Year 2, year 3? And you go, oh, no, this is an early stage venture fund. You're going to see returns in probably year 8, year 9. That's how these things work, because you hold on to them for a long time. And some people manage to understand that, while other people, you can see them just trying to process it. Doesn't make sense. And certainly I've sat in meetings before as a VC, and you just go, I don't understand this. I don't know what isn't connecting here, but this just doesn't make sense to me. The next one is, can you help me with that relevant expertise? And I think sometimes it's very easy for both founders and investors to over-index on that degree to which your expertise is relevant or helpful. The best kind of relationships are often that sort of mostly a pull relationship rather than a push relationship in terms of giving expertise. But can you help with relevant expertise? Can you introduce me to the right people? Now, I perhaps have a controversial view, at least to the founders, in saying that introductions, generally speaking, founders say, I want to be introduced to more investors, and that's very, very important for me. And do you know enough investors that you'll be able to introduce me to people? And I generally say to them, it's totally a waste of time to worry about it, but that is important to them. My view is that, generally speaking, good companies get funded once they actually have a degree of business traction. The business has to speak for itself, but founders care a lot about being able to introduce people to the right people. And then finally, and one where I think we have certainly had some experience in the last couple of years and seeing the way that different investor groups, I guess, engage with startups is, will you get in my way? And I think there's increasingly now more knowledge on the founder side in realising that VCs and angel investors can really get in the way of running a company. And we've seen that happen where you have people blocking weird deals or wanting to get strangely involved or things like that. And you sort of sometimes have to go this person is a $25,000 check, just tell them to go away. And it can be quite hard, I think, to have the right dynamic there. And it's tricky because as an investor, you often think, I'm here to help. I want to help. And you can very easily smother a company. And so I think, and the earlier the company is, the more sort of voids that it has. And so when we talk about the first, that first check, very early check piece, the things really not to do are, they don't need governance and boards. The number of times I see founders say to me, oh, it's great, I've got this person, they want to sit on the board. And I'm like, you don't have a board. You have two people. You have 2 co-founders. There's no such thing as a board. In 3 or 4 years, you might have a board, but that's probably going to be from your Series A investor. It's not going to be from an angel that wrote you a 25 grand check. You don't need a board. Like if you're worried about your asset compliance pieces, talk to your accountant, but the board isn't going to do that. You can talk to strategy, but really the strategy comes from the two people that are sitting there in the room, not from all of your investors. We're there to just bounce ideas off and be able to help. So they don't need that. And the number of times that we again talk to potential LPs and stuff like that, like, oh, I really want to sit on some boards. It'd be great to sit on some startup boards. Startup boards are really boring most of the time. Before like a Series B or C, they're really boring. You don't get to do all of the fun, strategic, everything else things because the whole company's on fire. You don't have the opportunity to wait until the next quarterly board meeting to be able to have a strategic decision on what we're going to do next because the whole thing is still burning. So it just doesn't really work. They can't pay you. Again, surprisingly, we see people go, oh, it'd be great. I'd love to be on the advisory board. Get $40,000 a year, and you sort of go like, oh yeah, these people can't really afford to pay for a coffee machine. So I'm not sure they're paying for their investors to sit on an advisory board. And I think the final thing is that you're really not there to run the company. And this was something that came out a lot when we spoke to the founders about what it was that they were looking for in their first investors. Was that a lot of them realised that really the people that they were looking for was someone who would be there as the, I guess in that advisory capacity in the sense of someone who I can go and talk to when I need help, but who isn't there stepping on my toes. And I think certainly when I was an angel, before I raised and ran the fund, certainly when I was an angel, I made the mistake of thinking that angel checks were a way to buy myself a job. I was an ex-consultant, so of course everything's a consulting project. And I was like, oh, it's kind of like buying consulting projects. You invest and then you sort of do some consulting, even though you're not actually getting paid for it, but you're kind of paying for it yourself. It's kind of weird. But then you get to do consulting projects and it's fun. But you're not an employee. And it's very easy, I think, sometimes to forget that it is a very different relationship and you have to build that relationship. And for our companies, I think a lot of them, they've discovered that one of the big value adds has actually been in realising the value that friction provides. So while I say that there's no real need for governance and boards, one of the things that we teach our portfolio is that piece of saying, well, with your investors and with your advisors and people like that, like a board and a CEO, you need to have a little bit of friction. It shouldn't be that everything is just tick and flick. It shouldn't just be like no one ever questions your wonderful logic and treats you like God the whole time. There should be that amount of friction between the two, and building that right amount of friction is actually a really challenging thing for founders, particularly when it's their first real company. They probably haven't ever sat in a board meeting of a major large board where the CEO and is asked some hard questions by the board. They've probably never even sat in one of those before. And so really your job is to try and hold up that mirror and be able to ask those hard questions. You can do that in a friendly and approachable way. You don't have to try and, like friction isn't applied with an angle grinder. But your job is to make sure that they are actually critically thinking about those things. And what we say to our companies is, we're fine if you don't know the answer. You can just say, I don't know. Or you can fine if you say, hey, you know what? You think it's this, I think it's this. We'll go, great, cool. Okay, you understand my view. I understand you have a different view. Let's see what works. But your job is to make sure that there is enough of that friction, there is enough of those pieces, because in these companies when they're very early, it's very hard for them otherwise to find themselves stuck in too much groupthink. And that's all I really wanted to say. If you have any questions, I'll be around for a little bit. But thank you all for coming.
Brilliant. Thank you so much, Hugh, for your presentation. It was truly inspiring and very informative. We really appreciate you sharing your time with us and expertise. It's now time for a very well-deserved lunch break, and we're excited to have our sponsor, Flav, provide a very delicious spread for everyone. So please help yourself to the food and take the time to network with other companies. You will find their tables in the company expo area. So feel free to connect with other companies, team members. And when we reconvene, we have a really exciting panel session on digital assets investment trends for 2023 lined up. So make sure you return promptly around 1 p.m. Enjoy your lunch, and I'll see you guys shortly. Thank you. Welcome back, everyone. I hope you enjoyed your lunch and made some valuable connections. We are now ready to kick off the afternoon with an exciting panel session on digital assets investment trends for 2023. Our panel features a group of distinguished experts who will be sharing their insights and opinions on this important topic. Please join me in welcoming our esteemed panelists. We have Archie Whitford, investment analyst at Hansa, Mark Woodward, investment partner at Apollo Crypto, Adam Switzer, CEO, CTO at Leonie Hill, and Pras Inder Kumar, family office and institutional at Zero Cap. Over to you, panelists. Thank you.
Hello, hello. Hi, everyone. Yeah, welcome to the expert panel. Thank you, Wholesale Investor and Emergence 2023 for giving us the opportunity. Yeah, it's on digital asset investment trends. What a timely topic to talk investment trends as well as digital assets. So let's kick it off. Yeah, I'll get everyone to kind of introduce themselves, kicking off with Mark there, Mark Wood at Apollo. So and then we'll go around and then we'll kick into it.
Thanks very much. Hello, everybody. I'm Mark Woodward. I'm an investment partner at Apollo Crypto. We are a crypto asset specialist investment fund manager. We're based in Melbourne. We have about $100 million AUM, or assets under management, across 3 active funds. And my background comes from finance and private equity, as well as software entrepreneurship.
Go for it, Archie.
Yeah, hi, I'm Archie. I'm the investment analyst at Hansa. We're a young multi-family office fund out of Melbourne that was born out of a single family office that was heavily involved in the Web3 space. We like to invest and accelerate in the protocols that we believe to see advancing the future of open society. So pre-seed, seed checks, small funds to maximize our returns. And since it's a single family office, we always have skin in the game and try and win alongside our co-investors. And prior to that, I wasn't particularly doing much. I was doing a lot of writing pseudonymously in the crypto space while studying, and then came into this role and very glad to be here.
Thanks, mate. Adam.
Hi, I'm Adam, the co-founder of Leonie Hill. We are bringing real-world assets onto the blockchain, so tokenization of real-world assets, and also focus on providing access to digital assets to institutional and sophisticated wholesale investors, primarily a B2B2C type approach. Setting up from our traditional backgrounds, my background is 20 years in trading technologies, trading floors, data and AI. And we really set up our business to bring all the best practices of running a traditional financial institution into the digital space, which has proved very, very interesting over the last year or so, which I think we'll talk more about as the panel goes on.
Excellent. Thanks, Adam. I'll give a bit of background on myself and Zero Cap. I manage family offices and institutional investors at Zero Cap. Zero Cap is a Melbourne-headquartered asset management private banking firm here, backed by the Victor Morgan Group. Been managing a lot of institutional capital as well as family office capital, building massive portfolios. Done about $2.5 billion in transactions, and mainly custodial type setup for large institutions such as we're doing a lot with the ASX and the banks as well, so that's the main part of our world. But my background has been across the last 10 years in this crypto digital asset world. Still an original shareholder from Independent Reserve, and been investing in Bitcoin. That's my background. So known Apollo really well as Leonie Hill, and we're doing a lot of work with Coty, especially with the family office background as well. So we've got really good connections, associations with all 3 firms. New Aura Capital who'd backed Leonie in the early days. So a lot of this ecosystem is quite small in terms as well as a Australian startup or Australian ecosystem. It is a wider story to cover as well. So we'll kick straight into it, and I'll go around the panel and ask the experts what they're seeing in terms of the actual digital asset investment trends for 2023 current and beyond. Mark, for you.
Yeah, sure. So we had a very interesting year in 2022. I think a lot of people did not expect the numerous black swan events, all of the unfortunate collapses that we saw in a lot of the centralized exchanges. Clearly, I think coming out of that, we're going to see increased regulatory scrutiny. I think there's a lot of investor sort of nervousness about custody of their assets and utilizing centralized solutions. That I think is a good thing for really the reason why crypto was created, which was to create a decentralized network of finance for individuals to be able to use, to be able to self-custody, and to be able to transact on their own without a middleman. So we're heavy investors in DeFi, and that's sort of one large positive that I think we can take out of the calamity of 2022. You've seen some reactions lately in the crypto market to the failures of the banks in the US, Signature, Silvergate, Silicon Valley Bank. These are major banks in the United States that have now folded. And as a response, you've seen crypto actually rally and start to adopt this narrative as a non-sovereign store of wealth, a non-sovereign way to transact with your own finances without the need for an intermediary. And we think that trend is going to continue as we go forward. So we are cautiously optimistic about 2023.
Yeah, I'll just second, I think, a lot about what Mark said. When I was looking at the title of this presentation, right, Digital Asset Investment Trends for 2023, I think even we're in March now, and I think there's already sort of been 2 2023s. So you've got the, I guess I'll call it pre-SVB, where you had the long lingering effects of FTX's collapse and then general macro conditions. And I think crypto, as a result of that, sort of behaved as it had even in the bull run, as sort of what I'd call a leveraged version of the NASDAQ. Sort of like an indexed fintech almost. And then post-SVB, a lot of the points that Mark was just making about erosion of trust in traditional institutions and really a return back to crypto's main principles of permissionlessness and trustlessness. So the way that I would sort of characterize the bull run prior was there was this amazing, like almost whimsical frenzy of permissionless innovation, mixed bag in terms of utility. But I think now you go more to the core principles of blockchain in terms of optimizing for decentralization, optimizing for trustlessness and rebuilding institutions from the ground up. And so I think what we're seeing now is a lot more people building serious things even at the pre-seed, seed stage. And one of the big ones that we're seeing at the moment is this theme around the disintermediation of data and information. So prior bull runs were very much focused on disintermediating finance, which is a tremendous innovation. But we believe, especially as a firm, that creating these sort of fair, neutral, and reliable new information flows on blockchains and in a decentralized manner is where there's a massive opportunity to sort of reinvent almost really flawed parts of societies. And that's a really exciting opportunity that we're seeing.
Some really interesting insights. I agree with most of that, in particular the whole sentiment of people are coming back to the point of blockchain and coming back to the real reason why it became popular in the first place and what the use case is trying to solve for. And the exchanges, I think the reason why they failed, and I disagree with the comment that no one saw it coming, because that's actually our business model to have brought it in a way of essentially encapsulating the decentralization, but doing it in a way that is on behalf of a client, to try and navigate that for people that aren't familiar with crypto, as opposed to what the centralized exchanges were doing was essentially, trying to centralize access to digital assets. And it's a subtle distinction. The downside for us is that no one likes the people that said "I told you so." But having lived through the whole GFC and the wave of regulation, we took that whole approach from the start. And obviously just being flippant about no one foresaw it coming. But I think a lot of people just kind of forgot those lessons of why banks collapsed back in 2008. And we're seeing the same patterns and the same reasons why exchanges having a liquidity run, unable to pay their customers. Banks are having liquidity run. These are bank killers. They're rehypothecating and prop trading client assets. These are all the same things that have happened in the past. So it's easy for us to forget why that's happening. And I think you're absolutely spot on that coming back to the core reason for being of crypto and digital assets is the essential thing going forward. And what that means is people may or may not know what to do, what to invest in. Obviously volatility. Things may explode up which might be counterintuitive to those that are looking at saying, hey, isn't the sector falling apart? So I think the two things for me, and caveat, I'm a technologist, not an investment expert, but I think the two things that I think will come through this year are sticking to things that are fundamentally value or have utility, like you mentioned. And that is, and again, as a technologist, can it solve a real world problem? So for us, using blockchain to tokenize and make much more efficient the process of unlisted assets and making them tradable and discoverable. And secondly, the volatility and uncertainty brings opportunity. So there will be things that die. There will be things that are, will rise out of the ashes. And I think they're the things that you guys look at of saying, which ones, if you're in there and you're an expert, which ones are the ones that are right? Which ones should we back? Navigating that for people that are not full-time, not experts, or just don't know or don't have the stomach is going to be a real challenge. But I think that there'll be a lot of value that comes out of it and opportunity for those that have got the stomach.
Thanks, Adam. Look, the views that you've heard, like from Mark's and Archie's and obviously Adam's view around it, really shows what this the trend is across this whole space. I mean, you look at diversification within an asset class, and if you look at this digital assets and asset class, you've got Mark's view and Mark's world of, from a funds management perspective on what the Apollo fund's been investing in, looking from, I guess, Hunter as well as Cotty, in terms of the VC perspective, the Web3 funds management world, and then you look at it from the whole, I guess, advisory space and the, the private wealth and the platform side of, where Adam. So if we look at the investment trends that we're seeing across where, family offices or investors are asking, they're looking for diversification even within this. I mean, even when you look at a real estate, asset class, you've got across, whether the resi all the way up to in infrastructure and commercial, right? You've got to take the same view on that. And that's the way we see investors taking a view on this. They want to have a bit of exposure in infrastructure. They want the funds management exposure, bit of VC play. And the breakdown on that is not about, what percentage of my portfolio should be crypto. That's not a question we hear anymore. It's more about what percentage should I have exposure into the infrastructure, the tech side. People really get this asset now. It's every one of you in the room haven't really started the question of saying, what is digital assets? We don't need to go there anymore. And I think that's where we're at now. In terms of real trends, we're seeing what Reserve Bank's doing in terms of the CBDC, in terms of the, the stablecoin movement of the banks, as well as the whole private stablecoin market. And then you're seeing tokenization taking real kind of out of pilot mode into real, I guess, real live assets coming to actual real use cases where there's problems being solved. The New South Wales government and the federal government here, changing the titles as well as your identity. So this is all happening underneath us. And I think the best way that I see in terms of trends is when you actually don't need to define it and don't need to say it's blockchain anymore. That is actually happening around us. And that's the trends that really we're noticing, kind of deep within this ecosystem. Now, to go on to the next part is our own personal, I've touched on that from our own investment strategy, but I'd love to dig into more Apollo and your own investment strategy on how you, I guess, fit into this diversified portfolio that I spoke about.
Yeah, sure, happy to. So as I mentioned, we are a multi-strategy investment firm. We have 3 different funds. I'll just highlight our flagship fund, which is the Apollo Crypto Fund. So this fund, again, is a multi-strategy fund. It's designed to give wholesale investors broad exposure to the crypto asset category. The way we look at this fund, or the way we segment our investments, are in a few different categories. The first one are layer 1 and layer 2 blockchains. So these are the fundamental blockchains and building blocks that all transactions and applications are built on top of. So it includes things like Ethereum and Bitcoin, but also alternatives to Ethereum, as well as what are called layer 2 scaling solutions, which will help Ethereum scale and be able to handle much higher transaction amounts while also not sacrificing the security that you get with Ethereum. We are heavy believers in DeFi, or decentralized finance. This is the category of crypto assets that is looking to replicate and improve upon existing traditional financial activities like lending and borrowing, exchange, derivatives, options trading, and yield generation, for example. So we've been early investors in this category even before it was called DeFi. Our chief investment officer was the founder of 2 different DeFi protocols, and it's an area that we continue to invest in. And we think, given the events of the last year with all the centralized organizations and now the banks failing, we think DeFi will continue to grow, and people will certainly understand the value in this emerging asset category. We also invest in NFT and metaverse infrastructure. So NFTs, non-fungible tokens, these are unique tokens that are used to represent a digital asset on the blockchain. They can be anything from a collectible, a piece of artwork, a gaming asset, or even a financial instrument. And metaverse, again, is a catch-all phrase for anything sort of in the digital world where individuals might, for example, game, they might have an avatar, that sort of thing. So investments in this category might be a layer 2 blockchain that's optimized for the minting or the creation of NFTs and the trading of NFTs, or an NFT marketplace. We believe in a multi-chain future, so we believe we're not maxis. We don't believe that it's just going to be Bitcoin or just going to be Ethereum. We think a number of layer 1 and layer 2 chains will coexist. So we've invested in the infrastructure that allows these chains to speak to each other and allows investors to move assets across these chains. We're also very active early stage investors, so we take sort of a venture capital role, investing in the categories that I mentioned in the very earliest stages of a new protocol or a new token. We also do a bit of market neutral and liquidity providing activities in this fund. So this is a way to be able to generate yield without suffering some of the volatility that you're going to see in the crypto asset markets. So again, those are the categories that we invest in and that we spend the most time in.
Thanks, Mark. As you can see, a very diversified investment portfolio across that. I mean, in terms of percentage breakdown, are you kind of evenly across those? Is there a heavy weighting towards one or the other?
Yeah, so layer 1, layer 2s, those are probably 45 to 55% of the fund. So there's probably 7 or 8 different assets in there, including Ethereum and Bitcoin, things like Avalanche, Polkadot, Matic, and others. Anybody that invests in crypto might know those names. DeFi, 15 to 25%. The market neutral stuff is 20 to 25%, depending on where we are in the market. And the balance is, the early stage illiquid investments. So pre-token investments in the venture capital style.
Nice. And same for you, Archie. I mean, wearing the Hunter hat as well as the Coty Capital, how does that portfolio look across, as well as the family office side?
Yeah, I'll focus more on sort of Hands, or as a multi-family office rather than Coty, because Coty's a very generic vehicle. But Hands essentially is an agglomeration of the family office private capital and then also partner capital. We, like these guys do, invest at the pre-seed and seed stage, looking for valuations of anywhere between 5 and 20 million, because we think price matters, and that's why we keep the fund sizes tend to be quite small as well, because we're trying to be able to write those small checks that have the highest upside and allow us to win with our partners. In terms of the diversification piece, I think from the Hands of vehicle, we are unapologetically long and unapologetically targeted around our theses, particularly around the narrative I was talking about earlier with sort of decentralized flows of information and rebuilding those sort of information-bearing institutions from the ground up.
Fantastic. It's good to have that conviction and that focus. And I think we see that trend with some of the family offices with a focus on we just want to have exposure to the infrastructure or just to have that coin, So I think that's a common thread. So over to you, Adam.
Yeah, I mean, we don't invest. We're not a fund or anything like that. We're a technology provider and also bring the technology to real-world assets. So for us in digital asset space, obviously we're naturally long the whole sector. But as essentially an SI or a platform provider and giving rails to people that are investing, I think what you've both strategies you've touched on are really important. Particularly, Mark mentioned 2 things that resonate with me is the layer 2s and the core infrastructure and interoperability. I think it will take a very, very long time for the industry to settle on a particular network standard or monopolization, which is actually anti what the whole industry is about anyway. So I think that's a really good space for continued innovation and growth, and particularly to do things like bring down the cost of transactions and support the hopefully exponential growth of adoption of the technology. So it's a really important space. And also around DeFi as well. Again, another huge part of what we do is applying technology to massively simplify and streamline existing financial services products, which I think is, you touched upon that really succinctly in the way of what using, why you've invested in DeFi and what it's trying to do. I think the risk over time, and why I guess is a bit tainted, as people are using it for the wrong thing or have the wrong understanding of what it's trying to solve for. It's not necessarily a whole new product or a whole new type of asset class. It's essentially just making the whole process less friction in the process, and distributing out to people to take out the middlemen. I think that's a really key point. Again, I agree with the sentiment of why you're investing in that space.
And you also presented this morning about the tokenization as a service. What part of your portfolio is that?
The whole thing. But I think that goes out of digital assets. So I guess when we're talking in the space of investment in digital assets, these guys are talking about investing in blockchain projects. And as a technologist and a fundamentalist, is they have to have value. So is that token valuable in an ecosystem, and can it be used, and is that project and network going to scale, and it's a proxy for the value of that network? I think it's important. For us, bringing real world assets to the blockchain, those interesting ones, again, we're selective about which networks we use, but the ones that can offer huge scalability, predictable transaction costs, the right level of validation, KYC workflows and some functions that allows to replicate real world processes around sophisticated investment, accredited investment, regulatory jurisdiction about modelling products. So for us, obviously that opens up digital asset investment to real world assets as well as blockchain assets.
That's fantastic. I mean, for ZeroCap, I mean, being a custodian, we're kind of across the entire ecosystem. So right from exchanges to fund managers to, those who are doing the tokenization projects, everyone needs to have their assets in custody. You need to have your assets in insured custody. So a solution around that's what ZeroCap's gone out to provide. But taking a journey through a family office like the Victor Smorgon Group, the Smorgon family, who've then taken a view 5 years ago onto investing into this asset class, what percentage of their portfolio they should be investing, starting off with 1 Bitcoin and it's a bit of Ethereum as the portfolio mix. At that time, we were looking at a 70-30 portfolio mix of Ethereum and Bitcoin to start off their portfolio, to right down to growing out their portfolio into investing into a Bitcoin fund that we launched out, which was just like a Grayscale Bitcoin Trust. We had a ZBT Bitcoin Trust as well. And then we had a smart beta Bitcoin, which was taking away the downside because it's such a volatile asset class. So we built out a smart beta solution around that. So it's dampening the downside of the volatility, and that's why it's a Bitcoin US dollar rebalance strategy. So I guess sophistication within this asset class, going right upstream into structured products. So what we've done is we've got a derivatives license. So this is all under regulated, I guess, funds management, right up to structured products. So we're actually wrapping up a derivative instrument where you're not just buying on spot through exchanges or OTC, where you're now looking at entering and exiting the market using options trading, but it's actually giving to the trading team to manage. So you're looking at entering 10% below market, 20% below market, enhancing yields. So these are sophisticated private banking strategies that you've all been exposed to, but in this space where the volatility is 4 times higher, you're getting 4 times the yield. So you're generating 40, even up to 80% yield on some of the altcoins as well. So they're the kind of strategies that we're seeing diversified across this asset class. I don't think a lot of you may have heard about a lot of this in traditional crypto trading language, but I think a lot of what you've heard today in terms of asset management, venture capital, and in terms of the platform and the service and tokenization, this is the evolution of where we're at in terms of digital assets. So this is the elephant in the room, the regulatory environment, right? Where we're heading to and where we are. So gents, around the room, how do you see a regulatory environment shaping up and evolving in the near future, hopefully the near future?
Sure, yeah. I mean, all eyes are on the US SEC and other regulatory agencies. You've seen the Biden administration a year ago, they sort of came out and said they were going to take a somewhat agnostic and exploratory view of crypto. And the result of that has been a very draconian enforcement action by a number of regulatory agencies led by the SEC. So I think we're going to see more of that this year. I think the SEC has chosen legal routes. So they've issued Wells notices, which is a notice that they're going to try to complete an enforcement action. Coinbase got one overnight, so they're the leading U.S. exchange. They're already public, highly regulated, and some of the activities that they are now being scrutinized for were actually in their S1. They're in the prospectus to go IPO, which the SEC would have had to sign off on. So it's a bit strange this late in the game. They're starting to come after them. But I think it's a clear reaction of the Biden administration. They don't like crypto. They want to get it out of the U.S. They want to cut off all the banking avenues for on-ramps and off-ramps. I think crypto purists can say this is a great thing because it sort of amplifies not a great thing, but it amplifies the value proposition of crypto, and that you want a trustless, intermediary-less financial system, and that's going to accelerate all of that. But the question is, where are the on-ramps and where are the off-ramps, right? So how does the capital come in and get out of the system? And as an example, you see other countries actually opening up. So Hong Kong, which is a part of China, has actually now reversed their stance, and they're going to allow crypto trading for retail investors, opening it up to the large caps, but also ETFs as well, which is something that the U.S. has not approved, even though they've had at any given time 24 or more ETF applications in the U.S. So the U.S. has taken this approach of trying to regulate by enforcement rather than giving clear guidance. And I think we're just going to see more of the same. And I think the legal fight is going to take a few years. Haven't seen crypto react as strongly in sort of a downside fashion as I thought they would have. And it's also ironic that you're seeing these highly regulated banks all fail, and yet the focus is on crypto.
Yeah, I'm not a lawyer, so I'm not going to try and speculate too much on sort of the regulatory scope around crypto globally, especially. I think as a firm, just sort of we keep an eye over it, but the priority from our side is just wishing that governments consult technologists in the space like Adam. And I think it's something that Australia's done quite well with its crypto consultation at the moment. But yeah, I think the main thing is without being offensive, you just don't want too much grey hair in the room and people who have been educated for 6 months on the space. You need people who've been building there for a long time and understand the core principles to be consulted on its regulatory development.
Actually, I might just jump in and kind of challenge you on that, because I think that there is a need for a lot of grey hair in the room. Because, I mean, the actual lessons have been learned, and this is not in the last 30 years, and we're talking way back in the 60s, and when bond instruments, when these were actually created, they were actually created with the right intention. And even when the first ATO ruling came in, 11 years ago with how to tax crypto, that they had it right. They were one of the first in the world to get it moving. I mean, obviously there was money to be made for ATO, but I mean, I think the regulators need to come in, and I think need to consult with maybe not what's gone on in the last 10 to 15 years, but I think we need to go back and learn from the ways it was set up right in the start. So yeah, no, it's a good point. Yeah.
I agree with the need for regulation, but my point was more around balance. Yeah. Just having both sides at the table, I think.
Yeah. Yeah, I'll go dye my hair, get rid of all the greys. I think it could go a couple of different ways, and I don't disagree with your point that we need a bit of fresh thinking around how to make it appropriate for crypto. I was also a quantitative risk manager for some of the biggest trading floors in the world, all through the GFC and rolled through the whole wave of Basel III and capital adequacy, and that's kind of how we structured our business, because we knew that's the right way to do it, to not rehypothecate client assets, not put them on your own balance sheet and trade them. Make sure you've got capital adequacy, not over leverage, all these things, right? So, and the contagion scenarios, again, things that I modeled out, lived and breathed back in the day, and sort of 20-year career on a trading desk. So these things aren't different in crypto. If you're looking at crypto from a financial product perspective, as in currency, commodities, derivatives, financial instruments, some store of value, and so on. Then from a technologist hat, decoupling crypto from the technologies undoubtedly can solve an enormous amount of use cases. So park that for a minute. The regulation of crypto trading as a financial market is inevitable. It will come, but it could come in a lot of different fashions. And I think your main point is absolutely right, that it has to be done with consideration for what the market is actually all about and what it's trying to achieve, not kill it or not stifle it or not, try and apply things blindly. I think that's a really, really key point. And to Mark's point as well, maybe some things are going to be a bit knee-jerk by just cutting off the rails. Actually, that kind of helps, but it alienates the whole sector. So it'll accelerate things like, the whole move away from government and part of the original, to evolution of crypto itself and why it's there to try and decentralize from the government. But it's not sustainable, I think. I don't think it builds a healthy ecosystem. And I think where it probably should go is, rather than being knee-jerk and trying to do all the legal things and the current tools they've got to restrict companies, particularly counting off US dollar payments or US dollar banking licenses, is kind of the world's biggest financial weapon. Things like accelerating the RBA's digital asset, central currency. I think other key things that it really brings into account is if a bank like Signature and Signet failed backing its own stablecoin, what does that mean for the validity of ANZ and NAB's tokens? Is actually even a bank-backed stablecoin, is that still valid? So there'll be a lot of scrutiny around, particularly on stablecoins, cash management, financial transaction reporting, derivatives licensing, credit licensing for lending, all the same things that happen in the current banking system. And I think if they do it right, they can kind of fuse the best practices of how financial markets should work, but do it in a way that actually doesn't kill the crypto economy.
Yeah, no, good point. How are we doing for time? Oh, okay, cool. I'll just wrap up with, obviously it's good governance, good processes, businesses in the space need to get that right. Regulators will take their own time and it'll all come together. So might just wrap it up. Thanks, Mark. Thanks, Archie. Thanks, Adam and Emergence team for putting it together. And yeah, thank you all for the session. Cheers.
Hi everyone, I'm so sorry. I know you want to connect, but we have to move on with the next company presentations. Excuse me, everyone, may I get your attention, please? Hello, may I please get everyone's attention? I'm so sorry. I know you want to mingle and connect with people, but we have other company presentations to move on to. So I would just request, if you want to have a conversation, please feel free to make your way outside because we have to move on to the Can I please request everyone to sit down, please? Please, thank you. And also, I would like to firstly thank our panelists for such an insightful session. Your expertise and experience in this field have been incredibly invaluable in shedding light on the latest developments and trends in digital asset investment. Thank you so much to our panelists. Moving on to our next session, we have an exciting lineup of presentations from some of the most innovative companies in the industry. Our first speakers are Kevin Dattagupta, founder and director, and John Lenny, advisor and mentor at Investify. So please give me a round of applause for our amazing companies coming up shortly. Thank you.
So my name is John Lenny. I do have grey hair, referring to the previous speaker. I was actually a share manager of a large research firm in Auckland. We are Kiwis, and I only wish that the tool that is going to be presented to you was available to us then. So my colleague is Kevin Dattagupta. He's the founder of Investify. Kevin, what is Investify?
Are we putting up the slides? Sorry, John.
So rewinding just a second. So we're doing this under a Q&A presentation just to make it a little bit different. I'm asking Kevin the question. So Kevin, what is Investify?
John, in this age of the internet, information relating to listed stocks is readily available, but filtering through the huge amount of information is very time consuming. Have you ever thought that there could be a better and faster way to find undervalued companies around the world based on what your risk-reward benchmark required? At Investify, we are using artificial intelligence and machine learning to give everyone in the wealth management industry the platform to do just that with ease and speed. Platforms such as Skyscanner, Expedia, and Booking.com search for hotels, cars, and flights very fast. Investify works in just the same way, finding the best options amongst listed stocks fast. We like to refer to it as the Skyscanner for shares.
And Kevin, what was your eureka moment?
Investify was born out of my own need as an investment advisor to answer questions that my clients asked me of finding listed undervalued stocks and to construct an investment portfolio for them. The research and analysis required in laborious, intensive, and time-consuming work. While information is available through terminals such as Bloomberg and Reuters, they are very expensive, and a human still needs to spend considerable time and analyzing the data provided. I thought there has to be a smarter, faster, and a more affordable way.
So what is Investify's secret sauce? How does it actually work?
Investify uses artificial intelligence and data aggregation algorithm to start, search, and aggregate millions of data points very rapidly, and thereby find listed undervalued companies and key investment financial metrics in minutes. Just like ChatGPT, it uses machine learning to read and summarize lengthy annual reports and other documents quickly to generate succinct and helpful commentaries and reports.
What is the challenge Investify solves?
In the last few years, technology has rapidly transformed the wealth management industry in the form of robo-advisors and micro-investing apps. Innovative companies are threatening the existence of the human advisor. However, while these solutions are very price competitive, it does not do a good job in providing robust guidance to the investor as to what to invest in. As a result, the investor has got two choices: either to do their own research, which takes considerable amount of time, or seek professional advice, which is expensive due to the advisor's own research and time required and the compliance costs incurred. This is exactly where Investify is to come in, via this capital raise through the enhancement of a version 1 of its existing tool with a hybrid robo-advisory solution and a B2B2C model. In our future roadmap, our solution will help the SME advisor become 5 times more efficient in creating better performing curated model portfolios by reducing the time and cost of analysis by up to 80% and create thematic portfolios such as green energy. In short, more value-added service in less time.
And Kevin, how big is this opportunity?
The global wealth management platform market was sized at USD 1.1 trillion in 2020 and projected to grow at over USD 3 trillion by 2030. Our research has identified a gap in our current version of Investify of not having data for exchange-traded funds and managed funds. In the initial 3 markets of New Zealand, Australia, and UK, we have research. There's about 17,000 advisory business and with over 57,000 advisors. If the tool was enhanced, feedback from our research was positive. So we believe with the large size of the total addressable market, the opportunity is huge.
And please tell us, what have you achieved so far?
Following our initial R&D funding of 520,000 New Zealand dollars from the government, we assembled a team of developers and created a version 1 of the tool with features as shown on the slide, including coverage of over 11,000 stocks across the US, the UK, Australia, and the New Zealand market. Valuable key insights on financial metrics, the ability to generate automated self-branded and white label report, and aggregated buy and sell recommendation from over top 100 analysts. We have a fee-paying subscription customer, and through our extensive research, have collected a significant amount of user feedback and interest to enhance the functionalities.
And what are your immediate and longer-term aspirations and vision, Kevin?
The current version, as I mentioned, of Investify only covers listed stocks. Our research and demonstration of the current platform across New Zealand, Australia, and the UK showed that there is considerable amount of interest for the tool. The overriding response from the advisor contacted was that if exchange-traded funds and managed funds data were added to the tool, many of them would be interested in paying for the service. Our future aspiration is, however, to expand the tool into a hybrid robo-advisory solution. This is where the concept of thematic portfolio construction comes in, along with artificial matchmaking, intelligence matchmaking. Here is an example of some of the portfolios we had created with the big data analysis. As you can see, the returns are quite attractive compared to the benchmark, and is what I believe to be one of the huge opportunities for Investify. The current subscription-based revenue model is to primarily become a management fee-based revenue model. There will be opportunities for additional revenue generation from licensing, lead generation for sourcing client for the advisors, and SaaS models. Once exchange-traded fund and managed fund data has been made available in version 2, along with the thematic portfolio capacity, our focus will be introduction of the B2B2C model to large advisory firms to enhance scale.
And how much capital are you seeking, and what are the terms, and what will it be used for?
We are looking to raise about AUD 1.85 million by way of convertible notes. The notes have a coupon paid quarterly in areas of 7.5%, an uplift on conversion of 20%, and a 20% equity stake. The proceeds will go primarily towards the product enhancements of version 2 of the tool, key hires, targeted sales and marketing, and infrastructure.
And tell us about your team and why they are the right team for this.
John and I are both licensed financial advisors and have a deep understanding of the gap in the market. And John is also a chartered accountant in public practice. My other founder is a seasoned expert in AI, machine learning, big data, and data analytics. So dealing with artificial intelligence, millions of data points is his bread and butter. We are also in final discussion with an Australian senior industry participant for a business development role in Australia.
Well, thank you, Kevin, for telling us about Investify. As you will have noticed, this is an exciting AI-powered tool with significant growth opportunity in financial services. We'd be happy to answer any further questions you may have in our booth, which is just opposite the reception down there on the right. Thank you for your attention. Thank you.
Amazing. Thank you so much for that presentation, Kevin and John. Now, I would like to invite our next speaker, Cody Kotrovsky, CEO and founder at Right Choice Capital.
I do. Thank you.
The side buttons.
Side buttons. All right. Okay. Thank you all for your time. As you can see on the slide, the role of Right Choice in the ecosystem is we provide banking and financial services. We do that currently in Singapore and the Philippines. Our main products are loans, remittances, and payments. We provide those products to consumers as well as the tech infrastructure to other banks and institutions. The addressable market that we have between Singapore and the Philippines is quite large, over 110 million population and over 1 million MSMEs. And if you're not familiar with the banking sector in the Philippines, there's quite a lot of opportunity for improvement. This is recognized by the regulator, who's making a big push because they recognize that the commercial banks, which are typical in many emerging markets, are not really adequately servicing the customers and businesses. So there's a huge underserved population. And the provincial banks in the Philippines also don't have the infrastructure to provide anything beyond basic products to their customers. And so this is right where we fit in to that space. Our core customers are the underserved individuals and MSMEs that are not being addressed by the commercial banks. And we also provide the infrastructure to the provincial banks to better service their customers and offer a wider range of products to them. Over in Singapore, banking services there are much better than in the Philippines, but MSMEs are still underserved in terms of cross-border payments and loans primarily. We provide both of those products and services to our customer base in Singapore. So I'll show you guys a slide of the overall group. We've been operating for quite some time. We have a number of licenses within the group. In the Philippines, 2 banking licenses. In Singapore, we have the major payments institution license. We do the cross-border payments. We're adding insurance later this year into the Philippines. We're also adding credit card issuing and acquiring both in Singapore and the Philippines. Our revenues have been quite strong historically, finishing the last fiscal year at around 7.5 million Sing dollars. This current fiscal year, we're seeing quite a jump. That's on the back of the acquisitions that we're completing this fiscal year, plus revenue growth of the existing business units. Overall, 9 companies within the group, 10 office branches, over 100 employees, and we have a track record where we've been doing this for quite some time. And so with the changes that we see coming about in the Philippines and in Singapore, we're really well placed for an exciting trajectory over the next 3 to 5 years. And so this is who we are and what we do. And from an investment perspective, there's just a list of the various licenses that we hold in the group. It's quite challenging now in both Singapore and the Philippines to be able to get the payments institution licenses and the banking institution licenses. Also point out that we've got direct membership with MasterCard and UnionPay through our second bank acquisition. Our current raise is up to 25 million. We can do that via common share equity. We're also open to convertible preference shares, which would have a 10% coupon, 20% conversion discount on the valuation at conversion, or debt placement, terms 24 to 60 months, and interest rates ranging from 10 to 19%. Why we think investing in Right Choice is a good opportunity. We do have a proven track record. We've been successfully operating and self-sustaining throughout our history. We have been a very good custodian of investor funds, having raised over 17 million to date, a combination of both debt and equity. We have returned over 11.5 million in investor payments, interest and principal repayments. You also have the security of the investment coming through the Singapore holding company, but the opportunity and benefits of the emerging market of the Philippines, as well as our growth in Singapore. In terms of our competitive advantage, the licenses that we have, quite unique, hold intrinsic value. We've got a very strong tech team building our own in-house platforms, which also integrate with APIs, with third-party solutions. And the team that we've put together, over 100 strong, very seasoned individuals in their respective fields, coming from commercial banking, impact lending, as well as technology. And that is why we'd like you guys to consider an investment in Right Choice. If you want to talk to us further, we are around the corner at the exhibition booth, and our contact details are there if you want to reach out. So thank you guys for your time.
Amazing. Thank you for your presentation, Cody. Perfect. So next up, we have Matthew Edwards, Group CEO at Geniusto International.
Okay. Good afternoon, everybody. Thank you very much for your time. If we may have the slides, please. I don't know how this thing works. Okay, so accelerate your digital economy investments with Australia's fastest growing digital economy or digital banking technology provider. So right away, let's talk about the ask. No? So we started back in 2018 with seed money of $5 million US. We acquired a very robust digital banking platform from Europe. It was a UK-based company called GCP Software. We fully acquired that asset in 2021, and it came along with not just the IP, but also some paying customers as well, which helps us to hit the road running right away. We then went to market and raised 6.2 million in capital very quickly. At the end of 2021, it took us just 3 months to close that round. 2022, it's been a really exciting year for us. Doubled the number of customers, doubled the amount of revenue. So I'll show you those numbers in a minute or two. We're now looking to do a pre-Series B raise, if you like. So prior to the recent pullbacks in all of the evaluations, we were looking at a slightly larger raise that would take us out into the US and North American markets. We were going to go after about 40 million. But having spoken to our advisors and given the pullback in valuations and the current challenges with the markets that everybody is familiar with, we decided we're going to go after 8 million US. So we don't want to dilute ourselves too much, but that'll give us a very nice little war chest to start expanding into some new markets. We are currently organically growing very strongly. We expect to double our growth again this year. And we still have about 18 months of runway, but we will be cash flow positive by Q4 of this year anyway. So we will continue to grow organically. We're in a pretty stable position. We're signing new customers very rapidly. Very, very exciting times for the digital banking space right now. So it's not only banks, of course, that we address. We address all kinds of customers in this space. They might be EMIs in Europe, which we have many of. In Australia, you call them an ADI, which is a similar concept of a financial institution that's not a full-on bank. We deal with PSPs and remittance companies in the space. So we have a complete suite of digital tools for an institution to be set up in as little as 1 month. And we've actually proven it and done it in Europe, where we've signed a new customer, put them live with a complete digital bank in as little as 1 month. Everything they need with KYC, AML, transaction monitoring, mobile applications, ready to go. So it's a really exciting suite. Happy customers. So this is a little overview. Obviously, Europe and UK have been our primary markets and still are very strong markets for us. If we look at EMI licenses, the UK regulator has issued something like 386 EMI licenses. Lithuania has issued about 80-some EMI licenses. We already have some of those customers on our books, but there's an enormous market for us to go after there, just in those markets alone. The gentleman who came before was talking about the Philippines. We've already got 2 banks using our solutions in the Philippines. We're working with many other institutions in the Philippines, and we will be putting some more of them live this coming year. Some savings banks, some co-op banks, some microfinance institutions who are using our digital front end to address the mobile economy. In North America, in Africa, we're kind of expanding out in a lot of different areas. But the key markets for us are really UK, Europe, and Southeast Asia. So Philippines, starting to get some traction in Malaysia, Indonesia, and we will strongly focus on those 2 markets. This is not a SaaS offering. So this is a license. Regulated institutions are very familiar with buying licenses, and traditionally they've been signing 7-year and 10-year contracts, and they continue to do that with us. And this is the really cool thing, that when we sign a contract with a customer, many of them are signing as many as 10 years. Our current average is 7.14 years contract. So it means that our revenues going forward over time are very, very predictable. Having said that, we do a pay-as-you-grow license. So it's a SaaS-like model where we start them at a very small package, and as they add more and more accounts or more and more payment volumes going through the system, then of course they're going to be paying more, but on a declining pricing scale. So it's great for these small startups and small institutions who can get on board with us, can be up and running for as little as about $200,000 to $250,000 US. So from a financial perspective, it makes a lot of sense. It's a very sticky product, recurring revenues, predictable revenues, but, sorry, I'll go back one slide. I think what's really important here is that 30% of our business last year came from customer referrals. Our customers are so happy with what we're doing, they're referring new customers. In addition to that, the product is a multi-tenant, multi-entity platform. So they can now offer embedded finance services to their customers downstream, which allows them to really become our salespeople. So we're growing both horizontally and vertical, and our customers are doing our selling for us. What do we address? They have a lot of challenges, these institutions, given the current disruption in what I call the new digital economy, crypto, lending, buy now, pay later, earned wage access. Many of these, traditional institutions don't really know how to address all of these things. Micro lending that the earlier gentleman was talking about. And so we can empower them with all of these things. But at the heart of it, the challenges are compliance, agility, relevance, and efficiency. And so these are the 4 things that we really address with this platform. And so, if those of you would like to know a little bit more about the technology, I'm not going to talk about the technology here today because it'll take too long, but we have a booth over there. Come and talk to us. We can explain a little bit more about how we address all of this. I've got 1 minute left to go, so we will quickly go forward. As I mentioned, multi-tenant, multi-entity. So some of our customers have multiple licenses in different jurisdictions. They can run it all on one software license, and they can then offer downstream white label services through embedded finance to other customers. So this helps us to grow very, very rapidly and letting our customers do the scaling for us. So this has been a very successful model. Key traction and roadmap, I've got a few seconds left. As I said, this is now in Australian dollars, just to make it easier for the Aussies in the room to understand what we're talking about. So seed capital, 7.6. First year of operations started in March of 2021 when we fully acquired the asset. In 10 months, we grew to 11 paying customers. We did 2.13 million in actual revenue. We raised another 9.4 Australian dollars in Series A. We had a very strong year last year, so doubled the customer count, doubled the revenues, 4.17 million of actual billed and collected revenue last year. This year we anticipate to do right around 8.6 million in Aussie dollars, or about 7 million US dollars we expect to do this year. 4.8 of that is already contracted, so the rest is coming from new customers that we will be signing as we go forward in the year. And if we look at that kind of aggregated recurring revenue for the next 5 to 6 years going forward, it gets us by the end of 2025 to 225 million enterprise value of contracts locked in and ready to move forward. So this is where we're at. This is what we've been achieving. I'll be happy to share with you all of these presentations. As I said, please come to the booth and have a chat with us. We have a really strong team. Again, white hair seems to be the theme today. We're not 20-something-year-old kids. I'm actually 62 this year. But we have a great board of directors who are sitting on ASX listed companies as well. So we've got a great team, strong governance. We're a public company in Australia, registered out of Perth. We're not yet listed, but we're public, unlisted, but that gives us great governance as we go forward as well. So what are the key reasons to invest? Solid, experienced team, mature, stable, full-featured product. The product is 20-odd years in the making. It's very, very robust, no bugs, no issues, no problems, and customers using it very well at the moment. Verifiable revenue growth. I can't make this thing work. Clear vision and business strategy. We're very clear about where we're going and how to get there, and we'll be happy to share that. Happy customers who are referring new business to us, which is really, really important for the growth. And it's a very high growth sector. There's so much opportunity out there for us. So let's go. Come and talk to us, please. Thank you.
Brilliant. So you guys got to hear from our amazing innovative companies today. That is amazing. Okay, so for our next session, I have the pleasure of introducing one of our sponsors, weConnect. As a leading provider of innovative communication and collaboration solutions for businesses, weConnect has been making a significant impact in the industry. It is my pleasure to welcome to the stage Matthew Kyle, the co-founder and chief commercial officer at weConnect, who will share his insights on the topic of international expansion more accessible than ever before. So, welcome, Matthew.
Thank you, Rhythm. So a few housekeeping items. I am 6 feet 11 inches tall. And yes, I played basketball, so now you all know. And you know why I'm here? I am not looking for money. I am here to hopefully provide a arrow in your quiver to help those that you know or help yourself grow companies internationally. And so, today I want to take people on an international journey. And, I think today we're going to go through the history of international expansion very briefly, and how it's changed over the years and how it hasn't, and what people should be focusing on. Thanks. And what people should be focusing on and what they should get help with. Okay. So international expansion used to look like this, with boats and stuff like that. Now it looks like this. Okay. So what's changed? So you still need money then. You still need money now. You need to still respect culture. It's big. This is a Finnish sauna. If someone invites you to a sauna in Finland, it's a good thing. It means business is going well. Kind of like coffee meetings here. Very big. In the UK, if they touch the nose, that means they're going to tell you a secret. In China, gift giving is huge. Australia, you guys love your coffees. I'll tell you what, I had 21 coffees the last 3 days. I'm still awake. You still need to align on strategies like you had to do throughout history. You still have to attract leaders and build a team. You still have to localize and do it right. So in the 1970s, Coca-Cola went to the Middle East. Their trademark logo looks like the Arabic for no Muhammad, no Mecca. So that is not a good job localizing. So do it right. So they changed their logo for the Middle East. Doesn't look like the trademarked one. Looks like the one in the middle there, which no longer looks like something offensive. And Pepsi went to China in the early 80s, and they had a slogan in America that said, "Come alive with Pepsi." And that translated into Mandarin, or someone translated that into Mandarin that said, "Pepsi will bring your ancestors back from the dead." And so you have to make sure that your localization goes well. These are things you should be focusing on. But what has changed? So having a local presence is easier than ever. Basically, you can go on to LinkedIn, pay $1,000 for a special program called LinkedIn Recruiter. You get all access to all the data through all LinkedIn. You find great talent. This is our UK office director, Cameron, and this is exactly how we recruited them. It took us 2 weeks. We had my partner, our CEO, reach out in a very spirited way, and he said he never would have responded if it wasn't our CEO. And then you have to secure them fast. And you can secure them these days on these companies called employer of record providers. Yes, we are one of those. There are others. There's probably about 100 there. And what they will do is they will hire talent in a country as if you had your own subsidiary there. As if you had your own PTY LTD in that country, they'll hire them. And so we do that, so you secure them fast. Now, if you don't want to do the recruitment yourself, then you hire someone like, a recruiting firm in another country to do that, and that's totally fine too. But what we've learned is that the million-dollar question is, when do you need a local entity? When is that? And so when you need it is, number one, when clients require it, when you want to invoice customers locally, so local transaction, when you want to prove your market commitment, when recruiting staff becomes hard, employer of record, not all staff is excited about that. They don't feel like you're going to take care of them sometimes, not all the time. It becomes too expensive because the employer of record company will take on liability and they'll charge you $500, $1,000, $2,000 a month to hire somebody. When you get to 50, that may not make fiscal sense anymore, especially in these days and age. money's a little bit more expensive. You want to take care of it. We had one client in India that was spending $500,000 to employ 100 people, and we said, why don't you set up an entity and pay $40,000? And they were like, huh. So there's, there's things to think about. If you want to distribute physical products, you need, and be the importer of record, you need an entity, or alternatively, you have a distributor, but that's not your control, that's their control. Your activities are regulated, like some of the gentlemen that came before me, their activities are regulated, so they need entities. But really, the overarching reason to have an entity anywhere is you have a long-term business ambition for a country. So if you don't have it in the beginning, you're going to have it eventually. So expansion execution is always harder than strategy. It's easier said than done. It goes along with the sailing. So we think you should focus on core tasks like talent recruitment, sales strategy and execution, and localizing your products and services. This is where you should spend the majority of your time and resources. And you should get help in areas like employing talent globally, managing foreign business compliance, and reducing your global tax bill. That's where you should get help. So optimization, expansion, from our perspective looks like this, just said another way. These are all the things that you guys are doing as you expand your business, or as your portfolio companies expand their business. They should be doing this so you can get your ROI. If they're doing anything in-house that is non-core, like these items, especially when it's the first people in that country, you may be wasting resources. And weConnect can help. So we basically are the only company in the world that does employer of record in 86 countries and also set up and manage subsidiaries. So we have we're the only integrated company doing both. There are a lot of companies doing one or the other. We feel that creates a bias towards their service. We feel that we are very unbiased because we can go either way. And then we introduce people to vetted experts. I can tell you, when I started my career in the professional service industry, my boss and I would go into a room with a client and we would sell something that we've never done before. And then I'd have to figure out how to do it. And that was not fun. So we, as a co-founder of this company, we tell all the people that join our ranks, we're only going to do things we're great at. And if we're not good, we're going to introduce you to someone that's great. And the reason that is because we don't care who has the contract for the service. We just want to create a great solution. So, for example, we can introduce you to the right firm in the right country that can do global tax strategy. That could be PwC, Deloitte, KPMG, EY, Grant Thornton, RSM, Baker Tilly. They'll make a tax strategy, and we can execute it, right? They are in the business of the strategy, the planning. We are in the business of the execution and doing everything as part of the strategy. So the biggest difference is for us, if we have the privilege to work with somebody, is as you expand country to country, we promise clients they'll never have to repeat themselves. So if you expand to the US, everything we set up there for you, all your talent, hiring your talent, all your systems for your accounting and your tax, and all this plumbing that comes along with global expansion, we're setting that up in the US. And then if you go to Germany, we don't have to ask you again what you want to have set up. But with everyone else in the world, you have to have that conversation again. Well, someone does, maybe not you, but someone has to have that conversation again. It's just wasted time. We give you one point of contact that manages all your compliance for the world. We use the same communication and file sharing platform for the entire world. China, Brazil, US, Germany, Japan, it's the same. It's not different by country. We use the same system. So for example, Xero is a really, really popular accounting system in Australia. We're the only company in the world that can use Xero in 86 countries, including China, Vietnam, Korea, of course the US, Germany. No one's doing that. We can apply the same process to each country. And again, like I mentioned before, we're the only company doing employee of record and subsidiary setup and management. So we are very unbiased in what we're telling you we think makes sense. 86 countries, and we just think that we want everyone to make international expansion headache-free with us. And that's it. Thank you.
Perfect. Thank you so much, Matthew, for providing us with valuable knowledge on how to successfully expand a business globally. We really appreciate your time. Our next speaker, who is also a sponsor of our event, is Auticon. As a leading provider of technology consulting services that employ individuals on the autism spectrum, Auticon has made a significant impact in the industry. Please welcome Bodo Mann, the CEO and Managing Director of Auticon, as he takes the stage to share his insights and expertise with us.
Good afternoon, everyone. Thanks very much for your interest. Also, I'm not here to raise any cash, at least not yet. So we will go through a global... Can you hear me okay? Is that all right? Good. So the second half of this year, we will go through a global capital raise, of which 15 million euros we were expecting, of which 2 million euros should come from the region here. So I'm the CEO and MD of Auticon Australia, New Zealand. And you probably haven't heard of Auticon, so the objective here is really just share with you a little bit what we do and maybe plant a seed to what extent in your business or any of the portfolio companies you might look at, you might be interested actually collaborating with us. So Auticon is a social enterprise. We are in 9 countries around the world. I set up Australia about 3 years ago. Last year, we opened up New Zealand. And our objective is actually twofold, right? On the one side is we want to create meaningful employment for autistic talent. So we outright hire autistic staff. And secondly, we also want to generate some genuine value for our partners. So we are not a charity. We are not a recruitment company. We outright hire autistic talent. And we are in a fortunate situation, there's some slides coming up in a second, a fortunate situation that we have a group of shareholders, including Sir Richard Branson, the Porsche Family Trust, 2 venture capital funds. So we are for profit, and those shareholders certainly are super supportive and helpful. So let me maybe quickly, so in terms of who we are, we tend to work, so we focus very much on technology. So, and within technology, there are 4 verticals. So software engineering, software testing, quality assurance, data analytics would be the third, and also we are in the cybersecurity space. And what does make us unique is, like, obviously we hire those individuals outright, but we have, in order to secure like an ongoing success and an outcome, we have our own psychologists and our job coaches, which are on our payroll as well. And we do not charge for that mission-critical support network. So that allows us over a longer period of time to make sure that obviously the individuals get trained. We also have some technical coaches on the mental well-being side as well as on the technology side. And we also coach not just the individuals, the consultants, but also the clients. And with that, basically, we're effectively riding the ESG wave, and we stand certainly for the S. And that has been going well over the last few years. And in Australia, you might appreciate the fact that we came a long way when it came to Indigenous or LGBTIQ or gender. So we feel the neurodiversity D&I space is the next frontier. And that's basically what we're doing. And so I might just jump over that in terms of what it is, but let me just go to the next one. So really what makes that a unique space to be in, and that's why it's not a charity play, it's very much around productivity and innovation. The ability basically having some explicit autistic strengths in terms of accuracy, the math interest, the pattern recognition, the ability to concentrate over a long period of time, that translates into those 4 verticals I just mentioned early on. And if you look at the benefits, that's why I meant it's not a charity. It is really actually a tangible value add. And if you look at the pandemic, there are probably not a lot of positive side effects of the pandemic, but one of them, certainly for us, is that we popped up on the radar screen as an alternative source for talent, particularly in the IT space. But if you look at the advantages in terms of, there's clearly like for our partners, productivity and innovation metrics, and some of those productivity metrics go as high as 140% if you compare a neurotypical individual to a neurodiverse individual. subject to you define the swim lanes well and you have the right support structure in place. But also from a social impact, if you look at the stats, you have like 34% of autistic individuals are actually unemployed. And the underemployment rate is like nearly 90%. So you have like a highly talented and skilled group of individuals who are actually not utilized from an employer perspective, from a society perspective, as well as individuals. So by tapping into that, you also take a lot of the pressure away from the NDIS because suddenly you have fully functional members of society who basically don't need the support they would need otherwise. And I mentioned the stats on the personal side, because what we see in all of our consultants, by having the situation being unemployed, a lot of those core existing conditions in terms of ADHD, anxiety, they obviously flare up if you allow for basically some financial insecurity with that. Yeah, so should you feel compelled to say this is an interesting D&I idea, please reach out to us. And certainly in the second half of this year, we might have another conversation in terms of when we grow into Asia. That's my mandate, certainly in terms of growing into APAC. Thanks very much for your time, much appreciated. Have a great day.
Brilliant. Thank you so much, Bodo. Your insights on how your company is harnessing the talents of autistic individuals to deliver exceptional technology has truly been very inspiring. Our next keynote speaker is Todd Forrest, Managing Director of NAV Ventures. Todd will be sharing his insights and expertise on how VCs identify and facilitate high-performing ventures in his keynote session titled From Investment to Exit. Over to you, Todd.
Okay. Well, no, that's right. I was going to sit. That's right. Okay. Thank you. So I don't have slides today, but so I wanted to kind of make it a bit of a conversation as well, and have a conversation and get some feedback and involvement from you guys. So who here, by the way, raise your hand if you're running a startup. Okay. How about investors? And then what else? What else we have? Bit of both. So I want to, again, title is kind of like From Investment to Exit, right? And so I want to talk through, I'll use actually a couple of examples, case studies to kind of walk through kind of the experience I've had and what's worked and what hasn't worked. And so it's not that different from all you investors, whether you're an angel investor or whether you're running a VC or private equity fund. Similar principles, right? At the end of the day, there are three pieces, right? One is have an investment thesis, and how do you find kind of the right founders and the right businesses? Number two, work with them. How do you actually grow the business over time? And number three, people forget about this piece, is actually how do you work with them to exit at the right point and right time? And so I'll actually talk through kind of a couple scenarios of where I've been kind of through that journey, and where it works and where it hasn't worked. So the first one I'm going to talk about is a company called Active Pipe, which is based in kind of Melbourne, Australia, but it started there. Actually, it's a guy that used to be a car mechanic. Didn't go to uni, but got into a startup and was going hard at it. So it is a marketing platform for real estate companies, right? And so the NAB thesis, NAB is a big bank, right? And obviously property and mortgages are a big part of all the banks' big business. And so for us, the thesis was understanding kind of the data and having the digital tools to buy property was a key thesis for us. That was really important. And these guys had developed the platform. Again, they had been around for 5 years before, but had really, kind of went sideways a few times and were up and down, but they finally started getting momentum. And so, two of the biggest real estate firms in Australia, which is Ray White and LJ Hooker, were becoming clients. They loved it. They hadn't rolled it out completely, but they loved the experience. And we talked to them, and they're like, okay, great. These guys are getting something right in terms of how they, again, their offices were using their
their platform. And so we took about 4.5 years ago, actually more than that now, but we took a 6% stake in the business. And we said, okay, great. So that was the first step. Hey, we had a great founder, great founding team. Now, what's the next step? We made that investment. Now, how do we help them grow? And so for us, again, as a corporate, we do the standard stuff that all the typical VCs do, right? So we help them actually, find kind of the right staff, right? So they had, to be honest with you, one of the founders' daughter was the finance person. And so we brought in a proper person from actually Catapult kind of sports. It was a CFO for a listed company. We're like, hey, this company's going to grow. It's smaller, but we're gonna bring over good talent. And that was a huge hire, especially the CFO roles at that stage. We also they launched into the US market. So they had big penetration here in Australia, but then they actually were launching into the US. And so we helped them develop a go-to-market plan of how to roll out, which kind of associations that mattered in the US. They even did a program called the National kind of Real Estate Association program, which actually took an equity stake, but allowed them to roll it out in the US. And then the third piece, which is we're a big corporate, right? And so we've got a lot of customers as well. So NAB actually owns or did own kind of an aggregation platform, which is Plan, Fast, and Choice, which are mortgage aggregators. And so we actually it wasn't immediate. It took a couple of years, but we actually that network has 5,000 brokers that in the system. And so we actually spent some time we had a tool which was it was actually Salesforce Marketing Cloud, it was called, but it didn't really work well for the industry, for real estate. So it was a generic kind of tool. So we thought this was actually going to be much better. We actually did some technical integration to make it super easy to pass the data along, and then rolled it out. And again, we were able to get eventually all 5,000 of those mortgage brokers onto the platform. So it really expanded their revenue stream. In fact, they grew from $1.7 million revenue to $11 million over several years. Combination of the U.S. market and kind of expansion. So that was the leverage piece. Again, we did that over several years. At some point, after 4 years, we said, hey, this business is doing really well. The big difference was actually it catapulted over. It actually was an Australian company, but then actually revenues in the U.S. became the bigger share of the business. And so we said, hey, we're doing a raise. We're going to really capitalize. We had about a 30 to 40% share of the Australian market, but the US was tiny. It was 1 or 2%. How do we accelerate this? And so we started a strategic kind of review and investment. And we hired actually a specific broker or advisor that was based in the US, but that knew the property space. So they really understood kind of who are the players that we should be talking with and where do we go. So we started as a raise. Eventually, it turned into kind of an acquisition, right? So we eventually kind of looked at it, and a private equity firm acquired the business, right? And actually merged it with a company out of Seattle, Washington called MoxieWorks. And I was just talking to the founder just actually this morning on something, and it's a great kind of piece where it's been 18 months now since the acquisition. But 80% of the new revenues that actually MoxieWorks has been driving the last year is via ActivePipe. So it's a perfect cross-sell. They've got a client base in the US that's really big, and they've been able to take this new digital platform and cross-sell it into their clients, which has been great. So for us, it was perfect, right? We invested when it was much smaller, and then 4 years later we sold it for 4x for our return. So it was a really good exit. So that's the first example I'll walk through. And again, open to kind of questions as we go or comments on other stuff. So the other one I'll talk through, which is actually a Sydney-based company called Basic. Has anyone heard of Basic? Involved in kind of open banking platforms. So we had a thesis here as well, which is when I started NAB Ventures, that we had data is really, really important, not only for banks to understand kind of their customer base and what we can, what sort of products they need, but then other fintechs and how they can use it. So this is before there was something called CDR or open banking. So Demir was very much into it. He's again, he started with screen scraping, but the idea was we have to understand these customers as there's data out there. Players like Plaid in the US and Tink in the UK are already doing this. He became kind of the leader in this space in Australia. So that was, a brilliant founder as well. It almost, when the founder pitched for me, we had this thesis and he was presenting it exactly the same kind of themes that we were thinking about and talking about. And so then the second step is how do you grow? How do you support them? And again, it is like it's like a marriage, right? I'm an investor in another company where I'm an angel investor called Design Crowd, which is a Sydney-based company. I invested 15 years ago, and it's done really, really well. Its valuation is 35x of what it was, but it's a long journey. It's a marriage, right? Like it's in private investments. What's that? It screws the IRR, exactly. The 15-year piece, that compounding piece is a challenge. But anyway, so it's a marriage, right? Like it's and so with Demir again, we're an investor. I sat on the board for the last 6 years, and so we introduced them to different parts of the bank. And to be honest with you, like it didn't work every time, right? Like it's we pitched them into the bank, and then like Proviso won. Proviso is a competitor in that space. They won on one certain kind of deal. Look Who's Charging, which is another kind of business, kind of an understanding kind of data, enhancing kind of like the merchants. They won another deal. And so it was a challenge. Not everything worked, but then actually during COVID, we realized like, oh my God, especially for the bank, we're really worried. People are going to be losing their houses. They're going to be calling us up. And how do we deal with that? Especially kind of post, kind of like when we were coming down from COVID. So these guys actually developed a special product, affordability product, so that when people called in, the agent kind of, or the banker working with them would know kind of like what their capacity is, how long we could extend them for. So if we already put them on a hold, to freeze for 12 months, they're coming out of it. Okay, now really understanding their financial position, and Basic actually provided and developed a product that matched exactly that solution. So that when the bankers pulled it up, they could understand what their financial position was, how long did we have to extend it, did we have, is this quite likely to blow up on us? So that was one good kind of use case. The second one was with our UBank division. So we kind of plugged it into UBank, understood kind of people's spending patterns, and then created nudges around them, kind of traditional PFM kind of like tool and solution. Which again, that was really big. Actually, UBank was the number one client, or number 1, 2, or 3 client for the last like 3 or 4 years. So big end of town, being able to bring them on board. The other thing we did, so it's not only introductions, but then we actually kind of said, as an investor, we want to bring other investors along that can also help out. So we were the first investor along with Reinventure, but then we said, hey, at different stages, because we followed on investments 4 times. there were actually four investments in total. So initially we brought on Salesforce Ventures, which again, they could cross-sell it through their platform. And then we said, okay, geez, there's this company Plaid in the US. We're able to introduce them and bring them on board. So they took a small equity stake. Then eventually Visa and Touch Ventures, which is Afterpay Ventures, also invested. So each one along that journey, it's really important as an investor. Part of what you provide is cross-selling, but also like what is the next logical investor? Who are the synergies for that? And so we do think, actually, even when we make one investment round, we think of like, okay, who's the next logical investor that would be good to bring on board? Is it Ron from 1835? From ANZ, or is it a Salesforce Ventures? Are they going to go to Asia or Europe next? Is there a logical kind of next investor? So we do think about that as well. And so we actually, again, it's interesting. The exit, and the third piece is exit, and how you kind of approach that and go about it. And so with Basic, it is one you don't start with. I advise everyone, every startup, don't think about the exit from day one, because you can't plan for it. Right? You can have certain themes of like, okay, there could be these types of investors, in, retail space, or, hospitality, or a bank, or insurance company, et cetera. Have themes, but again, don't build your product for a customer base, because the acquirers, you don't know it's almost impossible to predict who the acquirer will be in the end, and it changes over time. There have been several situations where I've been involved in a company, and we had actually acquisitions opportunities early on after 3 years, and it ended up being 5 years later, it's a completely different set of acquirers. And so it evolves over time. So don't build for the customers, not for kind of an exit. And so we started this process. Actually, I had lunch with Demir back in June of last year, so like 9 months ago. And we said, hey, the business has gone really well. It's done great. You guys are a leader in the Australian space, but how do you continue to grow really strongly. And so we actually started the conversation of like, okay, we got to think about a strategic round, and who else is a logical kind of player. And so we kicked that off again back in June. We kind of started talking to folks. The market was actually tanking in the meantime. Again, anyone who's tried to raise money in the last year, it's been a challenge. And so we're like, gosh, geez, this is going to be really challenging. It's going to be, everyone has come off. No one's investing. A lot of companies were pulling back. Valuations were receding, et cetera. Well, we started a process. We got the right alignment. Still CDR and open banking still got a lot of visibility, and it's the right space. It's a hot space. In the end, we actually ended up getting 5 offers, which was great, and 3 that were actually full acquisitions, and then 2 that were strategic investments. So that certainly helped the process. But eventually, we announced actually last week that Cuscal is acquiring the business. So a lot of the business, again, like big banks are users of the platform, but where it's really driven it is in fintechs. So all the fintechs in Australia, they primarily use Basic. And so we found Cuscal was a great kind of path, which is, again, we announced literally last week that they'll be acquiring Basic and continue on. They have a great ability to kind of cross-sell into their fintech base. So yeah, and so that was great. We actually, again, over 6 years, again, well, IRR reduces, but it was 8x our original investment, which was just fabulous. So I think we're almost done with questions. Yeah. Yep. How big is it when we entered? How big was it when we exited? Yeah, so it was it was really small. I mean, it was Demir and 8 people, but they didn't have any revenues. They really hadn't launched a product yet. And then at the end, they were actually, again, they didn't have huge revenues, but they're the leader in Australia in terms of like they have like 100 fintechs that are using the platform, as well as a bunch of big companies. So it really gone from 0 to like a decent number. Any other questions, comments? Yeah.
Why is the right time to exit? Why is this the right time to exit? Basically, because the CDR is still rolling out.
Yeah, it's a good question. The board, as an investor and a shareholder, you always in a board, you have to kind of evaluate what is the right time. For us, like it's because it's a challenge, right? Because the CDR space is still taking off. The question is, can it do it as a standalone, or can it do it with capital and kind of like cross-sell opportunities, which is what Cuscal really provides. So I think like it had grown well. We think it can grow like that, again, with the right support. And that's probably the right place for it. It's a combination of like resources and dollars. Any other questions? Yeah.
Hi, Todd. What are the top 3 things you look for in an investable venture?
Yeah, so it's again, it's got to be a product that's easy to understand and is 10x better, first of all, right? Because doing 20% is not a venture investment. It's like it's a nice thing. Number 2, founder, real passion and commitment, but also willingness to like pivot or evolve their business, not so hard. And then number 3, like just a marketplace that's big enough, right? And for us as well, like as a strategic investor, we look for the strategic angle. How can we accelerate it? That makes a big difference. So, one case actually was just on a panel earlier. We invested several $1 million into a company, and we actually signed an ARR deal with the same amount. So $4 million equity investment, $4 million ARR deal. Guess what? The $4 million equity is good because they need that to build the product, but $4 million ARR just doubles the value of their company on day 2. So I think, again, as a strategic, we look to how can we actually accelerate that growth. Yeah.
So I came late. I'm not sure if you have already covered this, but as an ongoing investor, so what are some of the support services that you provide so that your portfolio company goes out there and meets the certain objectives?
Yeah. So again, we want to do certain kind of VCs will have a whole VC platform. For instance, hiring staff. They'll actually hire kind of recruiters. For us, again, we do some of that. We make introductions because we know, for instance, we have a tight relationship with a lot of the US VCs. So for us, that's a unique kind of piece. We can bring them to the US market, get funding and kind of deals. But so we look for the value added kind of pieces that we can do unique. Again, we probably we don't do the recruiting because I'm like, oh, other people can help you with that. But what we can do is help you get into the parts of the bank. That's probably the biggest piece. You know, you can go to UBank or NAB or BNZ or JB Ware, different parts of the bank where like, okay, wait, there's a potential fit here. We could use you here. And more importantly, not only use you for the bank, but use you for our customers, right? That's actually where it's really valuable is we've got a couple investments where we actually, again, it's perfect if the bank uses it. Great, like a crypto capability. But then if we can also roll that out to our customers, that's doubly valuable. So, yeah.
Do you also support companies who want to build sustainable businesses and grow the company as opposed to just exit?
Yeah, I think so. Again, we don't look at exits as a solution. In fact, as a corporate investor, we don't have a hard 10-year time frame, so that gives us a little bit more flexibility. You know, if the company's still around in 20 years from now, doing well, the founders are happy, we have a partnership, we're actually we're happy with that. So we don't have in some ways, not having a time fund, a fund that has hard time commitments, it's all right. Eventually, at the end of the day, like most founders will look to and most investors, it does create an issue. If it's going to be a lifestyle business, you probably shouldn't be raising venture capital, right? Like if someone's going to never sell it. But I think it's tough to anticipate kind of when and what the right time of the exit is, which actually does create issues. The one recommendation I have is for startups or even investors, when understand the expectations of the new investor who's coming on board. What is their time frame? What is their plans? What are their desires? Because I think like it gets when the capital stack gets really complex, you actually have very competing views. Some companies, some will want to sell. And there are opportunities now with the secondary markets in Australia, second quarter ventures and other players. There's now a secondary market, so you can get out of the business. But like actually, it creates a bunch of issues. I've been on a few different. I was CEO of one company that we had parts of the shareholder base had completely different views of what they wanted to do with the business, and it became a huge challenge. Primarily on kind of like the exit time frame, which is, you know, you can't manage it completely, but at least go in conscious of what people's expectations are. So, any other final questions? Come on, Ron, you got something? I think my time's up anyway. I'm over. Great. Thanks.
Perfect. Thank you so much, Todd. Your talk on the journey from investment to exit was truly very enlightening. And we have learned a great deal from your experience and expertise in this field. And we really enjoyed the Q&A as well. So now I would like to let you know that we are stopping for just like a quick break. So please come back in approximately 20 minutes because we have company presentations lined up. So after the break, we are going to start with a session from Barry Moore, who's the Managing Director of Digispectro. And then we also have a very insightful panel session on the great transformation, AI sustainability, and deep tech. So I will see you all back here at 3 p.m. Thank you. Amazing. Thank you so much, everyone. I hope you all had a good time at the break. It's now time for the company presentations from a fantastic group of founders. We're excited to kick off this session by welcoming Barry Moore, Managing Director of Digispectro.
Thank you, Rhythm. I was hoping for a bigger crowd, but we've got to work with what we've got. I am Managing Director, Barry Amer is my name. I'm Managing Director of Digispectro. That's what the slide says. It's not moving. Am I pressing the wrong button? Where is got it. That way. Got it. We are, as the slide says, we manufacturers of a scanning device. We initially focused on cosmetic and dermatology applications. But our scanners can be used for a wide variety of color analysis applications. For example, paint. In our software, we have the vast range of Dulux and Taubman's colors. So for demonstration purposes, we can scan a wall and tell you which Taubman's or Dulux color is. But initially, as I said, we're focusing on the cosmetic and dermatology applications. We believe that the cosmetic market represents a significant initial opportunity, and having attended cosmetic trade shows in various places around the world, we have developed an extensive prospects list of, and initially, that is, the prospects are generally retail cosmetic chains, but also manufacturers of cosmetics. For example, manufacturers in Germany and France, and also dermatology groups in various countries around the world, strange places like Saudi Arabia. And so very, very much we're focused on business to business type. The design of our, while our scanners are technically unique, we're also very proud of the Apple-like design, for which we received an Australian Good Design Award to acknowledge the design aspects. It's difficult to have a competitive analysis because our products are unique. Our scanners are unique. And while there have been various devices used in cosmetic applications, they are basically photographic devices and take a photograph of skin and then do a lookup table against various cosmetics, whereas our spectrophotometers are unique in this format. We have overcome some significant component sourcing issues which were created by the pandemic. We were basically ready to go to market in 2020, but we were unable to source all the components we needed. We've been through an extensive process. Sometimes we had to replace some of the components with alternative components, redesign a printed circuit board. subsequently, but we're now in the situation where we are ready to manufacture. We manufactured a number of, we've manufactured 200 odd units of sample sales, and we are manufacturing 100% in Australia, both for the electronics in Adelaide and for the injection moulding in Brisbane. And the funds we're seeking to raise are specifically for that manufacturing, so we can meet the demand that we've created. The level of interest and requests for volume quotation, for example, as I mentioned earlier, cosmetic manufacturers in Germany, for example, requesting quotations for 1,000 units at a time, has given us a lot of confidence in that we can generate significant revenue, and given the potential sell price and the cost of manufacturing, which we've now determined, we are confident in a significant revenue and profitability. And as I mentioned, the current status is we are ready to go to market, and we're looking for, we need to be able to go to trade shows, and where people request quotations for large volumes of units, we can not just give them price, but we can give them delivery. We can quote a delivery time, and that's we're at that point right now. And our team, I've personally been involved in a number of founding a number of companies, all with an export focus, and there have been a variety of software companies, manufacturing of different, mostly in the IT industry. And my background is as an engineer in industrial applications. Don is an expert in colour and is recognised so around the world, and corresponds with professors in different universities on colour, and really is the expertise behind it. And David Merson was the manufacturer of Mincom, which is Australia's biggest homegrown software company, and it's specifically for the mining industry, and is very well connected in government circles, and has and once again is involved in export-focused business in a software company. And there's another slide. Oh, that's us. That's it. Thank you very much for your time.
Thank you. Next up, actually, we have Jim McCurley, the CEO of Kendo Way. He's the father of Michael McCurley.
Good morning. Well, there you go. Good afternoon. Michael, my son, was meant to be presenting this. Guys, we need to turn the hearing aids up. Hey, thank you. So at 8:30 this morning, I get a phone call from Michael. Dad, I need a favour. He's in bed with a shocking flu and throat, so I've got thrown the job of presenting this. So I just wanted to introduce Kendo. Let me start with the reason we're here. We are raising capital. We are halfway through a $1.5 million raise. When I say halfway, we've got 200 committed and 500 tentatively committed, and we're closing that out shortly. So everything I'm about to tell you is to excite you about the opportunity we have with Kendo. We're also an ASIC qualified investment, which is pretty tasty if you're paying a bit of tax. Okay, so business problems, business success is typically a result of strategy, execution, and success. At least that's what the management books tell you. There are two other elements that need to be added to that equation. Capital, we can't do it without money, and the core ingredient is people. And the right people, you need the right people for the projects to get to where you need to go. And as Steve Jobs rightly says, ideas are cheap and dime a dozen, but it's execution that's worth the millions. And the Kendo product is about helping organisations achieve their purpose by ensuring that they execute on their plans, and that's what we do. So we're going to look at the execution problem. Why do organisations have trouble executing? Because I think if you look at most business plans, very long on strategies, tons of research of what we've done and industry analysis and opportunity and all the rest of the stuff. Where are the pages on how we're going to execute this? Generally doesn't exist. Generally what happens is it gets thrown out to a team somewhere and say, here's the big, hairy, audacious goal. You go and sort of break that up into detail and allocate it out to people and execute it. And that's where the train wrecks can start. And one of the reasons for that, and one of the reasons of their execution problems, is there's a lot of different stakeholders within a business, all of whom are people. There's the organisation, the company itself, with its shareholders, with demands, with making inquiries, with pushing you around. There's the board, who have got their, gonads on the block. And if something goes wrong, they're in trouble. So they're very agitated and active and trying to understand what's going on. You've got the executive team, the CEO, and her team, that's trying to actually control the execution. Then you've got HR, whose interest is in helping getting people to grow and recruit them and all the rest of the stuff. Then you've got the teams themselves that are actually sometimes unilateral declarations of independence that do what they want to do, irrespective of how well it fits into the big picture that you're going for. And at the end of it are just individual people who come to work, look to get some satisfaction, make a quid, and get some growth from it. And there's been a big change in the workplace about what those people want and expect from their job. So in this, there's lots of players that can create lots of problems. And the analogy we use, and the Kendo solution, is very much like an orchestra. If you look at an orchestra, there's up to 100 players. And they have to come together to produce that exquisite experience of the symphony. But 100 different players. And the secret to that is each player has their particular piece that they have to play that they see, and they see it in the context of what the overall symphony is about. And Kendo is very much what Kendo does to organisations is what that does to the orchestra, that gives everyone a very clear understanding of their role, what they've got to do, and so that they can deliver that exquisite outcome. And that's what Kendo does. Now, we'll show you a little bit about how, but just a little bit of insight into some reports that come out of Kendo. And this is important because it shows how we think about things a bit. There's actually two diagrams on that page, so think there's a divider in the middle. The one on the left is saying we've got a big, hairy, audacious goal, the yellow bit, and it will be broken down into 3 or 4 things it's got to do. We've shown one there, and that one gets broken down further and further and further. And to assess the success of that goal, or the ability of the organisation to deliver that goal, you've got to cascade it out and see and allocate accountable responsibilities to people, and then periodically, monthly, measure how well people are going and doing their particular part. This is no different from a football team coach who gets the stats all the time about what individual players are doing. And I don't know if you've followed football for a long time, you'll remember once upon a time they'd tell you the score. Now they tell you bloody everything. How many tackles have been made, how many drop balls, how many turnovers, and it's just endless information. It's all data. So the left-hand diagram is digging down into the data. Right-hand diagram quickly provides a risk assessment of what's the likelihood of a particular objective being achieved. and it's a clever little diagram, and I say that because I created it. Lots of rings, and each ring is a time frame. The bubbles on the ring, the size of the bubble tells you how meaningful or important that is to the core objective being achieved. The colour tells you the status of the event, and where it is on the ring tells you how long before that happens. Now that, for any objective that's in Kendo, you can have a look at that and you can get a risk assessment of what is the likelihood of that actually being delivered. I'm running out of time here. Are we precious about time? Okay, no, obviously. Where does that information come from? Everyone's got their objective. There's a pulse check. The pulse check collects the actual information, does the pulse check which says, okay, how is this going? The employee or the individual makes some comments about why they think they went well or didn't go well, and the manager provides some comments. And because it's all about, in the workplace, it's about interaction and help, if there's any action items that have got to be generated as a result of that discussion, a result of that pulse check for that objective that month, they're made and they sit there until they're completed. So we're managing the execution of these plans right down to the detail. Sprinting along, we can use those same objectives to calculate the STI. It needs to be transparent, needs to be fair. So if you nominate what objectives are important in calculating bonuses, performance bonuses and public companies' STI, then that becomes critically important. We also, two dies on this, we also have a capability assessment, which is the one on the left that says, for the job that I've got, this is how well I'm prepared to do that job. And they're the little speedo scores. That's pretty important because that tells a person, here's where I've got to develop and grow. Right-hand one is the overall view of the organisation, and it can show where things are, where we're up to, and gives you a talent profile for the whole organisation. For boards, we can use the capability assessment to develop a board's skills metric. If you're a public company, reporting and having a skills matrix is an absolutely compulsory part of governance. The board can also set its own objectives, which it can be measured. So this governance aspect can sit over the top of the board and over the top of the company. So often you get alignment in the business, but there's not alignment with the board. This brings alignment with the board into play. 3 classic case studies, very big ASX companies. Essity's 18 billion global turnover. What do the case studies show? We deliver alignment, we deliver productivity improvement, we increase engagement, reduce costs, and we increase profitability. And our go-to-market plan is there. You can read about it. I'm very conscious of the time I've taken. We've got about $3 million in the pipeline. We only launched 3 months ago, effectively, so we sort of cranked it up and got stuff going there. We have got a cracking team with expertise. I've chaired 4 public company IPOs in Australia, so I think we know what we're doing. Our business model is as simple as possible. It's classic SaaS. You pay per month per employee, and you can look at that, but there's nothing to it. We're asking for $1.5 million. We've got about half. What are we going to spend it on? I've spent $7 million building the product and put in 5 years. The predominant use of this money is to develop channels to market and to grow those channels to market. And thank you for indulgence in running a little bit over time. Thank you.
Thank you for that presentation, Jim. Next up, we have Jens Bonwagner, CEO of xSQUARE Technologies.
Yeah, good afternoon. I'm happy that the room is filling up a little bit. I hope it's not only the other speakers. So my name is Jens. I'm with xSQUARE. xSQUARE is a Singapore-based company. We are building solutions for intelligent warehousing. And what does that mean? Do you see anything? Oh, sorry, I paused it. Where's the next? Oh, here you go. So the future of intelligent warehousing, what does that mean? We want to we are going to allow the goods in the warehouse to flow like water. That means frictionless, smooth, and efficient. And we understand that in order to do so, we have to integrate a lot of moving parts within the warehouse. Machineries, robots, other software, IoT. So this is where we are focusing on. If you look at the landscape of warehousing, there are a lot of issues that operators facing nowadays. Rising labor costs, shortage of manpower. Now this is a global phenomenon, not limited to warehousing, but nonetheless, warehouse operators can't find the personnel to operate their forklifts and so on. So automation is definitely a solution here. One of our key focus points is the lack of interoperability nowadays, or historically. That means operators buy machinery, a little bit left, a little bit right, nothing works together. Human intervention is still required. We are closing this gap with our products. And I skip ahead a little bit now here. So our solutions, we have two main products. One is our autonomous forklifts, our robots, if you want the muscles to move the goods physically within the warehouse. Now these are palletized goods that our robots can move. And the model range we have covers everything you need. We have pallet stackers, we have reach trucks, V&A, tow tractors, counterbalance forklifts. Whatever a warehouse operator may need, we have the robots based on these machines. The specialty of our machines is they are very precise, down to 1 centimeter precision. That means we can execute tasks that others can't. We can operate in tight spaces where other competitors require the operator to widen the spaces. We can go in with the existing layout of the warehouse, which is a big benefit because if operators have to redesign their warehouse, that's associated with a huge cost. Even more important is our second product, the warehouse control system, and it's actually much more than a simple warehouse control system. We use this to integrate everything in the warehouse. We integrate our robots, obviously, that was the first integration, but we can integrate other robots from other vendors. We can integrate doors, simple elements like doors or IoT devices, conveyor belts, storage systems. We can integrate with the warehouse management system or ERP systems. Now, once all this integration is done, we can orchestrate, execute transport orders across all this machinery to allow the execution of these transport orders and movements of goods without any human intervention, end to end, achieving true interoperability here. And the third component here is the optimization. If you have more than 2 or 3 robots, optimization becomes an issue. You need to make sure that your robots are not queuing up, waiting for each other, or blocking resources that are required for other tasks. So optimization is required here, and it can give the operators a competitive edge over their own competition. If you look at our numbers, especially after COVID, we see a huge increase in revenue. Companies have realized they need to automate. For example, risk management for the next pandemic is a huge concern. But I mentioned earlier, many customers come to us with problems. They can't find the labor, the human operators, and automation is a natural solution here. Our customers, just a few examples here, our main customer group on the top row is MNCs, GSK from the UK, pharmaceutical, Cato Nazi is a chemical 3PL from Belgium in Europe. The beverage giant is worldwide the biggest. So these are MNCs that we are focusing on. We have deployments with them in Singapore at the moment. We started in Singapore, so all of our deployments are in Singapore. We also serve SMEs, bigger SMEs like ST Logistics. They are operating a government warehouse in Singapore. Our growth strategy, MNC engagement, I mentioned this. There is a huge lifetime value for us. MNCs usually start in a small subset of their facility with automation, and once they see it works, it gives them the benefits they are looking for. They will expand, and we can provide them with more machines, with more solutions, with more integrations. MNC definitely is one of our main focus points here. Then in terms of functionality, we are implementing right now autonomous container loading and unloading. That means our AGVs, our autonomous forklifts, will be able to unload the palletized goods from the shipping containers and load the shipping containers with the palletized goods, which is currently a huge gap, especially for brownfield warehouses. There are huge solutions that do this in one go, but forklift-based solutions, autonomous solutions are rare, and we are closing this gap. So this is something that we talk to many customers about, and 90% of them want this yesterday instead of tomorrow. So this is a very exciting feature. On the other side, on the right side, we are collaborating with Mitsubishi LogisNext. Mitsubishi LogisNext is one of the top 3 or 4 OEMs globally for material handling equipment. They will distribute our products through their dealership network in Asia Pacific. So needless to say, this is a huge opportunity. And we are going to start together here in Australia. That's one of the reasons why we are here. We are looking for investment, additional investment, but also we are preparing the market. We are looking for customers and other partners. We are currently raising US $5 million in the current round at 23 million valuation, and we are going to spend this an additional $1 million on the container loading, unloading feature. It's a complex feature. It will take another year to be completed. We have started development already. Another 1.5 million on other R&D, machine learning, AI for the warehouse control system. Marketing and working capital we spend some money on as well. In terms of management, we have a very senior management team. We have the domain knowledge. We have 25 years of domain knowledge through Keith, our co-founder. He has worked in the material handling equipment business, as I said, for 25 years now. We have built our products exactly to customer requirements, to market needs. So the market fit is built in right from the start. On the left side, Arthur Chua is our chairman, strong strategist with a big company background in Singapore. He's leading Goldbell Group in Singapore, one of the market leaders in leasing of commercial vehicles and forklifts. And myself, I have worked with startups for my whole career, always building products, bring them to market, and sometimes even successful for the exit. All right, 1 second over. Thank you very much.
Thank you for your presentation, Jens. Next up, we have David Christmas, the managing partner and founder of DataBench.
Thank you. Did we work out the direction of the buttons? Yes, no?
The right one.
Oh, the right one. There we go. Good afternoon and welcome, everyone. David Christmas is my name. I'm the founder of DataBench. Thank you for joining us this afternoon. So our goal here today is to meet and talk with as many people as possible to sort of pique your interest in a possible investment with us, and to perhaps prompt some further questions so we can carry the conversation over. So to sort of help ensure that we're facilitating that for you, so I'm just going to share just enough information for you today to understand that, and we're available this afternoon and tomorrow to carry on the conversation for anyone who's interested. So founded in 2018, we watched some global trends occurring in the UK and EU around companies responding to GDPR and the data privacy compliance burdens that was proposing for businesses, and also across into the US and how that market was being affected. And what we found was some very common trends that were occurring worldwide, and that was based around companies that were choosing to automate their response to the legislation. We're seeing their costs certainly their OPEX go down and their risk profiles were going down and they were being compliant. Companies that were looking to not automate their solutions were seeing their expenses rise across the board. They were breaching their compliance obligations and they were getting fined and they were being hit with enforcement penalties. So we saw that trend occurring worldwide and we decided that we wanted to bring that to Australia. So in short, what we've done is we've automated data privacy compliance, and that's what we brought to the Australian market. So what does that problem look like, to give you the context? So it's a series of events that have occurred over a number of years, and this is a global problem. So what we're seeing is companies with expensive legacy old architecture in place that effectively is all pre-cloud built. We're seeing companies with a very chaotic arrangement of sort of share apps and shadow IT that's sitting on employees' devices and laptops and phones and so forth. And we're seeing that IT have pretty much lost control over where all this personal data sits. And they don't know how to access it, and they certainly don't know how to delete the legacy stuff. So this is also coupled with rapidly expanding privacy laws. So we're seeing security and compliance as an afterthought that's being applied to this framework that was never really built to meet security and compliance in the first place. So it's this sort of perfect storm of issue that's coming to place. So what's the current approach in how to address this? Well, I think that slide says a few words. So really the approach is the big four, and they come out from a consulting perspective, and they don't offer privacy enhancing technology. They offer a lot of body shopping and consulting, but the actual privacy specific technology that's needed is just not available. So that's where we come in. That's our point of difference. Just as a point to note, their revenue in 2021 on consulting alone was $8.4 billion. So we think there's a fair bit of movement in that space. So what does this solution look like? So we've stood up technology here in Australia over the last 12 months. And what it does is it maps all existing personal information across all known data sources, whether that's on-prem or off-prem, whether that's structured or unstructured data. We can find it for you. What we do is that we then actually take you through a process of eliminating old legacy data, information that's no longer required, and then we can start putting process holds around the information that you already have. And that means that we can also start putting observations around the data that you've got in place. What do you need to do with it? Where's it moving laterally across the organisation? So why is it moving from a secure location to an unsecure location? Why have you got dual logins? So we can serve up notifications around potential ransomware activity. So why is this information being accessed that doesn't normally get accessed? And suggest protocols around how you can address that instantly in real time, without having to wait for 4 or 5 or 6 days for IT to understand and respond. We can also face the direct-to-customer obligations, so we can automate that process. So someone can now put an access through to a business, an access request through to a business and say, can I have a copy of all my data? What are you holding on me? How did you get it? What are you doing with it? So we can automate that entire process. Why now? I think that slide probably says quite enough there. And also the key proposals that are in place at the moment with the Privacy Act reforms, and certainly with potential exemption for small business being lifted, and we're also seeing a lot of businesses get worried about what might be the future implication of employee and HR related data. So think about salary reviews, think about performance reviews, think about resumes on file. All that sort of material is all coming into scope. So what does the market look like for us? So we're currently going out for the Australia-New Zealand small to medium business market layer. But more importantly, that medium layer of business currently represents around 51,000 businesses. And if we were to go after just 2% of that market, we've identified that there's space for 1,200 new customers over the first 10-year period. Now, if we wanted to scale up and ramp up our efforts, we could certainly see some increases in that, but we think that's probably a relevant starting point. And we've calculated that with recurrent revenue, that we're going to be looking at around about 50 mil rev by year 10. Competitor analysis. So currently we're the first to market here in Australia. There are vendors that do similar type of offerings to us in the UK and Europe with GDPR, and also in the US, but none of those vendors have actually made our shores yet. It will change, it will occur, but considering we're talking about an economy-wide marketplace, we feel that there's space for other vendors to enter the market. So for now, we have 0 competitors in the marketplace. So what does our business model look like? Well, currently we represent what you might call a wide moat business. We're backed by regulation, we're first to market, and we're looking to set up annuity-style revenue that'll have multiple year contracts in place. Our technology is stood up in a local Azure environment that we control, and we're delivered through several methods, and that could be a SaaS offering, it could be larger models where we do a data under management. We can white label, we can go in behind firewalls for businesses that may not have the appetite to send the data off. So we've got a number of configurations that we can offer to put into place there. So that's just an overview of sort of a schematic for people that may want to have a look at. But current position, so speed up growth is our main driver. So what we want to do is turn our pilot pipeline, which is full at the moment. We're not looking to increase it. We've got about 6 businesses in there. We'll probably select 2 of those to go to pilots with. So we want to then turn those into our first revenue customers. So we're on the cusp of first revenue. So we expect that to change within the next few months. We've got our strategic profile sorted out, our go-to-market. We're looking at some national advertising campaigns. We've also got 6 patents that we're looking to finalise and put those into development in the second half of the year. And essentially that's what our capital raise is about, is to help us kick off all of those components. And finally, this is our founding team, myself and Ben. We're both Brisbane-based. We've got an advisory member that's based out of Melbourne, who's one of the leading privacy lawyers here in Australia. So feel free to follow us, look at us on LinkedIn, or there's our website there with a lot of information on it. That's us. Thank you.
Thank you so much for your presentation, David. Next up, we have Andrew Whitney, founder and CEO of Ferret Tools.
Thank you very much. Good afternoon. Oh, there we go. It's even up there. So Ferret Tools, we're a hardware company. We produce multi-award-winning technology. We've designed and manufactured a small inspection camera, and we're selling this globally. We've been in the business for 10 years. We've got 130,000 cameras out there on the market. We're looking to grow. We're looking to grow faster. We are growing. So what's the point? What's wrong with existing inspection camera technology? Well, it really just hasn't evolved. Normal inspection cameras, just like that, bore scopes, very limited reach, very limited functionality. Yeah, they're good for some things, but they're really not good for seeing in enclosed spaces. So what we've done is we've created the world's first true multi-purpose wireless rechargeable inspection camera. It's sort of like the Swiss Army knife of inspection cameras. It came about when I used to manage a data cabling business in Adelaide about 15 years ago. We had a lot of electricians trying to do cabling in enclosed ceiling spaces and not being able to see what's up there. So I just realised at the time there had to be a better way, and the Ferret was born. So our vision was creating the future with new thinking and innovation in smart inspection camera technology, and that's exactly what we've done. We've got a number of models out there to different price points and different markets. So play a video. This best shows how the camera works and what the product actually does. So we do have a lot of awards. It is award-winning design. Everything in the camera is purpose designed. We have 2 main models that we sell into the electrical market, which is core. So an electrician can push it up into a ceiling space, see what's up there, find and grab a cable with ease, see in enclosed spaces that were never before visible. Spaces like this, it's basically before the Ferret, it was impossible to see inside. So electricians are our core market. So this shows an electrician being able to push it up into a ceiling space. This is the view from the app. Find a cable, hook the cable and pull it back. Previously, the only way to do this was fishing blind. It's a safety device as well. You don't always have to climb a ladder. So you can see part numbers, serial numbers. Home inspectors are a big part of our market in the US. We have a little magnet on the front for people who have dropped a screwdriver, dropped a tool, anything like that. So really a multi-purpose device. I wouldn't really want to get down there by the looks of it. We've just started selling into the marine industry in both the US and Europe. This is a video that one of our marine resellers put together showing some pain points for some of their customers. Just being able to get visibility in areas that were not visible before. It's a transducer for an echo sounder underneath the boat. Just seeing what was out of reach. Here, looking to see a wiring loom, once again, looking to see what was out of reach. So the only product in the market that allows you to do this. We find a lot of new uses and different uses from our customers. Here we're looking behind a motor, hopefully not finding a leak, but being able to inspect. We've made some other adapters for our camera. Rather than getting out your $2,000, $3,000, $4,000 inspection camera for plumbing, plumbers can now use this for a really quick look. Here we're checking in a sewer to check whether the flow is coming down where the plastic pipe meets the clay pipe. So this was a sewer inspection which saves time, saves money. Or tank inspections, which is another market that we're selling into the US. This one's in Australia, I believe, checking bird boxes. So many uses. It's a true Swiss Army knife of inspection cameras. Little guys are huddled back in the corner. This one we saw on TV, border security in the US using it to look for drugs inside cars coming across the border. So we were quite excited when we were watching TV one night and saw this. So we didn't realise they were using it. And there they go, they found it. I don't know whether it was planted there, but it was good for TV. So we are used in a lot of different industries. At the moment, our global sales reach is right across North America, Western Europe, Japan, Australia, and New Zealand. And we sell a variety of different business models and channels. We sell through master distributors in some channels who then on-sell to resellers. We sell through manufacturers, agents in some. We sell direct to some resellers. We sell on digital. We sell on Amazon, our own web store. And we also strategically contract manufacture. So we'll make it under someone else's brand, depending on where they've got access to markets that we don't have. But ultimately, we're trying to build the Ferret brand rather than be a contract manufacturer. We have won a lot of awards. That is helping really create a strong brand. We've won 11 international awards so far across the US and UK. And we've got some excellent customer feedback, both on Amazon and on social media. We get a lot of customers that like to post videos and photos of what they've been doing. We do have premium new models due for release later this year and ongoing product development. What we're looking to do is create an update for the Ferret camera owners. So every few years they'll look at it and go, hey, I want the upgrade, just like you do with your mobile phone or other device. We're also trying to get into different price points, whether that's premium price points or DIY lower price points. We have an Auckland-based team. And we have sales representation in the US and Europe. Just a reasonably small team, but a very dedicated and focused team. And we're supported by some world-class external advisory. So what we're looking to do is raise 1 million New Zealand dollars. And we've got details on the exit strategy, a very healthy return. I can go over those details with people. If you'd like to talk to me, I'm out there this afternoon or always available. The money is going to be used for growth. Money is going to be used for ongoing R&D to let us grow faster than what we're doing now. We are growing now. We are moving towards profit. We're a very profitable business model. We want to grow fast to be in front of our competitors. Thank you very much.
Thank you so much for your presentation, Andrew. Next up, we have Tim Warren, co-founder and CEO of Vively.
Thank you. Vively.
Apologies, Vively.
It's all good.
Thank you.
How is everyone today? How's the energy levels? Usually this time of the afternoon, everyone's in a bit of a slump. That could be because of your blood sugar levels after lunch. I've been tracking mine, so I'm in a bit of a slump at the moment after looking at my levels. But so this is the clicker here. So Vively is a health technology company based here in Sydney that is trying to solve one of the biggest problems in the world, which is behaviour change for people with chronic disease or metabolic disease, as we like to refer. So, sorry. So, what is metabolic disease? Well, metabolic disease includes things like obesity, type 2 diabetes, heart disease, insulin resistance, basically disease that affects more than 50% of the population around the world, and driven by our diets and our lifestyles. So basically, it's a behaviour problem. And behaviour change is really hard. We have deeply ingrained behaviours, but continuous glucose monitors have recently been recognised as one of the most effective behaviour change tool in medicine, and are becoming increasingly popular around the world. But CGMs are extremely expensive and inaccessible. If you wanted to measure your blood sugar levels over the course of a year, it would cost over $2,000. And it's really hard to interpret the data yourself. It's quite technical. And we would know, our founding team, not sure what's going on. So our founding team has been in the health and wellness space for a few years. So there we are. So our founding team has been in the health and wellness space for a few years, including successfully exiting a number of businesses worth over $300 million in combined enterprise value. And we, over the last year, we've been working to build a solution to this problem. And so, sorry. And so what Vively does is, Vively makes continuous glucose monitors 100 times more effective and accessible for consumers. Vively leverages continuous glucose monitors, like I've got on my arm right here, other wearables, and then we create software that's created by behaviour change experts and scientists, and then we use AI to fuel diet and lifestyle insights that make behaviour change super easy for people to manage their health. The opportunity is massive. So put aside the fact that over 50% of the population have a metabolic condition. If you look at the Australian market itself, the market for wearables, smart nutrition, weight loss, and longevity is worth billions of dollars. So our platform is working. Since launching just over 8 months ago, we've grown to $2 million in annualized revenue, and we're on track for $6 million in annual revenue by the end of the year. But not only that, 90% of our members that have signed up for our product say that Vively has helped them to change their diet and their lifestyle. What's even better, distribution is getting cheaper and faster. We started off as a direct-to-consumer business, going to market through digital marketing, which was a great starting point to develop the product and build the brand. But we're now exploring partnerships with some of the leading health insurers in Australia, huge gym chains, and other wellness businesses to distribute our product through those channels. But the holy grail for us is integrating into the healthcare system. So every week we get inbound requests from clinics, doctors, dietitians, nutritionists wanting to integrate our product into their clinic, because it turns out diet and lifestyle and behaviour change is a huge problem in the healthcare system as well. The way that our product works is on a self-serve subscription basis. So customers sign up for either a quarterly or an annual membership. And at an annual membership of $680, We've managed to get the price down from $2,000 of continuous use per year to $680, but over the next few years, through the development of some of the AI we're doing right now, we aim to get the cost down by another factor of 10 and increase the utility through things like real-time predictions of glucose as well. So we're on track for break even by the end of the year and to become highly capital efficient. Just a year after launching the platform, our monthly churn rates for our customers is this month on track for below 10% and improving. We are the only brand in Australia that brings health and behaviour data together to address the metabolic disease crisis. And that technology and data gives us an advantage over every other health and wellness business in Australia and allows us to build highly effective and highly accurate AI models on top of that data. And the first to launch into clinics and into the healthcare system in Australia will provide really sticky and predictable revenue, and the winner here will win the market. So we raised $1.5 million in pre-seed last year, which has gotten us to 2 mil ARR now, and we're on track for 6 mil ARR by the end of the year. But in the second half of this year, we're going to look to raise a seed round to turbocharge our growth in the Asia-Pacific region. So our mission is to rid the world of metabolic disease by putting consumers in the driver's seat of their health. So if this mission resonates with you and you want to be a part of the journey, come find me after this chat or come find us at the store and join the monthly investor update list. Thank you.
Thank you for your presentation, Tim. Next up, we have Sean Fagan, the co-founder of THDR Group.
How would you feel if none of the clothes in your wardrobe were labeled with a size tag? The THDR Group is a fashion and technology company using artificial intelligence and emerging technologies to fundamentally shift how consumers engage with fashion. Fashion is an industry that's barely changed since mass production and ready-to-wear became the norm over 200 years ago. Our vision is to create the fashion houses of the future, and we've started with Theodore, our luxury menswear brand. The fashion industry faces several problems. We're in the year 2023, but we're still trying to fit consumers into 8 or so standard sizes, despite the many diverse body types and fit being an ongoing consumer pain point. Fast fashion's off-the-rack products result in an average 30% overstock rate for retailers with excess garments being thrown into landfill, causing significant environmental damage. Entrenched players have no motivation to innovate and avoid disrupting their existing business models. Emerging technologies can offer solutions. Our AI body measurement tech allows for a uniquely made garment created to each customer's body dimensions. Made-to-measure production reduces waste, phasing out the need for excess inventory, and consumers value the ability to personalize their unique garments. Tech and AI has matured to a point where AI measurements are just as accurate as human. We've also achieved a point where production capacity is finally able to supply, at scale, the made-to-measure garments. Shopping sustainably is now a strong consumer preference, and customers want to be unique. The THDR Pocket Tailor app is the result of months of development and uses a licensed AI algorithm applied to industries such as healthcare, fitness, and now fashion. In less than 60 seconds, the app uses the device sensors and captures 2 photos. Data is uploaded for cloud processing, where the algorithm generates the body measurements. Further applications are in development, such as footwear sizing, personalized AI styling, and AI garment design. The tech is so accurate that we provide a perfect fit guarantee on all orders, meaning that customers have full confidence in the process. Theodore is our luxury menswear brand with in-person and e-commerce channels. The e-commerce channel is driven by our Pocket Tailor app, while the in-person experiences serve 3 purposes: early revenue generation for our business, building the brand, and proofing the AI tech. Pop-ups, expos, and in-person appointments allow us to showcase our range and situate us in our target market. In the next few weeks, we will launch Ramai, our exclusively e-commerce luxury women's wear brand. Fashion is the world's third largest sector, and we're taking an approach to address traditional fashion market segments. Luxury menswear was a natural starting point, as tailoring is most common in this segment. Moving into womenswear is necessary, as the female sector generates almost double the revenue. Launching additional brands is critical for growth. We're building the fashion houses of the future, and like Tesla with their car models, we've started with luxury and worked down into the mass market with brands that address each segment. All our fashion design and tech development has been done in-house, leading to our business being extremely capital efficient. There is no market leader in the AI-powered fashion space, and so we have a first-mover advantage. Our competition is primarily traditional fashion brands in each segment. The many innovative techniques that we use across our business in branding, tech, and supply chain set us apart as we rapidly grow our revenue. We understand the ingredients to make a fashion brand and that our core functions need to be strong. Fashion design that consumers want, marketing that will cut through, reliable and accurate tech, and a supply chain that will scale. Reducing turnaround time will be key for tapping into the mass market, which long-term will require investment into regional automated manufacturing hubs. Harnessing further emerging tech, such as AI styling and blockchain for garment lifecycle, will continue to place us at the cutting edge. And expanding our offering of brands will be a major factor to ensure we capture the critical mass of the market. Upon inception in February 2021, we started with supply chain and tech development, which led to the launch of live orders in August of that year. In March 2022, we raised a pre-seed venture debt round, which was key in scaling up our operations, including our premises, staffing, and pop-ups. We are currently raising our seed round to expand globally and launch our next brand. With our HQ in Sydney, we will open our Singapore fulfillment centre in the very near term, becoming the backbone of our global supply chain. Our London studio will be open by the end of June, with key personnel ready to go. By end of year, we'll have our New York studio open. Fashion is an industry that's heavily reliant on marketing to build perceived brand value. The success of our tech application depends on re-educating consumers about the benefits of made to measure, as opposed to the current off-the-rack model. Modernizing consumer behavior is vital to disrupting the industry. Our founder, Timothy Aquino, has extensive experience in the fashion industry, including his role as head of sales at a prominent Australian menswear retailer, where he played a key role in launching their US operations and is an expert in garment design. As co-founder, I have significant business and marketing expertise from previous executive positions in both startup and large multinational organizations, as well as have tech experience including programming and development. Our creative director, Xenia Arrowsmith, is a highly skilled photographer and has an extensive portfolio of fashion and editorial campaigns, and has built a broad network across Australia and North America. We received significant traction in the past 18 months of trading, with hundreds of positive reviews showing a 4.9 rating on Google and a 93% customer satisfaction score. We're a member of the Australian Fashion Council and recently participated in Melbourne Fashion Festival. With lifetime sales of 2.9 million and this month to close at over 400,000 revenue, we're experiencing tremendous growth. Our app has been downloaded nearly 15,000 times and nearly 3,000 in-person bookings have received, and we receive top-tier professional support. Our key metrics include a 55% gross profit margin with a ROAS of 4.75 times. Average order value is $1,478, with only 2.5% of revenue used for our perfect fit guarantee. No outside equity has been granted to date, and all venture debt has been repaid. Our private investor loans are linked to the security bond for our lease premises. We've already received a government grant relating to our export markets, with 2 more grant payments pending. Our fundraising target for the seed round is $5 million. This valuation puts us at 9.2 annualized earnings multiple. As our business rapidly expands, we will continue to invest in scaling our process, including opening our fulfillment center. We will also continue to optimize the marketing efforts of our existing Theodore brand, including the global expansion. The bulk of proceeds will be invested into our Ramai women's wear brand, with significant amounts of marketing planned to ensure we generate cut-through, buzz, re-education, and scale to maximum success. It's plain to see that AI and fashion will fast collide, which will cause inevitable disruption in the industry. This will lead to a shift as seismic as the beginning of e-commerce. With already 2 years of development and through our focuses and strengths of fashion design, emerging tech, supply chain, and brand building, the THDR Group is positioned to be the leader in this next generation of disruption.
Thank you for that presentation, Sean. So now we have an amazing panel session. Just give us a minute or two to do the setup, and we will just bring our panelists in. Thank you. Okay, perfect. Well, thank you, everyone. I know it has been a full day for us all, but amazing, nevertheless. We're almost at the end of the day, and before we wrap up, we have an exciting panel discussion for you. Our esteemed panelists here today are leaders in the industry, each with their unique perspective and experiences, and they will be sharing their valuable insights on the topic of the great transformation, AI, sustainability, and deep tech. Please join me in welcoming the panelists. We have Yash Verma, founder and general partner at Empress Capital. We have Jackie Bloom, growth and investment director at Startup Bootcamp. Alex Kaur, the co-founder of Afterwork Ventures. Stuart Cook, co-CEO and co-founder at Flav. And last but not the least, Stefan Jansen, partner at Pacific Channel. Over to you, panelists.
Awesome. I thought I'd also maybe take a little bit of time because not everybody is familiar with all the companies. So just give a quick little background to provide some context. But, you know, I think the thematic of this panel is incredibly exciting, you know, and very timely as well with, you know, the world incredibly being disrupted by the natural language processing models like ChatGPT and other forms of technology that is really, I think, an incredibly exciting inflection point for, in my personal opinion, for humanity. And so, but also probably a bit of a scary time for existing businesses. How does it impact them? Investors, how are they looking into the future and what's going to be successful and what isn't? But then also, how is that going to impact their existing businesses as well? So really excited personally to be on this panel, but also hear from all the panelists today. You know, I wear a couple of hats, but just a little bit of background and why, you know, burgers and restaurant businesses aren't as relevant to the conversation today, but I also have my family office, which is called Twire Capital. So we also do early stage investing in climate tech, food and food sustainability, and well as environmental technology as well. So very exposed, and we're also you know, biased, a little bit biased because I'm also LP in Yash's fund as well. So very bullish on the AI space. So really excited about that. So I'll pass over to you, Alex.
Thanks, Stu. Hi, I'm Alex. I'm one of the co-founders at Afterwork Ventures. We're a pre-seed and seed-based VC fund here in Australia and New Zealand. We have a relatively broad mandate across a number of industries and domains and have a number of deep tech investments in our portfolio. likewise, my personal background come from a bit of the research world, so was a university researcher in applied mathematics, and then spent a bit of time in a corporate career working at Quantum Black, which is the AI arm of McKinsey, where I kind of was focused more on AI use cases for enterprise clients. Yes, that's it for me. Thanks.
Excellent. Hi, everyone. My name is Yash Varma. I'm the general partner and founder at Empress Capital. So we have a pretty simple thesis. We invest in early stage AI companies, and I think the theme throughout today has been the impact that AI is going to have. And look, we looked at this a little while ago and went, we can see now is the time. And so our focus really is at that early stage, and we feel there's a lot of opportunity in terms of augmenting almost every part of our lives. And so we're really excited. Every day I wake up and I see some new ways of doing something, and it really mirrors back to my first business, which I had started 20 years ago. I had a software business based in London, and we had global clients. And so that was in the early days of the internet. And so I feel really excited again. It's really great ways to really, as Stu said, to move humanity forward. So I think if we can use it in a really positive way, I think there's some really great opportunities.
Awesome. Is this working? Okay. Hi, I'm Jackie. I'm Growth and Investment Director for Startup Bootcamp Australia. We are one of the world's largest industry-focused accelerators globally, and we are situated in the Americas, Europe and APAC. We focus on 4 key themes in Australia. They are sustainable fintech, energy, food and agriculture, and sports and events. And we don't have enough time to go through my background because, anyway, but no, background is very much around focusing on female founders. I'm very passionate about that. And also coming from actually the startup background of doing a number of startups, failing often and learning from every single one of them. And so I share that information and share those learnings with mentoring and advisory for early stage startups as well. So and like the guys have said, really exciting space. And for me, it's all about collaboration and education. So it's important.
Hi, Stefan Jansen, partner at Pacific Channel. So we're a deep tech early stage venture fund based out of Auckland. We specialize in investing in companies in healthcare, energy, and future of food. We invest early, and then the name Pacific Channel, the idea is that we'll take companies out of Australasia, channel them across the Pacific, and help them land and expand in the United States. I'm originally Israeli and started my VC career at a big Israeli venture fund called Our Crowd, then moved to the US to work in California and venture for a while, and then came back home to New Zealand where I actually grew up, and now working at Pacific Channel. So no, very excited to be here and talk about this important topic.
Cool. Awesome. So Stefan, I'm going to throw it back to you to begin with, because I think probably focusing on, as investors, how are you thinking about the different ways this new technology wave is going to disrupt sectors? And you speak about healthcare, and personally I think it's going to be one of the most exciting spaces. That it's huge data sets, very hard to get a grasp of using traditional models. Like, how are you thinking about it, and like what are you looking at with your different industry sectors and the way technology is impacting them?
Yeah, so if we're talking about sort of traditional industries, let me actually give you an example outside of medtech. So very traditional industry, forestry, right? So in New Zealand, there's something called the Emission Trading Scheme, which basically lets you plant a tree. The government comes and audits it, and it says, okay, you have now sequestered X amount of carbon, you now have a carbon credit, and you can sell this on the open market, and by law, New Zealand polluters have to buy those, right, to offset their emissions. Very kind of simple traditional industry, plant something in the ground, watch it grow, right? We've taken a license from an AI startup that we invested in that takes geospatial data from satellites, and it basically says, okay, we're going to scan some topography, and we're going to say, based on the shape of the land, based on where we see the sunshine and rainfall, we know that this is actually the best place to plant a forest, and we can increase your yields by doing that, right? So we can use AI to identify the best place to plant a forest. We can then use AI to design the site, right? So you have great place for trees here. Maybe you have a lot of rainfall here. We should do water collection here. Maybe you have a lot of sunshine here. We should put solar panels here. Maybe you have a river going through your property, we could put a micro hydro power plant over there, right? So very, very traditional industry, right? But you layer a little bit of tech onto that, and suddenly you have this whole different way of looking at that, right? So that's a non-tech but tech-enabled project, which we're doing right now, right? And we've done that with AI. And we had a German billionaire. All the billionaires escaped to New Zealand during the pandemic, right? Because they're all convinced that this is the place to ride out a nuclear holocaust, right? So, we got in touch with some European billionaires. They came and they looked at this. Coincidentally, this guy is the founder of Carlyle Europe, so real hard-nosed investor. Looked at this and decided, oh wow, actually now that we've seen this and we have some numbers in this is really worth investing in. I'm going to bring all my friends to do this. And so, this is an industry that historically would have been, tech-free, and now with a bit of data, we're actually able to look at it with really fresh eyes. So yeah, no, we're really excited to be playing in that space, for example.
Might throw it over to you, Alex, about in the same sort of scenario as well. Like, is there a particular industries that you're seeing heavily disrupted in this space through your portfolio or different businesses you've been looking at?
Yeah, I think we like to think about the role of, AI and deep tech on two different levels. One is at the kind of core technology and the infrastructure layer. You might have heard the term kind of picks and shovels. And businesses that are building, I guess, like supporting technology at which you expect a number of applications to be built on top. And then equally, there are those businesses which are building at the application layer and very much targeting themselves at specific use cases or specific industries. I think when it comes to thinking about different industries, we think quite deeply about whether it's the right time in the technology lifecycle to be engaging at that infrastructure layer, or the right time to be investing at the application layer. I think we've made, to give an example of that, we have a number of investments in the MarTech space, so marketing technology, where there is a lot of applications for kind of AI and reinforcement learning, so very much the applications of neural networks and that style of AI, which has probably become quite popular over the last 5 to 10 year, over a 5 to 10 year time horizon, and we think now's the right time to be very much going deep at the application layer. Likewise, there are things that are becoming more prevalent. So I'm sure we'll talk a lot about the role of OpenAI and large language models, and I think we have a probably softly held thesis that at this point in time we're seeing most of the value being created and captured by those companies like OpenAI, which are building the technology infrastructure, and where it comes to building applications on top of that, that's probably an area where we have perhaps less confidence that the market has evolved to a state where it's clear who those winners are going to be and which specific applications are going to be.
And Jackie, how are you? You're obviously working with large corporates, and are they recognizing the need, and how are they interacting with you and the startups that you're working with to address that, or to brute force innovation using the technology? I'd be keen to hear how they're thinking about this.
It's a great question, because what we're recognizing is that not enough of them are actually doing enough about innovation. And so we're going to find some really large corporates lagging behind quite considerably. And that's going to be quite problematic, especially as some of the technology that is taking over and the disruption, such as electric vehicles. The electric vehicle component is really only one component of the vertical amongst the entire industry. So we're going to see this whole disruption, not just of the vehicles themselves, but then of the charging stations, of the batteries that are required, and and then of the infrastructure that's needed to run those, and then the software behind it to mandate that. So, and also from a government perspective, what's the governance going to be around all of this as well? So if corporates don't innovate now and don't come on board now and start looking at what are the programs, how can we disrupt, what are the problems we need to solve now, there's going to be a lot that are lagging behind. On the flip side of that, we are working with some larger corporates who are doing some innovation and doing some really, really interesting work. And I can't say too much, but particularly we are seeing a lot of innovation in the energy space, Food and agriculture absolutely blows me away what can be done with sustainability and circular economy of recycling as well, and also how we're improving sustainability from a livestock perspective as well, and the ecosystem and moving forward and actually helping not just the technology side of things, but from a product perspective as well, from start to end value chain. So really interesting.
And now to you, Yash, is like one of the things that I always baffles me slightly, and one of the things that I question investors on is in such a rapidly evolving market around technology and disruption, is that technology can disrupt a little or it can disrupt a lot. And so when you're making investments with Empress, albeit a relatively new fund, how are you thinking about the investments you're making? Because somebody might disrupt a sector significantly, but then how are you looking at the other people who are trying to disrupt that sector to pick the winners? I mean, that's the multi-billion-dollar question, but yeah, I'll give you an easy one to start with.
Yeah, thanks, Stu. Yeah, look, I think it's moving so quickly, particularly as our focus is in AI, and if we talk about where the value is, developing applications, particularly on large language models, it's quite easily, as we're seeing, if we look 2 weeks ago, before Microsoft and Google announced some of their functionality, we had hundreds of startups developing applications in the sort of summarization space, in the generating PowerPoints automatically, and there's quite a number of those. And in fact, we had a company called Tome. They raised, I think, $43 million in February at a $300 million valuation. Now, last week, after both Microsoft and Google released their functionality that they're going to bring into their products, that company effectively doesn't necessarily have a $300 million product. So it's very hard to understand what that is. But I do think there are some ways of looking at this which you need to have a unique either vertical and specialization. And so, we have one investment now that is in the generative AI space. It's not using a large language model or all of the large language model. I can't tell you exactly what it is in terms of, but it's working in the property space, and it's doing something really unique, which is taking some unique data sets. It's allowing people to design buildings. It's allowing people to kind of fit in with all different other rules and regulations that are around that. And I see that as being a really niche use case of this technology, which is providing a lot of value and is pretty hard to replicate. So we're looking for things that are hard problems to solve, that aren't just using this sort of the models that are just open totally. And I think there's value on top of that, but it's really identifying what that is, what the sort of process is, what the defensibility of that data is as well.
Yeah. And does anyone have any other thoughts around that, Stefan?
On picking winners?
Yeah.
Yeah, I mean, I think fundamentally picking winners in the VC industry is something that, yes, there are new technologies that come along and make us think about where are there new opportunities. But I think the formula, for me at least, has been somewhat consistent for the last 10 years. I look for someone who has insight and then can marry that to data. And let me give an example. My favorite example of this is probably Airbnb, and it's just easy to relate to because everyone has used it, right? So Airbnb was started, right, by a guy who basically had this insight, and he said, hey, once upon a time there was this cottage bed and breakfast industry, and people loved it. You got to go to a new place and meet the host, and they'd cook you breakfast, and they'd get personalized recommendations for what's happening around in the area. The issue is that it wasn't consistent, right? Some of them were great, some of them were terrible. And so into that gap sort of came running the hotel industry, and the hotel said, you know what, a Hilton in Bangkok is identical to a Hilton in New York. And so the consistency problem has been solved. But something was lost in that, right? There was a little bit, maybe you're not interacting with your host anymore. Maybe, you don't get the kind of quaint architecture of the local place that you're staying in. Maybe, they don't cook you a breakfast, or they don't give you a personal recommendation for, oh, you should go check out that restaurant. And so he had this unique insight that there was this need that, you know, we all actually loved about the bed and breakfast industry, and that got lost under sort of the standardization of hotels. And he said, you know what, with the internet, we can solve this problem. We can have reviews, and people can tell you whether the consistency issue is a thing, right? And we can leave star ratings, and you can read comments. And so therefore, the consistency thing is not as much of an issue. You can just see whether this is the kind of place where you want to stay, whether people had a really good experiences. So he had this insight, he had a solution, right? And then he married it to data. So he then got some air mattresses, he blew them up in his lounge. That's where Airbnb comes from. And he went and tested it and showed that actually, hey, yeah, you know, if you wanted to rent out a room in his New York apartment, that people would go and they would do it, and they would get the recommendations from him, and they enjoyed it, right? So that combination of insight plus data, I think, has always been a fairly good formula for the VC industry. And yes, you know, we're seeing disruptive technologies come through. We will continue to see that, right? But I think that fundamentally, when, you know, we're picking winners, yeah, you're looking for a founder, and you want to see that they understand something that few other people around them understand, and do they have some data to back up their thesis?
Go ahead.
I might just add to that. I think there's a really key piece in this scenario as well, and that is collaboration as well. I think it's really important now in terms of being able to grow the ecosystem, particularly in Australia, because we are small. We are still really far behind globally from a VC perspective, and also from deploying capital. So the more we work together on in a collaborative approach, not all deals are going to be right for every VC, right? Or for every fund. So the more we can actually help the ecosystem together, the better those picks are going to be as well, because you get a different lens and a different focus depending on what your thesis is, and I think that's really important to also help the whole ecosystem, but also to help pick some great companies.
Anything on your end, Alex? Or
not too much. I would just echo what Stefan said, which is that we're all investors on this panel, and the job of investors is not to know more about an individual founder's company or know more about the space than they do. Otherwise, that would mean that we should be the founders in the first place. So yeah, I actually would just echo what Stefan said.
Okay, now to a little bit of a different segue on this piece is the role of government. And I may throw it back to you, Jackie, to be able to just go. I know you said that you didn't want to do much of the talking, but you're jumping in, so that's good. But I mean, what is the role that government does play in either with the regulation or data privacy? I mean, there's so many different ways this conversation go, but just keeping it broad and open, whether or not it's supporting the sector, whether it's different policies. Like, is there anything that you think that you would like the members of Parliament to hear, or the or if you were Prime Minister for a day, how would you support the industry?
Oh my God, where do I start? Don't unleash the beast. No, I think there are a few things from that perspective as well. But from a governance perspective, particularly being part of the ESG considerations, everything that we do is going to need something or some form of governance behind it. So how governments at the moment should be getting involved is with funding. So the more funding we can get into early stage founders, the faster it's going to grow, the more innovation, the more technology we can bring through as well. Some of the examples are with sustainable finance. We need to be funding 170,000 early stage startups in order to reach the SDG goals by 2030, right? And it's a $53 trillion. It's $5 to $7 trillion annually invested into SDG considerations. So the point is the government plays a big part in that, because there's also going to be a lag behind with corporates being able to innovate as fast as they need to. And so the government are going to have to at some point step in and help with regulations around that as well, and also with funding.
And Stefan, you've been a VC across Israel, US, New Zealand, Australia. I've read Startup Nation. I basically want to hire every Israeli after reading that. But who are you seeing out there doing it the best, and what could Australia learn from some of the lessons that you've learned?
Yeah, so
join the army.
Yeah, so I actually think Australia has a unique opportunity when it comes to the role of government. So in the US, VCs hate funding companies that will sell to government because it's long sales cycles, there's a ton of red tape, a new party gets elected, they want to undo everything the old party did, right? Like if it was the old party's initiative, it's immediately terrible. So it's just a terrible customer, right? And I think Australasia and the governments over here have a real unique opportunity to capitalize on the fact that governments are relatively small and nimble, right? I know this is against some people's religion, but relatively to the US, governments over here are small and nimble, and that gives governments the ability to get behind and approve things in ways that larger governments can't. I'll give you an example. In New Zealand, we're investing right now in a company called Vortex, and they are, and sit down for this, they are building a company that will stack an 8-kilometer tall spinning column of vapor, right, like looks like a tornado, and then harvest that for electricity. You can't build that in New Jersey, but you can build that in Gisborne, New Zealand. It's a small town. We went to the mayor. We said, how would you like to be on the front of every newspaper in the world, bring tech jobs to your region? And he said, where do I sign, right? Like, do we need to change laws? Do we need to, I'm kind of being a little bit glib for effect, but, like, how do I help you do this? And so I think small government actually is uniquely well positioned to help the innovation ecosystem.
I think there's also a tax component as well that helps. You can be classed as an ESIC, you can invest into an ESV CLP, and so the more investment we can bring in, the greater we can create technology and spearhead it.
Being from Canberra and knowing government, seeing I'm there, yes. Look, I think there are the financial things that the government are doing, incentives, R&D grants and so forth. But I think there is a role for government being a client for startups, and it's often a bit of a barrier to run hackathons and do all these things, which is really nice, but then nothing actually happens to let them sell to government or facilitate that. So I've actually been having a few early sort of conversations with having a thing around GovTech and actually building some sandbox environments where startups can come and develop solutions in there and have some way that, the CTOs of those government departments can actually support this industry, because I think, they can be potentially a big client for early stage companies, and I think supporting, those early stage companies, why do they need to go elsewhere? I think the government has a lot of options, and so if they can, I guess, remove the red tape, the barriers, and know that from a technical point of view, because that's often what's put in front of them, they're tested, they can work and have a sort of fast path to be able to do that would be really excellent. So I think that could be a role.
Only build I have is to reframe the question entirely and take away the lens of startups and investors and industry and talk about the role government has in engaging with emerging technologies within its own mandate. So a good example of that is there's actually some really interesting research going on through the Digital Finance CRC that is spending a lot of time talking with the RBA about the role of central bank digital currencies. That's an example of a project which is beyond the purview of any individual startup or any individual company, and thinking about what are going to be the kind of societal or macroeconomic impacts of some of these emerging technologies.
And then in the last 5 minutes, so 1 minute per person, we've got a group of investors as well as startups or company operators here. So 2-part question type thing is, what are you most excited about being disrupted in terms of the space from a technology standpoint or industry? And then so that's sort of suitable for the investors in the room. But then also, what's one piece of advice in a market that we're in to give to founders or CEOs of companies dealing with this space? So
I'll go back to your first question on healthcare for this one. So, the world is aging, right? In the whole West is aging, and now also Asia is aging, right? So China, for example, is going to go from having 8 workers to each retiree to having 2 workers for each retiree. There's going to be a lot of retirees. It's been called the silver tsunami, and that is a huge market opportunity, right? So I think as these populations age, they have unique needs, and I think really the world is going to divide into the developing world, where we're talking about high quality medical care products, right, that this new demographic is going to need. And then, you know, in the Chinas of the world, we're going to need, which, you know, China does not have a funded healthcare system the way that we would think of it in a place like Australia. They're going to need a lot of the same stuff, but on a budget, right? So we're going to need med tech solutions that can deliver for, you know, a fifth of the price. So I think that's a really interesting opportunity to be exploring right now.
And quick tidbit of advice for founders seeking capital in an environment like this.
Talk to me.
Nice, there you go. The same questions again.
I'm a little bit biased. I'm going to say sustainable fintech to start with, because I am raising a fund, and you can hear more about that tomorrow. But yeah, absolutely sustainable fintech. Some people think fintech's not on the rise, but when it comes to ESG considerations, it actually grew by 88% between 2021 and 2022. So it's a huge disruptor coming our way. The other ones, AI, you know, undoubtedly, medtech, absolutely, and energy. You know, they're probably my four key. And in terms of startups and how to raise in this market, is really know who your investors are, know who you're actually talking to. Don't just go and talk to every single person in the room. You know, there is money out there. It's a matter of finding who is the right investor for you, and be really specific and target the right people that you want to talk to.
Yash.
Yeah, excellent. Look, I'm excited every day. I wake up and there's a new company in front of me doing something in a new way. And so obviously I think AI is enabling all these things, but we have all these other technologies. And to Steve's point this morning, you know, if we look at genomics, robotics, it's changing the way we do everything. But what excites me is not that low-hanging fruit of replicating what we're doing already. It's the ability to kind of step outside of that and just create some new ways of doing almost everything. And so I'm seeing some really interesting things that way that I feel, you know, can move us forward as a society and humanity. And I think that's what excites me personally, is just we can, you know, solve a lot of problems we've never been able to, and whether that be in the environment space or the health space or the education space, I think it's really exciting what's going to happen. One bit of advice quickly is I think we are focused on product. I think right now it is hard, but I think if you can develop great products, there's going to be great things that come out of this.
I'll throw a random contrarian hot take in the end just to wrap us up. I reckon don't sleep on the metaverse. It was strangely kind of wrapped up in the Web3 and crypto world, even though it's an entirely separate concept to blockchain technologies. And it's about communication. Like, the really big innovations in technology have been like writing, the printing press, then into the internet and into the social internet. And the metaverse is kind of looking for what the next step in how humans communicate with each other, what that looks like. Zoom is the metaverse. It's a form of the metaverse. Think about how many Zoom calls you took this year versus 5 years ago. Something will probably change in that space, and that's something that I think is at least interesting to keep an eye on from the sidelines. In terms of raising capital, I think the principles for building a great business have never changed. Start with a problem, have a why, understand who your customer is, and build for them.
Yeah.
Cool. 100% agree on that. And just I'll add just my part. MedTech is, for me, the most exciting thing. The fact that we still go to our doctors and they use something around their ears and then put it against your chest, but I can lift my phone up and use Shazam to be able to go through a database of millions of songs in 5 seconds, and it can pick which song, but I'm still relying on a doctor to be able to use their memory and their own ears to be able to diagnose me or work out if there's something wrong. So I think there's just so much disruption that is happening, and really exciting companies that we're seeing in that space, through whether it's AI or through medtech. So, and also not only about, I think the last 100 years has been about death prevention, but it's about life extension as well, and also quality of life extension. I think that's incredibly exciting, especially because the silver tsunami that's upon, And so, yes, so with that, I'd like to thank everyone for coming today. I'd like to thank all the speakers today. You're all doing amazing things, and keep up the amazing work. The world needs all of you. So thank you.
Thank you. Okay, thank you very much for the panelists. Much appreciated on that session. So that concludes day one for today. Obviously, Emergence goes across 2 days. Tomorrow we're going to be focusing on funds. Obviously, you get the opportunity to see the likes of Yash, Peter, also present their funds, and also Jackie, as mentioned. One of the things I love about Emergence, you would have noticed, I love when we kick off this event, you can hear the buzz of the networking, you can hear the conversations taking place. Everything we do is about creating an opportunity which doesn't exist right now, and that's what I love about it. Tomorrow's focus on property, obviously prop tech, funds, obviously venture funds as well as part of that, and then also the search for yield. These have been some of the hottest areas that we've been having investors come to us for. So I really look forward to hosting tomorrow. Obviously tomorrow as well, we do have our networking drinks as well. We expect that to be kicking off somewhere around sort of 3 to 4 p.m. It's a really funny thing when you run conferences. You have to work incredibly hard to get a good audience to come along. Somehow when it's drinks time, people just magically show up. It's just an amazing thing that always happens. But on that note, thank you again for everyone for coming. I hope you've all enjoyed today's conversations with both the featured companies and also the panelists and the keynotes. Thank you again. Have a good night.